Let us see the chapter of real options in capital budgeting. Just one question has been asked, though it is again part of derivatives chapter, so one may include it under derivatives. But here we are going to apply the options principles in real life projects, and that's why we call it as real options in capital budgeting. So let us see what you have to prepare in this chapter. Now we have only two options, call option, put option. What does call option do? In call option gives right to acquire. Now I am going to use the word acquire, not buy, because we are talking of projects. The call option will give you right to acquire. What put option will do? Put options gives you right to dispose or sell. So I may acquire a project or I may dispose a project. Only two options, right? Now, when you want to acquire the project, if you want to acquire the project today, then we don't require derivatives. Remember, derivatives are tools that are used to face uncertainty in future. So I am not going to talk about call and put option if I want to execute something today. So please remove that from your mind. So I am going to use options only to exercise my right to buy or sell sometime in future. So when we are talking of projects, either I may want to buy a project sometime in future, say 1 year from now, or I want to sell a project sometime in future, say 2 years from now, like that. The project has to be bought or sold sometime in future. For that purpose, we want to use options. I am calling real options because it's going to happen in real life projects. Now in that case, I'll give you two examples, for one for call and one for put, and then we will talk about how we are going about this solving such kind of problems. Now assume that I have an investment. Today I am going to invest, say, 100 crores. It is a 3-year project. So if I invest 100 crores in a 3-year project, and the investment pattern is like this, I will have to put 50 crores today, 25 next year, 25 after that. Now if I put 50 crores, at the end of 1 year, I will get a fair idea whether my project is going to succeed or fail. If I know that it is going to fail, then I don't want to put further 50 crores. So having invested today, I want an option to come out of the project. And if I want to do that, then I want to do something today itself, so that I'll be able to exercise my right to sell the project 1 year from now and get some money. So I'm going to buy a put option. Means what it will give? It will give me right to sell. So I will buy a put option today, which will give me right to dispose of the project, say for 40 crores after 1 year from now. If I am going to get the idea the project is going to fail, so I will invest 50 crores. I will pass through the entire 1 year and I will assess the situation. If the situation, if I assess, if I get the value of the project is 60 crores, then I will not exercise my put option. But if the value of the project is 40 crores, sorry, below 40 crores, then I am going to exercise my put option. No, something like that. So what I'm trying to say is, I will have a particular cutoff value, that is your strike price. If it is above the strike price, I will not exercise. Because we know that when X is greater than ST, suppose the strike price is 60 and the next year project is 40, then I will exercise. Suppose the next year project is 65, then I will not exercise. So if the project value falls, I will exercise. If the project value rises, I will not exercise. So this is how we use. So what I will do is I will buy a put option and keep. And next year comes, the value is 65 crores, then I am not going to exercise. So this is how I use options. Now to get this put option, I may spend 2 crores or 4 crores. And that money will be the premium which will be lost in case I don't exercise. Now how to find the price of option? So we will be either using Black-Scholes model or binomial model. That depends upon what they give in the problem. Now coming to call options. Assume that I have a project. If I invest today, it will be 500 crores. But I am thinking, let me see next 1 year how the demand is in the market. If the demand is increasing, then I would prefer to buy the project next year rather than now. So here I want to have a right to buy the project 1 year from now. So there we use call option. So by reading the data, in fact you are all very fortunate, Institute clearly gives in the problem, find the value of put, find the value of call. So then what is your job? So you must know which method to use. They will give, suppose they give S, X, R, sigma and T. Then use BS model, Black-Scholes model. Suppose they give S, U, D, R, T. Then use binomial model. Obviously they will give X also. Binomial model. So U means up percentage, down percentage. And they will give clearly use risk neutral valuation approach. So the information would be provided mostly in the question. Now the challenge for you will be to identify S and X. Remaining thing in time period will be obvious. Our rate of interest will be obviously directly given. Sigma will be directly given. UD will be directly given. These and all. So challenge will be to identify S and X. So if you read the problem, you will come to know firm wants right to sell at 100 crores. So right to sell at 100 crores, that will be X. The present value. So present value is S. What is S? S is stock price. Stock price today. So whatever is the current value of the project, that will be S. Whatever right you want to buy or sell, that will be X. So once you identify S, X, U, D, R, T, you can do. One problem is solved, which is similar to the problem asked in the CA final exam, and that would suffice as a preparation for your examination. Hope you understood this. Let us read this problem. A project is worth rupees 12 million today without an abandonment option. Suppose the value of the project is rupees 18 million 1 year from today with high demand and rupees 8 million with low demand. It is possible to sell off the project for rupees 10 million if the demand is low. Calculate the value of the abandonment option if the discount rate is 5% per year. Use risk neutral valuation approach. Now this problem, similar problem was asked in the CA final examination in the past. And this is a problem involving real options in capital budgeting. For this, you must know one of the two pricing methods, that is risk neutral valuation approach, binomial model or Black-Scholes model. So here this problem specifically tells you to use risk neutral valuation approach. Let us see how we do this problem. Project value today is S is equal to 12 million. If it is a high demand, project value will increase to 18 million and time period given is 1 year. But if the demand is low, then the project value will go to 8 million. And discount rate is given as 5%. Now, what is the price of an option which will give us right to sell the project at rupees 10 million? Now, if the demand is low, one firm is willing to buy our project, this project, for 10 million. So I want to have right to sell the project. So right to sell this project in case of low demand. Right to sell this project in case of low demand for rupees 10 million. At the end of 1 year. Is same as our right to sell is put option is same as buying a put today for strike equal to 10 million. So if I buy a put option today and that option will give me right to sell at 10 million 1 year from now, then we are asked to find the value of put option, that is price of put. So we have to find the value of put. So we can write here X equal to 10 million. So we are supposed to find P, price of put option. Now they are telling us to use risk neutral valuation approach. So we can begin by writing that the project takes two values at the end of the period, that is 1 year. Therefore, we can use binomial model. We can use risk neutral valuation approach. Where now what is risk neutral valuation approach? So we match returns of investment in risky project with returns from investing the same amount in risk-free asset. Now suppose we have a project, so we write that, let us write that first. We can use risk neutral valuation approach where we match returns from investing in a risky project with returns from investing the same amount in risk-free asset. So we are going to use this approach. Now, what is this? Let us diagrammatically draw this, what we have stated just now. Today I have S, it goes to SU or it goes to SD. S is 12, SU is 18, SD is 8. Suppose I invest 12 million in this project today, it will become 18 or 8. But if I invest 12 million in risk-free asset today, then it will give me S into 1 plus RT. That is 12 into 1 plus 0.05 into 12 upon 12. So T should be stated in years. We can write 1 also. So 12 months I have written 12 upon 12. So we are going to match the returns. And matching this, left hand side we have risky project investment. If P is the probability of the project value will rise to 18 and 1 minus P is the probability of project value falling to 8. So we'll write that let P be the probability of project taking upper value and 1 minus P be the probability of project taking lower value. Then P into 18 plus 1 minus P into 8. Now what is this? The expected value of project at the end of 1 year. Today I am investing 12. At the end of 1 year, what will be the value of this? If it rises, it will be 18. What is the probability of rising? P. So P into 18 plus 1 minus P into 8. Now this is the return you will get if you invest in a project today. And we have matched the return with risk-free investment. So match, that is equal to 12 into 1.05. Therefore, P will be equal to, so let us solve this. $18P minus 8P, that is 10P. So 12 into 1.05. Eight 4.6 divided by 10.46. So we get P equal to 0.46. Therefore 1 minus P is equal to 1 minus 0.46 equal to 0.54. So we are getting 0.46 and 0.54. Now when stock or the project value, which is 12, goes to SU. The put option will go to PU. When S goes to SD, put option will go to PD. Now what is the value of put at expiry? Value of any option is intrinsic value and time value. At expiry, time value is 0. So we have got only intrinsic value. And intrinsic value is given by the formula maximum x minus SU, 0. Maximum x minus SD, 0. SU is 12. SD is 8. Sorry, SU is 18. SD is 8. So now this will be, our x is 10. So max, and this probability is 0.46, 0.54. This also 0.46, 0.54. Why? Derivative will take the same probability as underlying. So we will write here. Now this, let us complete this. 10 minus 18, 0. Max 10 minus 8, 0 equal to 2, equal to 0. So we will write the derivative in this case put option will take same probability as the underlying. So therefore we have written this. For up it is 0.4, S to SU 0.46. So we also wrote P to PU, same probability. S to SD we have written 0.54. So P to PD also 0.54. Derivative will take same probability as underlying. So now we have calculated this 0 and 2. Therefore we write, therefore expected value of put is equal to P into 0 plus 1 minus P into 2. P is 0.46 into 0, 0.54 into 2, 1.08 million. Now this is the expected value of put at the end of 1 year. At the end of 1 year. But you want value of put today. So take the present value. Therefore value of put today is equal to 1.08 million upon 1.05. So 1.08 million divided by 1.05, 1.02857, so 1.03 we can say. So we got the value of put option as 1.03 million. Means what? This particular company can start the project today for 12 million, but it doesn't know at the end of 1 year how the project will be, whether there will be high demand or low demand. Company doesn't know, but company can think like this: if it is 18 million, no problem, but if it slumps to 8 million, then it wants to sell the project for 10 million, and in order to get that right today itself, so today it has to pay 1.03 million. So it will pay 1.03 million and acquire the right to sell the project 1 year from now at 10 million. So if the demand falls to 8 billion, then since it has got a right to sell at 10 million, it will exercise the right and collect 10 million. But to get that right, today it has to pay a premium of 1.03 million. Better that you listen to this particular entire solution couple of times to get a good grip. This is a regular question in the exam. Hope you understood this. Okay, let us see this chapter, risk management. A very small chapter which comes in section 1, and generally you can get a question for 4 marks at the most. It is combined with another theory chapter, that is financial theory and strategic management. That is the first chapter. Now if you see the new year new syllabus paper trend, you will find one question from risk management, either a theory question or problems. So what you have to learn in this chapter, let us see that. Now what kind of problems can come in this chapter? You will find usually I will say three types of problems can come. Number one, where of a stock. Number two, where of a portfolio. Number three, if at all they ask for a portfolio, they will ask what is the diversification benefit. These two problems have already come. Now in this revision course you have three problems. You can see the three problems after I complete the chapter summary and a formula. You will see the three problems which covers the entire chapter, and I told you that you can expect maximum 4 marks. Now how we define where of a stock? Now before we define where of a stock, you must understand what is where. Where it refers to value at risk. When I talk of value, suppose I made an investment. What is the chance? What is the chance? What is the 95% chance? What is the 95%? Oh, sorry, not 95. What is a 5% chance that I will lose rupees 1 lakh over 1 month? What is a 5% chance that I will lose rupees 1 lakh over 1 month on my investment of say 100 lakhs or on my investment of say 10 lakhs? So where answers this particular question. What is the 5% chance that I will lose rupees 1 lakh over a period of 1 month? Now this can be written as percentage also. Example 3%. What is the 5% chance that I will lose 3% of my investment over a period of 1 month? So where answers all these three. So we can say where consists of these three parameters. What is this parameter? This is time. What is this parameter? This is amount of loss. What is this parameter? This is percentage confidence level. Now why they say? Because generally if it is a 95% confidence level, we write 100 minus 95 equal to 5% chance. So 95% confidence level, we write 100 minus 95. 99% confidence level, 100 minus 99, 1% chance. So where consists of all the three components. So what are the formulas we have in this chapter? Number one, where of a stock. Where is equal to W sigma alpha. So what is W? W is the value of investment or portfolio held. Suppose I am having a 10 lakh investment. So W refers to 10 lakh. What is sigma? Sigma is a standard deviation of returns of the portfolio or investment. What is alpha? Alpha refers to Z score. We'll talk about alpha slightly later. So this is the formula you must remember, where W sigma alpha. Now remember, if sigma is daily, means it is standard deviation of daily returns, then where will be also daily. If sigma is weekly, then where also will be weekly. So daily where will give you daily, daily sigma will give you daily where, like that. So whatever is sigma, you will get same thing for where. If sigma is calculated using yearly returns, then you will get yearly where. Okay. So this one formula you must remember. Now what is Z score? Now when you see a normal distribution curve, when I say 5%, if I say 1% confidence, suppose you write 1% chance, 1% chance or 99% confidence, then it covers 99% of my normal distribution curve. So this is 99%. So this area which is there, this area, this is that 1% area. So this is your 1% area. So this represents your Z score. This means what? This particular level. This represents this level. Let me remove the black one. So this level on the baseline represents Z score or alpha. For 1%, it is, so here it will be minus 2.33. So alpha is Z score, which is that number on the baseline of normal distribution curve. We ignore the negative. We ignore the negative sign. So we take 2.33. So similarly, if you take, suppose you take this is suppose it is 95, then this will be your Z score, and that is minus 1.645. Now this will be given to you in the exam. So alpha will be given to you in the exam. When Z score will be given. So this particular part will be given. This also will be given. This also will be given. So everything will be given. What do you have to do? You have to multiply and write the answer. That's all. Now you are going to see the November 2020 problem, which is part of this course. What they did, they gave a table like this. They gave a table like this, but not a so big table. They gave 99% confidence, and they gave this part, this portion they gave. This portion they gave in the exam. So your job was, if we want 99% confidence, so you should look for 0.99. You can see here, this is 0.9901, and what is this? This is 0.9898. So what you should do, you should take the middle one. You can see this particular dark shaded one, the middle one. So this is actually 2.326 or 99%. So 0.99 is 99.01%. This is 98.98%. So you can take, so you can see 2.3 is here, and here it is 2.32, and this is 2.33. So we will write Z is equal to 2.3 plus 0.02 like this, or 0.03. So 2.33. So students were expected to see the table and look across. Now look for 0.99 because they had asked 99% confidence. Similarly, let us take another example. Suppose they give 95% confidence. You can see this is 0.95. This is 0.9495. And it is lying in between here. So we have here. So this corresponds to what value here? 1.6. It corresponds to what value here? See, 4. So it is 1.645 approx. So you would have taken either 1.64 or 1.65. Both are correct, because in the exam exact value will not be given. So Z for 95. So if it is 95%, confidence level 95%, then you are supposed to use Z equal to 1.645. I tell my students to remember these two. If it is 99%, it is 2.33. If it is 95%, it is 1.645. If it is 97.5%, it is 1.96. So this you write down and remember. In the exam, suppose they give a table like this. On November 20 was a very weird paper. All the problems, indirect information. Even to get 4 marks from this was a challenge. When you go through the problem, you will understand. So we got W sigma alpha. So this formula is the first formula. So which is very important. W sigma alpha. Next, if they ask for a portfolio, now they can ask, for example, if they ask for a portfolio, so we write same formula, WAR equal to W sigma alpha. Now they ask portfolio of 2 stocks. Portfolio of 2 stocks. So let us say A and B. Now in portfolio chapter, we know, suppose I'm writing 0.60, 0.40. Sigma is 20%, 30%. Correlation AB is plus 0.5. So what is sigma P? Sigma P is WA square sigma A square plus WB square sigma B square plus 2 WA WB sigma A sigma B rho AB square root. So suppose we take this, so it comes to So 20.78%. So we are getting 20.78% as a risk of a portfolio. Now in this particular chapter, they will give like this: amount invested is equal to 10 lakhs. Then what we can do is we can write A, B. W will be 60% of 10 lakhs, 6 lakhs and 4 lakh. Remember, instead of writing decimal, I am writing what is called as value. Sigma I will write as 20%, 30%, and row AB I am writing plus 0.5. Suppose I take sigma P now. Now you can see WA is 6 lakhs. So WA sigma A. So WA is 6 lakhs. WA sigma A will be 20% into 6 lakhs. So that is 1.2 lakhs. WB is 4 lakh. And WB sigma B is 30% of 4 lakhs. That is again 1.2 lakhs. So what we are going to do, we are going to make everything. So 1.2 lakh square. Remember, this is WA sigma A in amount terms plus WB sigma E in amount terms. 1.2 lakh square. I am writing lakh as L plus 2 WA sigma A WB sigma B, again 1.2 lakh square into 0.5. So 1 equal to 1.2 lakh square into bracket 1 plus 1 plus 2 into 0.5. So 1.2 lakh will come out. So 1.2 lakh out into square root of 3. So when you take square root of 3, it is 1.732 into 1,20,000. Square root of 3 into 1,20,000. 207846. So we are getting 207846. So when you take 207846, so this is in amount. So you got in amount. So in percentage, how we take? So 207846 upon 10 lakhs equal to 20.78%. You can see the answer absolutely matches. 20.78%. Here also it is 20.78%. So in portfolio chapter we were calculating sigma in percentage. In this chapter you will calculate sigma in value like this 207846. So when sigma is in percentage, where will be expressed in percentage? If sigma is expressed in value, where will be expressed in value? Remember that. So you can write this. These are all the things you must remember when you go for exam. So if sigma in percentage, where in percentage? If sigma in rupees, where in rupees? Clear? Formula is same, where equal to W sigma alpha. Okay. Then when you go to the problem, you will learn diversification benefit, which is problem is self-explanatory. You can go through that, and this is the only formula you will learn. Now couple of adjustments you must know, and that is what I am going to write here. Suppose I am using daily sigma, it will give me daily where. Suppose I write monthly sigma. Suppose I use monthly sigma, so I will get monthly where. Now how to convert monthly where to daily where? So conversion to daily where. So remember, in where calculations, 1 week equal to 5 days. Remember, we take only working days. Therefore, we are writing 5 days. 1 month equal to 20 days. 1 month is 20 days. 1 year equal to 252 days or 250 days. Some depending on some textbooks use 250 days. So when I want to convert monthly where to daily where, so I will divide by root 20, because 1 month in where world is 20 days. So I have to divide by root 20. So what is the general formula? General formula is to get daily where, divide by root t. To get daily where from monthly where, annual where, whatever it is, I want daily, so divide by root t. So if it is monthly, then divide by root 20. If it is, if we know monthly, then we divide by root 20. If we know weekly, divide by root 5. If we know yearly, divide by root 252. So we can say, for example, so daily where is equal to annual where divided by root 252. Now, therefore, what is annual where? Therefore, annual where will be daily where into root 252, cross multiply. So whenever you have annual where, you want daily where, divide. Whenever you have daily where, you want annual where, multiply. By what? Square root, remember, square root. So let it be for sigma and where, use root t. For mean, use t. What is the meaning of this? Meaning is, pay attention. Suppose I have 5-day mean. I want daily mean divided by 5. So I have 5-day average. I want daily. What do you do? Divide by 5. Suppose I have yearly average. I want daily average. So divide by 365. Sorry, divide by 252. So what I am trying to say, if it is mean, divide by t itself. But if it is where or sigma and you want to convert, divide by root t. Okay. So this is all about the formula, and everything is covered in the problem. Go through the problems well. Okay. So what all we have learned? We have learned how to calculate where, what is where, if the table is given, how to find Z score, and how to visualize W can be in terms of, sigma can be in terms of value or percentage. If sigma is where, sigma is in value, where also will be in value. If sigma is in percentage, where will be in percentage. And this conversion daily to annual, weekly, or vice versa. And the problems will explain. And in the exam, they deliberately give they gave where and they asked students to calculate this. So they gave this, they gave this, they gave this, they asked this. So all the problems are reversed in November 2020. The problem is solved, you can go through it. Okay. Let us see formulae which are supposed to know in this very small chapter of risk management. You know that risk management comes in section 1. Either you get a theory question or a problem in every exam. Now, the only formula you have in this chapter is value at risk. Now, value at risk is calculated as W sigma alpha. W is the value of the portfolio. Sigma is the standard deviation of returns. And alpha is the Z value which you get from the normal distribution table. Now what is Z? Let us see. Suppose this is the normal distribution curve. And I want to verify or I want to calculate value at risk for 99% confidence. Now this entire area is 100. So this area is 99%. Assume that this area is 99%. So therefore this area is 1%. So suppose I want to find what is the 1% chance that my money will be lost. So that's how we find out value at risk. Now what is Z? Now whatever value we get here, that is a baseline value. Now this is 0. So for 99% Z is minus 2.33, but we don't take minus sign. We take Z equal to 2.33. In the exam they will give you value of Z. So it has got different values. For 99% it is 2.33. For 97.5% it is 1.96. For 95% it is 1.645. So all these values will be given. So you will be given portfolio value, you will be given sigma, you will be given alpha, and you have to calculate value at risk. Remember, this is the case when mu is not given. Remember, mu is not given. Mu is mean. Mean is not given or it is given as 0. Then we use this formula. Suppose they are given mean. Then you have to make a small adjustment like this. You have to do sigma alpha minus mu. So slightly different formula. This is yet to be asked in exam. Now, in where world 1 year is equal to 252 days. For us 1 year is 365 days. But in the where calculation, I will use 1 year equal to 252. Some books use 250. How we get this? We have 365 minus 52 Saturday minus 52 Sunday. Why? We subtract because markets are closed. So this comes to 1, 6, 3. Then we subtract 10 public holidays. Most of the countries do not have more than 10 days leave. So this comes to, this is 1, this will be 261. This will be 251. So some books use 250, some books use 252. We can see that we are arriving at around 251 days. Some countries have 11 days holiday. So they have used 250 or 252 days. Now, suppose you calculate Suppose they are given that annual mean is so and so. So we can calculate mean for 30 days. So first convert annual mean to daily mean. Suppose annual mean is given as 12%. So you divide by 252, you get daily mean. And after you get daily mean, you multiply by the number of days. So that will give, suppose you want mean of 25 days. And they are given annual mean. So first convert annual mean to daily mean divided by 252 and then multiply by that number of days. So that's how you do. But it's only for mean. Now if it is for sigma, then instead of t we have root t. If it is where, instead of t we have root t. This is very important. You should not forget. Very important formula. So usually when annual data is given, convert to daily data and then convert to 10-day data or 20-day data. Remember, annual to daily, and from there you have to go up. Now diversification benefit of portfolio. This is very well explained in the example that is solved. You must have a look at it. It is yet to be asked in the exam. And when we have where is equal to W sigma alpha. Now this sigma, if you want to calculate for portfolio, so they will not give sigma. What they will do? They will give W1, W2, they will give sigma 1, sigma 2, they will give rho 1, 2. So using Markowitz formula, we can calculate sigma p, and that you substitute here. So like that we get value of risk at portfolio. So understand that we will be doing this. Now this W sigma will be separately given here. You can see how it is. Again, the example that is solved will explain all these tricks, and it's very important example, likely to be asked in the examination, which you are going to face in future. And diversification benefit is yet to be asked in any exam. Now let us go to the next chapter. Let us read this problem. Consider a position consisting of a rupee 3 lakh investment in security A and a rupee 5 lakh investment in security B. Suppose that the daily volatilities of these two securities are 1.8% and 1.2% respectively, and that the coefficient of correlation between their returns is 0.6. What is the 10-day 97.5% confidence level diversification benefit using value at risk concept? Use Z for 97.5% confidence level as 1.96. This problem has been asked in the CA final exam, but they didn't ask diversification benefit. They asked the total portfolio where. So this involves additional concept of diversification benefit. Let us see how we solve this. First of all, we must know how to calculate portfolio risk. So we use the Markowitz formula. Sigma p is equal to square root of W1 square sigma 1 square plus W2 square sigma 2 square plus 2 W1 W2 sigma 1 sigma 2 rho 1 2. In the chapter of portfolio management, this is usually given, as proportion. Say I am investing 30% in stock 1, 70% in stock 2, that is given in chapter of portfolio management. We are also provided with standard deviations of the individual securities, and finally we are provided with correlation. But in the chapter of risk management, these two will be provided in combined form. Means we will be having value terms. Now let us see in this problem. I'll explain both these concepts. It's fairly easy, not that difficult. Now let us see what all have been provided. So we have security A and you are making an investment of 3 lakhs. We have security B. You are making an investment of rupees 5 lakhs. Sigma is given. Volatility means sigma. Risk is daily volatility. It is 1.8% and 1.2%. And row AB is given 0.6. Now the question is, what is a 10-day 97.5% diversification benefit using where concept? Now we have to calculate value at risk, and then what they are asking, let us first understand that. Now value at risk of any stock is given by the formula W sigma alpha. W is, let us take one by one, where for security A. Now since this is daily, they are given daily volatility, so we will also get daily volatility only. Daily where, we can calculate daily where. So depending upon sigma, value at risk will be of the same nature. Suppose sigma is weekly, then where will be weekly, like that. So where daily we can calculate. Now this is your W. So how much I am let me calculate for stock A. So this will be 3 lakhs into daily is given as 1.8% into alpha is the Z score. Z score for given confidence level. What is alpha? Let me just briefly explain to you. We have a normal distribution curve, and this portion is 97.5% area. Now this is center 0, this is minus infinity, this is plus infinity, this is 97.5%. This value on the baseline is your alpha, that is given as 1.96. It should be negative obviously, but we take positive value for calculation. So this should be minus 1.96 actually. Now this area is 2.5%. The total area is 100%. This area is 2.5%. So this problem is trying to ask us, what is a 2.5% risk of investing in security A and B, and how much more, or what is the benefit of investing in the portfolio of A and B rather than A and B separately? And that's what we are trying to ask. So we have to use Z, that is given as 1.96. So we substitute in this formula and we can calculate that as 10584. We ignore the decimals if at all it comes. Similarly, we calculate for where daily of security B. This will be 5 lakhs into 1.2% into 1.96 is equal to rupees. Remember, this is your rupee, therefore your answer is rupee. 1.8% is a number, 1.96 is a number. So we are having answer in rupees. So value terms, we can state where in value terms also or percentage terms. So here we are having value, therefore we are getting the answer in value. So when you multiply this, you get 11760, sorry. Now this is where of investment individually. Now what is where of portfolio? Now where daily of portfolio will be square root of. Now we can find that we are having W1. Just see here, I am circling in red here on the top. W1 sigma 1, we are having combined form. W1 sigma 1 for security A will be 3 lakhs into 1.8%, that is 54,000. No, 5,400, sorry. Similarly, W2 sigma 2, that is security B, 5 lakhs into 1.2% equal to 6,000. So W1 sigma 1 we are having in a combined form. So we will substitute this in the formula. We can write here since 5,400 square plus 6,000 square. See, W1 sigma 1 is 5,400. W2 sigma 2 is 6,000. Now you can see I am circling in the top. So I am having W1 sigma 1 and I am also having W2 sigma 2. So I can straight away multiply this here. 2 into 5,400 into 6,000 into 0.6, that is correlation coefficient. When you take the square root, 5,400 into equal to memory plus 6,000 into equal to memory plus 2 into 5,400 into 6,000 into 0.6 memory plus memory equals square root 10,200. So we are finding that the portfolio is having a WAR of 10,200. Now individual, you can find it is more, 10,584, 11,760. Okay, so how to find out the benefit is what they are asking, but they are not asking where of daily bill. They are asking 10-day where. They are asking find out the benefit for 10 days, not daily. Had it been daily, what I would have done is, let me mark this as, suppose I write 1, 2 and 3. So where diversification benefit daily would have been 1 plus 2 minus 3. Means what is the value of investing in A plus what is the value of investing in B minus what is the value of investing in portfolio. So whatever difference you are getting as answer, that is a where benefit of investing in portfolio. But we want for 10 day. So we have to convert all where daily into where for 10 days. Now, before we proceed, I was telling about in case I am going to do in the form of what I did in portfolio. Now let us see. Now this completes the first part of the answer. Suppose I can get this 10,200. I can get this 10,200 by second method. I'll just do that first. That is where a portfolio method 2. Now this you will not find in any textbook, neither suggested answer, but I'm just telling you because you are conversant with calculating portfolio risk in the chapter of portfolio management. So we are at A, B. Investment rupees 3 lakhs, 5 lakhs, total 8 lakhs. So WI 3 upon 8, 5 upon 8. So that is 0.375, 0.625. Sigma I 1.8%, 1.2%. And rho AB, it is given as plus 0.6. So what we do, sigma P is equal to W1 square, so 0.375 square, sigma 1 square plus W2 square, 0.625 square, 1.2 square, 2 into 0.375 into 0.625 into 1.8 into 1.2 into 0.6. So let us do this. 0.375 then 0.625 into then 2 into 1.275%. Now let us see what we are getting. Now what is 1.275% of total portfolio value? That is 1.275% into 8 lakhs. We are getting rupees 10,200. The same as what we got. So you can continue to use that portfolio formula and do this. Okay, or do by that method the way we have done here. You can see the answer is same. So we are getting here 10,200 and we are getting here same answer. Okay, now let us proceed to do 10-day where. Now how to find 10-day where? So 10-day where of security A is equal to where daily into root 10. So whatever is the number of days we want, we have to take the square root of that. About 20-day where, root 20. T-day where, root T. 6-day where, root 6. So we have to just multiply with the daily where. So this will be equal to, we got daily where as 10,584. You can see this, I am highlighting here. And B, we are getting 11,760. So 10,584 into root 10, and the other one is 11,760 10-day where of security B is equal to where daily into root 10, 11,760 into root 10. So let us calculate this. Three 470. Three 7,188. And then what is 10-day where of portfolio? Will be where daily. So you can actually write a subscript here, where daily of A, where daily of B, now where daily of portfolio into root 10 is equal to 10,200 into root 10. No, it's not 10,200. It is actually sigma P. This is sigma. So we have to calculate where of. So here we should substitute after calculating where daily of portfolio is equal to W sigma alpha, that is 10,200 into 1.96. So we will get 1,992. So here we will write 1,992 into root 10 63220. We get 63220. So this you can put a mark. So what we have got is, we got 10-day where of security A, that is 33470. We can call it as 1. 10-day where of security B, we got 37188. We can call it as 2. We got 10-day where of portfolio, which is rupees 63220. We can call it as rupees 3. Sorry, third. Therefore, where of portfolio for diversification benefit, where of portfolio diversification benefit is equal to 33470 plus 37188 minus 63220. This will give us 7438. So this is the portfolio diversification benefit what they have asked. So we have got two stocks A and B. Had we invested individually, the 10-day VAR would have been 33470 and 37188 respectively. But since we invested in the portfolio, we got some diversification benefit, and that we find out as add the individual 10-day VAR of stocks and remove the portfolio VAR, and that will give us the diversification benefit. So it has got, so what are the steps we did? Let us revise. Number one, what is VAR? Now VAR is given by this formula. This is the first thing we learned. What is W? W is the value of investment which we make. What is sigma? Sigma is the standard deviation of the investment, usually stated in percentage form. What is alpha? Alpha is a Z-score which we get from standard normal distribution table. It is usually given in the exam. Okay. So in this problem, what was the requirement? The requirement was to calculate diversification benefit of investing in security A and B. In what proportion? So we can see in the proportion, we are investing 3 lakh in A, 5 lakh in B. So proportion is 3 by 8, okay, is to 5 upon 8, or 3 is to 5 you can say. So in that case, what is the benefit? So how we went about doing that? First we calculated VAR daily. Step number 1, we calculated VAR daily of what? Of A, then B, then portfolio. Then for A and B, sigma is directly given, but for portfolio we have to calculate sigma P using our normal formula, Markowitz formula, which you have learned in portfolio. So we got VAR daily. Then we calculated VAR 10 days for A, for B, for portfolio. Then third, we calculated diversification benefit. How? Suppose I am calling it as 1, this is 1, this is 2, this is 3. Then VAR or diversification benefit, you can say diversification benefit will be 1 plus 2 minus 3, and that's what we got here as 7438. Hope you have understood this. Let us see this problem. Ramesh holds rupees 1 crore worth of shares of ABC Limited, whose market price standard deviation is 2% per annum, assuming 252 trading days in a year. What will be the maximum loss level? Within bracket they are given value at risk over the period of 10 trading days with 99% confidence level. Assume Z equal to 2.33. This problem involves use of value at risk concept, and we have to calculate for the stock for 10 days. Let us see how we do this problem. So value at risk is given by W sigma alpha. Now what is W? W is the value of the portfolio, and it is given as rupees 1 crore. What is sigma? Sigma is the standard deviation calculated using market prices. Usually we use market prices. We calculate mean and then we calculate deviation, square the deviation, total it and divide by number of data and take a square root. We get standard deviation. So, and that is given as 2%. 2% per annum, and assuming 252 trading days. So they are given now in where world 1 year is 252 trading days, signifying that we take only working days. The norm is we exclude Saturdays and Sundays, approximately 104 in a year. So 365 minus 104, and then we subtract public holidays, which comes to around 251, 252, 252. So here we are asked to use 252 for a year. Usually we use 252 or 250. So some textbooks use 250, some textbooks use 252. Even if it is not given and they are asking a question on value at risk, you should not take 1 year equal to 365 days. You should take 252, at most 250. So here it is given. Next, Z value. So 99% confidence level. This is a normal distribution graph, and this occupies 99%. So this is the remaining. And the value corresponding to this is 2.33. This is a Z value. Though it is negative, in the normal distribution graph we use positive value. So our alpha is our Z value. Remember, this is per annum. So using per annum standard deviation, we'll get value at risk per annum. So when we substitute this, so rupees 1 crore into 2% into 2.33 will give us 1 crore into 2% into 2.33, 4,66,000. Now they are asking calculate 10 day. Now first annual where I have to convert to daily where. Now this is annual, remember, because we are using annual SD. So this is annual where. Now we have to calculate daily where. Now how to convert daily where? See, annual where divided by root 252. So that will be 4,66,000 divided by root 252. 15.875. So 4,66,000 divided by 15.875. 29354. 29354. Yeah. Now we want 10 day where. Now 10 day where will be, now we have to convert daily where to 10 day where. Daily where into root T. So in this case 29354 into root 10. So we multiply into root 10. So this will give 92827. Approx. Depending upon the round off, it will be 92829, 92827, 92828, etc. Says okay. So Approximately this should be the answer. So what we have learned, using per annum SD, we could calculate annual wear. We converted annual wear to daily wear by dividing by root 252, because 1 year equal to 252. Then we multiplied by root t to calculate 10-day wear. This question comes usually in the compulsory section for 5 marks. If at all, 4 to 5 marks. You can't get more than this. Hope you understood this. Let us see this problem. This was asked in November 2020 exam in the new syllabus. On Tuesday morning, before opening of the capital market, an investor, while going through his bank statement, has observed that an amount of rupees 7 lakhs is lying in his bank account. This amount is available for use from Tuesday till Friday. The bank requires a minimum balance of rupees 1000 all the time. The investor desires to make a maximum possible investment where value at risk should not exceed the balance lying in his bank account. Now, what is the balance lying in the bank account? It is 7 lakhs. So, where should not be more than 7 lakh. So, indirectly they have given the value of where. The standard deviation of market price of security is 1.5% per day. The required confidence level is 99%. And Z equal to 2.33. In the exam they gave in the form of a very big table to frighten the students. But one has to look across 99%, you would have found 2.33. You are required to determine the maximum possible investment. So it involves calculation of W, that is the investment, since where is already given. Let us see how we solve this. This problem on risk management was asked in November 2020. This came for 4 marks. Now, like every problem in the exam of November 2020, even this was involving reverse calculation. Now, it is given that there is a balance in bank of 7 lakhs. It is also given that the bank requires minimum balance 1000 all the time. Investor desires to make a maximum possible investment where value at risk should not exceed the balance lying in bank account. Means where should be maximum, where should be 7 lakhs. So they are given where here. Generally where is asked. So here they are given where. And they are given standard deviation is 1.5% per day. So daily SD is given is 1.5%. And the Z score, Z or whatever alpha value we require, that is given in the table for 99% confidence. Z for 99% confidence from the table is equal to 2.33. Because if you see the table, which is given in the exam, in the question I given directly, so it was very easy to actually see the value of Z as 2.33. And what they ask, you are required to determine the maximum possible investment. So investment is question mark. So in our formula, what are this? So this is your where, this is sigma, this is alpha, and this is W. And what is the formula we have? Formula for where is value at risk is equal to W sigma alpha. So 7 lakhs is equal to W into 0.015, because 1.5% it is, into 2.33. Therefore, W is approximately equal to 7 lakhs divided by 0.015 divided by 2.33. 2 crores. 2 crore 2 lakh. So we are getting approximately equal to 2 crores. Therefore, maximum possible investment is equal to 2 crores. So only if the investment is 2 crore, your where will come, okay, below what is called as 7 lakhs. Now this is maximum, so it should be below. So possible investment should be below 2 crores. Therefore, possible investment should be less than rupees 2 crores. Hope you understood this. Let us see the chapter of mutual funds now. One of the most popular chapters, very less to study. That's the greatest advantage, and Institute's most favorite chapter. I would rate it fairly easy as compared to or as like portfolio management. At least in portfolio management you have a lot of formula. Here you don't have that. So let us see what you have to learn in this chapter. So what kind of problems can come? Let us see that first. If you divide the chapter, you can see problems can come on NAV, it can come on returns, come on plans and performance. Now usually these two are combined or these two are combined. This usually gets combined with portfolio management. So you can't study one part. As I told you, you can't study just one chapter also, because the entire section you have to complete. Unfortunately, mutual funds and portfolio management, they are in different sections. Even in November 2020, you had a problem where you are expected to know portfolio management concepts while solving mutual fund problem. So section 2 you have portfolio management, section 3 you have mutual funds. So therefore I strongly advise everybody not to leave section 2 and section 3 compulsory. If at all you are not finding time, don't do section 4 forex. Entire forex you can leave. At the most you will lose 28 to 32 marks. So 120 minus 32, still you can attempt 88 marks. But if you leave section 2 and a question comes in section 3, it may have concepts from valuation, from bond market, from portfolio. So you have problems. So never leave section 2 or 3. Do both. So let us see what kind of problems you get. Let us write down. First, NAV. Whenever we give, assume I am an investor, I give money to mutual fund. What does mutual fund do? Mutual fund invest that money. The fund manager of the mutual fund would use his professional experience, knowledge to invest money in securities. And SEBI says that at the end of the day, you have to declare NAV and tell investor what is his money's worth. So NAV, net asset value, gives money's worth to investor. So investor comes to know, okay, my 10 rupees has become 10 rupee 20 paisa, 10 rupee 30 paisa, like that. So how that is calculated? So NAV is calculated this way. Now at the end of the day, whatever securities have been bought and which are held by the mutual fund in the account of the respective scheme of the mutual fund, so you take the market value of securities. So market value of securities, then mutual fund may have some cash yet to be invested or cash received, okay, in the past and held thinking what to buy, etc. So all those things will be asset. There may be some payments due to be made or yet to be made and which are due but unpaid, liabilities. So minus liabilities. Now today mutual fund is declaring a NAV and today only it has received dividend on the security, dividend on equity shares. Today it is going to declare a NAV and today it has received dividend. So that will be shown under income. Yesterday it was received and it is still kept, that will come under cash. Today it is received, so you show under income. Similarly, expenses divided by outstanding number of units which have been allotted under the scheme. Now usually you have a problem where institute will give you a problem where transaction for the entire month will be provided. So you are going to see problems actually. Transactions done during the entire month is given. So then, how to segregate asset, income, etc. Since it is already conducted during the month and you are actually calculating at the end of the month, so I can combine every inflow in cash, every outflow minus cash. I can club under asset. Whenever I receive today, I show income. But the question would state that during the month the fund received so and so. During the month means it has already passed. So I generally tell my students, you put everything under adjustment in asset, opening cash, received, add, paid, subtract, and closing cash. So you show under net asset, that is in asset column. So this is the formula which you are supposed to know. Remember, whenever mutual fund deals with investor, the investor cannot buy or sell units. Remember, units can be bought when there is a NFO, new fund offer. So new fund offer is like our IPO in equity. So whenever NFO is there, mutual fund can buy at a face value, usually 10 rupees. Now after the NFO is over, there is some gap of a week approximately, and units will be allotted to those investors who subscribed during NFO. And in that period of week, the mutual fund would have accounted for all the money which had come and which have not been actually received, blah blah blah, all those. And the first NAV will be declared after a week. And from that day, if it is an open-ended scheme, any investor can come in or get out. Means we can buy units, or the one who applied during NFO can sell their units also. Now when you buy unit, now what does mutual fund do? mutual fund will sell units to investor. Mutual fund will buy or repurchase units from investor. Therefore, this is called sale price, because you have got the sell units. The sale price has come like this. Therefore, this is called repurchase price. Because mutual fund is repurchasing. Now, sale price will usually be NAV plus something. That is called load. Repurchase price will be NAV minus load. Or in percentage form, we can write NAV into 1 plus entry load. We can write here NAV into 1 minus exit load. If it is in percentage form, if it is in absolute form, we can say it away. Now this particular entry load now is banned actually by SEBI. Since August 2009. But still you get problems in the exam. It says that mutual fund charge entry load. I don't know how they are doing it when this is already gone. But you are requested to just ignore and apply this concept. Entry load means you have to, the sale price will increase. Sale price is what? Sale price is the actual investment, invested price for investor, because mutual fund is selling the units and you are buying, or you can say it is a purchase price, invested or purchase price for investor. Similarly, repurchase price is redemption price for investor. Okay, this is all about NAV. Next, we talk about plans. Of mutual fund. Again, unfortunately, your bonus plan is banned since many years, and your November 2020 question paper had bonus plan. Now, what they are trying to test, we are not very sure. So therefore, I am forced to explain what is a bonus plan. In real world, you will not get any bonus. Okay, let us see what are the plans of mutual fund. Assume that we are going to subscribe to NFO of mutual fund, and there will be columns. Which plan you want? So these are the plans which will be available. Dividend plan, dividend reinvestment plan, bonus plan which will not be available in real life, and growth plan. So we are going to see the difference between all the four plans. Assume that an investor is subscribing to all the four plans. rupees 1000 each. So amount invested rupees 1000. Assume that it is a NFO. So NFO price rupees 10 for all the 4 plans. NFO means new fund offer. So everybody is starting at normal starting point is face value 10 face value. So how many units will be given? Units will be 1000 upon 10, 100. So rupees 1000 upon rupees 10. All will get 100 units. Understand a couple of things now. Person opting for dividend plan will get dividend in cash. He is not eligible for bonus. He will not be under growth plan. He will be in dividend plan. Whenever mutual fund declares dividend, he will get dividend in cash. Dividend plan. Okay. Now dividend reinvestment plan. Dividend reinvestment plan unit holders will also receive dividend, but that amount of dividend will be returned back to mutual funds to reinvest in the form of units. So in dividend reinvestment plan, dividend will be accruing to the unit holder, but it will be converted to units. We'll see at what price. Bonus plan will receive bonus units only when bonus is declared. Otherwise, he will not receive dividend. Growth plan will neither receive dividend nor reinvestment units nor bonus. He will enter at the beginning, and when he is redeeming, he will take entire thing in the end. That's all. So let us apply each with an example. Suppose after a few days, NAV is rupees 15. So it will be 15 for everybody, because now no activity has happened, no corporate action till now in the form of dividend or bonus has taken place. So everyone will be at 15. Now at this point, dividend is declared. Dividend of rupees or 20%. Dividend 20% declared. 20% means what? 20% of face value equal to 2 rupees. Face value is 10. You can see this. Face value is 10. 20% of face value is 2. So dividend of 2 rupees will be given. So this will be, how many units are there? So 2 into, so 200 rupees will be given. Here also 200 rupees will be given. Nothing will be given, nothing will be given. Now X dividend NAV. X dividend NAV means after giving dividend, what will be NAV? NAV will be rupees 13. How? Rupees 15 minus rupees 2. Here also it will be rupees 13. Because you are giving dividend, though he is going to give back, but you have to know. Here NAV will be 15. Here NAV will be 15. Now fresh units. Fresh units will be given. Nothing here. Here it will be given. On 200 rupees, add rupees 13. Remember, this is important. So it will be given X dividend NAV, remember. So whatever is the dividend for, whatever is the NAV post dividend, that will be the basis of allotment of fresh units. So on 200 rupees. So this comes to 200 by 13, 15.385. So equal to 15.385. Now certain rules you have to follow when you solve problems in mutual fund. NAV 4 decimals. Units 3 decimals. Then amount 2 decimals. Better to follow. This is the norm in the market. So get 15.385 units and here no allotment. So total units will be 100, 115.385, 100, 100. So reinvestment units plan, whoever has chosen, units have increased. Let us assume that some days pass and NAV is rupees 18. Here also it will be 18. They will be same, remember. Assume that this is 20. Assume and 20. And bonus is given. No bonus will be here. No. It will be say 1:2. Nothing. So 1:2 bonus has been declared. Bonus declared. So whoever has opted for bonus units, only they will be given bonus. So bonus units. Nothing. 1 for every 2. How do you read this? 1 for every 2. So this will be half into 100 equal to 50 units. So bonus units will be given 50. And no bonus units here. So total units 100, 115.385, 150, 100. What will be NAV? NAV will be 18. NAV will be 18. Here NAV will be changing because you are given. It's like you must have known in share, whenever we are using reserves to give bonus, it becomes half. So here the 20, the value will be maintained in such a way. See, units before into NAV should be equal to units after into NAV. Units before 100, NAV before 220, units after 150. Therefore, what will be NAV? You can write NAV star. What will be NAV star? Therefore, NAV star will be 2000 divided by 150. So 2000 divided by 150, 13.33. So this will be 13.33. This will be 20. When the value before will be equal to value after. So this value will be equal to this value. So NAV will be, so this is all about dividend plan, dividend reinvestment plan, what you call as bonus plan and growth plan. Now plan and return, they come together. NAV and return, they come together. So what is return? So when we talk of returns, so we categorize into two parts. Period less than or equal to 1 year, period greater than 1 year. If it is period less than or equal to 1 year, then we write NAV end minus NAV beginning. So you bought at 10 rupees, you sold at 12 rupees. So difference 2 rupees. NAV end minus NAV beginning plus any income received. Income can be by way of dividend or whatever they name, divided by NAV end minus NAV beginning is capital gain plus dividend is income divided by NAV beginning into 12 upon N. N is months or 365 upon D into 100. So what you do is you annualize. So period less than or equal to 1 year, you always annualize. If the period is greater than 1 year, in real world, we use compound interest formula. In ICAI exam, we use average return. Average return means what? Let us see. Example 1/1/16, you invested 10,000. 31/12/20, you got 34,000. So period is 16, 17, 18, 19, 20, 5 years. Amount received. So let us make a number slightly smaller. 24,000. Amount received or gains, you can say. Gains received equal to 14,000. Therefore, return, that is average, will be 14,000 upon 10,000 into 1/5 into 100. That will be equal to 28%. So this is what they do in the exam. So average return. So if they tell you to do, use compound interest formula, then it becomes difficult for them to provide you scientific or permit you scientific calculator or log table, etc., etc. So therefore we use average return in the exam. Okay, this is all about returns. Last we come to performance. Now there are many problems solved in performance. You can go through it. There are three. One, Sharpe ratio. Portfolio return minus risk-free return upon sigma p. Trainer ratio. Portfolio return minus risk-free return upon beta p. Usually you rank based on values. Higher the ratio means numerator is more. Numerator is return over risk-free rate is more, and risk which is in denominator is less. So risk is less, return is more. Good, no? So higher the ratio, better the performance. Better the performance. Therefore, rank will be 1. Rank 1 for best performer. I wrote deliberately rank 1 for best performer. Usually, I stood first in a class. My rank is 1. That's good, no? I say in some students, unfortunately, best performer they gave number 5. Best number 5 is more than number 1. So please understand, here rank 1 means best performer. And students have lost marks. Simple thing. Remember, highest ratio should be the best performer. Therefore, they should get rank 1. Now last is Jensen's alpha, which is same as alpha what you learned in portfolio chapter, which is nothing but actual return of the portfolio minus expected return as per CAPM. Positive alpha means good performance. Positive alpha, good fund. Why it is a good fund? Because portfolios perform more than what CAPM desired. So the fund manager has done good job of selecting stocks, proper timing of sales and purchases. Overall good fund management skill has been exhibited by the fund manager. Okay, so these are all the problems you have in mutual fund chapter. The problems which are compiled are very wide, very varied. Go through that. Okay, hope you got all this. Let us do the formulas in the chapter of mutual funds. Fairly easy chapter, usually comes for 8 to 12 marks. Now, mutual fund is a pool of funds collected from various investors to manage with the view to enhance the returns for the investors, whom we also call as unit holders. So the entity of mutual fund, it will sell in the form of units. They collect money, say 1 lakh rupees. Assume that the face value is 10 rupees. So 1 lakh divided by 10 rupees, 10,000 units. So the 10,000 units will be sold by the mutual fund at 10 rupees each. And the rate at which it sells is called sale price. Now, when the fund is running for a few years and somebody want to buy, then the mutual fund can charge, but currently no mutual fund does, but still you should know the concept. The mutual fund can charge some additional extra which is called as load over the asset value or net asset value. So already I have said three terms: net asset value, sale price, load. Let us see these three first. What is net asset value? All the unit holders have given money to mutual fund. What mutual fund did? It invested in securities. If you take the market value of securities, remember I bought securities at a particular point of time and 1 month has passed. Today the market value of security has changed. So that market value of security I should take. If there is any money that belongs to investors, will have to be added, that is assets. This should be minus. And any money which is due to be paid, like outstanding auditor fees, outstanding fund management expenses, outstanding SEBI charges, whatever is outstanding to be paid, that will be minus liabilities plus income minus expenses. So market value of security plus assets minus liabilities plus income minus expenses, that will be numerator, divided by outstanding units, will give you net asset value per unit. Now this is the actual value of that unit which is held by mutual fund, and when the mutual fund goes to sell these units to investors, it can charge a load called as front end load or entry load. Now entry load is banned now, but if there is an entry load or front end load, then we calculate sale price as NAV into 1 plus load percent. So suppose NAV is 10, load is 2%. So 10 into 1 plus 0.02. So it will be 10 rupee 20 paisa. So sale price will incorporate addition of that entry load or front end load. SEBI has banned entry load since August 2009. Now sometimes questions do come in the exam with entry load. So you must know how to calculate. Now repurchase price means mutual fund is repurchasing units from you. Now first of all mutual fund will sell, then it will repurchase. So repurchase means the price at which unit holder is redeeming the fund. So you redeem at repurchase price. And when you redeem, mutual fund may deduct some charges. They are called back end load or exit load. So back end load or exit load. So we calculate repurchase price as NAV minus NAV into bracket 1 minus exit load. So these three formulas. Then how we calculate return? Now returns are categorized into two parts. One which is for a period 1 year and below, and other for a period greater than 1 year. For period 1 year and below, that is most common in the exam. So what you do is NAV end minus NAV beginning, the difference. You invested at NAV beginning, you redeemed at NAV end, you received some dividend. In institute also gives capital gain per unit, so that also we take it here, divided by NAV beginning into 12 upon n, means we are annualizing. So returns are always annualized, so therefore we are 12 upon n. Returns are in percentage, therefore into 100. So mutual fund returns for a period 1 year and less is calculated by this formula. For a period 1 year and less, remember, If it is beyond 1 year, then we have to use compound interest formula actually. And in the past, whenever the questions have been asked which is beyond period of 1 year, ICAI has calculated average return. When I say average return, suppose I own 10%, 12%, 14%. Now assume that, let us ignore this, 10 and 30 rupees. So you take average return. So I earn 20 rupees on 10. So 200% divided by 3. So that's the way. But in real life, we don't calculate that way. We calculate using compound interest concept. But you can refer the solution, which I personally don't agree. That's not the way you're supposed to calculate, because we need compounded annual growth rate, and that is nothing but one single rate earned every year, for which you have to use compound interest formula, what we have learned in school. But institute is calculating average return. I leave it to you how to do that. But in real world, don't do. Then in mutual fund, there are 3 main plans. One is a dividend plan, dividend reinvestment plan. Then there is growth plan. What is the difference? Whenever mutual fund declares dividend, then the cash dividend goes in the hands of the unit holders. That is a dividend plan. Then now let us see what is a dividend reinvestment plan. Whenever a mutual fund declares dividend, dividend goes to unit holder, but unit holder returns to the mutual fund. Why? Because he wants fresh units at the ex-dividend price. So after payment of dividend, NAV will fall. So at that new NAV, units will be issued on the dividend which is given to the investor. So under dividend reinvestment plan, you reinvest dividend at the ex-dividend NAV. Therefore, number of units will increase. Usually they will be in decimals, because generally you will not get a round figure. And finally, growth plan. No dividend will be given to the growth plan unit holder. Suppose you have selected growth plan, mutual fund declare 10% dividend, you will not get dividend. Neither your NAV will fall, because you are not given dividend. Suppose I give you dividend 2 rupees and current NAV is 18 rupees. 18 minus 2, 16 rupees will be the new NAV, because I have given 2. But in growth plan, since I am not giving dividend, 18 will remain as 18. There will be no change in NAV. So this broad difference between the 3 plans. Now coming to performance. When you want to find out or evaluate mutual fund performance, we use the 3 ratios. Number 1, number 2, and number 3. First is Sharpe ratio, portfolio return RP minus RF upon sigma P. Trainer ratio RP minus RF upon beta P. Jensen's alpha, we have already seen in portfolio chapter. What is an alpha? Same one. Actual return of portfolio minus required return as per CAPM. If alpha is positive, it indicates fund manager has done a good job. He has selected stocks properly. He has bought and sold at the proper time. And overall, he has exhibited good fund management skills. So alpha positive is a big positive when you are going to evaluate mutual fund performance. These are ratios, remember. You can evaluate these based on this only by ranking them. Whereas Jensen's alpha can be evaluated by calculating alpha. and positive alpha means good fund performance. And here beta will be indirectly given to you in exam, either this way or sigma PM upon sigma square. So these are all the formulae you must learn in this chapter of mutual funds. Good number of problems are solved covering all the concepts what I have discussed just now, and that will prepare you totally for the exam. Now let us see the next chapter. Let us read this problem. A mutual fund made an issue of 20 lakh units of rupees 10 each at the beginning of the year. No entry load was charged. It made the following investments. So particulars and amount are given, and total investments is 1 crore 96 lakhs. During the year, dividends of rupees 24 lakhs were received on equity shares. Interest on all securities was received for a full year as on the valuation date. Equity shares have a value of rupees 180 per share as on valuation date, and unlisted debentures are to be valued at 85% of the invested value. Initial expenses were rupees 3 lakhs, which are fully charged to the scheme in the first year. Up to the end of the year, operational expenses incurred were rupees 4 lakhs, of which rupees 1.5 lakhs remains payable next year. Just before the year end, 60,000 units were redeemed when the NAV was rupees 12.5 NAV per unit, and an exit load of 1% was charged. Find the NAV per unit as on valuation date, which is at the end of the year. Very, very important problem. It involves so many things, in fact, and it involves the calculation of NAV, taking care of the exit load, taking care of the expenses, some are due, the liability is there, and ultimately you are required to calculate NAV at the end of the year. Let us see how we do this. We have to find the NAV. NAV is equal to market value of securities plus assets minus liability plus income minus expenses divided by outstanding units. Now we are given from this point to this point, let us say, let us represent this as 1 year. This is 1 year period, and all transactions which are going in or coming out, everything is given, and they are asking what is the NAV on this day. This is 10 rupees. They are asking what is the NAV on this date. Now all the inflows and outflows are taking in between the year. So what we can do, we can club everything under cash, and therefore that will come, we will adjust everything in cash. Suppose something is going out, we subtract under cash. Something coming in, add to cash. Why? Because it is happening during the year. Had it been happening on the last day of the year, then if it is inflow of the nature of income, so I will show in income or expenses like that. Since it is happening between the year, I will show under cash, that is under the branch of assets. So let us see one by one. Now market value of securities on the valuation date. Market value of securities on valuation date. First, equity shares. 1 lakh shares are there. 160 is a book value and they are telling you to value at 180. So 1 lakh shares into 180. So this is equity shares. Instead of 160, we are valuing at 180. Next, 8% government securities. See, they are given valuation of unlisted debentures at 85%. Remaining all on par. Even if it is not given, we cannot take an inflated value, neither a depleted value. We have to take the par value. So 8% government securities, 16 lakhs. Next, 11% unlisted debentures will be 85% into book value. Be 8,50,000. D, 10% listed debentures. So nothing is given. So we take at face value or whatever book value they have shown. That will be 10 lakhs. So when we add this 180 plus 16 plus 8.5 plus 10, so 214 50000. So this is your market value of securities. So we can say we are taken care of this. Now let us come to assets, cash. We have to first find out how much money mutual fund received, and of that received amount, how much they bought securities. So if there is are there any leftover, and that will be cash. So that is the first thing we have to find. So amount received in NFO will be 20 lakhs into 10. Now what you have actually bought out of this? You bought 1 crore 96 lakhs worth securities less securities bought. Then they are telling you to charge 3 lakhs initial expenses. So less initial expenses. So this will be your opening cash balance. So whatever money you collected and then disposed of or invested, etc., the leftover will be your opening cash. Now let us add one by one. Add dividends. Now they are given dividends 24 lakhs. Add 24 lakhs. Now government security 8%. So 8% on 16 lakhs. So interest, add interest on, or we can write coupon also. Interest on 8% government security. So 16 8 is 128, 1,28,000. Then next is 11% debentures. Interest on 11% unlisted debentures. 10 lakhs, so 1,10,000. Then 10% debentures. Interest on 10% debentures. That is 1 lakh. So when you add all this, so subtotal of cash one plus 1 2 328 338 438 2838. Now we have accounted for all dividend, opening cash, and all interest also. Now let us show expenses. Less operating expenses actually paid. Now it is given that 4 lakh is incurred, but only 2.5 lakh is paid. So 2,50,000. Eight. So 2838 minus 250, 2588. Now this what you have now. Everything has been done. Then redemption is taking place. Now redemption of 60,000 units at the rate of rupees 12.5 will reduce cash flow by 60,000 into 12.5 equal to 7,50,000. Now you are not giving 7,50,000. You are charging exit load 1% minus 1% exit load. It is recovered from investor. So 1% is 7,500. $742,500. Therefore, net cash balance after paying for redemption will be 25 88,000 minus 742,500. 1845,500. So this is your cash and everything accounted. And we know liability is 1,50,000. Therefore NAV. So let us substitute this. So liability is also calculated. Let us substitute NAV is equal to market value of securities 2 crore 14 lakh 50,000 plus assets. So we calculated here 18 lakh 45,500 minus liability 1 lakh 50,000. So no income and no expenses. Remember, if at all any inflow or outflow happens on the valuation date, that you show in income or expense. Otherwise club under cash. So this entire thing divided by 20 lakh units minus 60,000 units which are redeemed actually. So this comes to 11.9307 or 11.93 you can say. So you're getting 11.93 NAV. 11.93 is a correct answer. So you can see here also you have to write a lot, but fairly easy problem. If we are doing at a normal pace, reading each and everything, then it can be easily solved. Hope you understood this. Let us read this problem. A mutual fund raised rupees 150 lakhs on April 1, 2018 by issue of 15 lakh units at rupees 10 per unit. The fund invested in several capital market instruments to build a portfolio of rupees 140 lakhs. The initial expenses amounted to rupees 8 lakhs. During the month of April, the fund sold certain instruments costing rupees 44.75 lakhs for 47 lakhs and used the proceeds to purchase certain other securities for rupees 41.6 lakhs. The fund management expenses for the month amounted to rupees 6 lakhs, of which rupees 50,000 was in arrears. The fund earned dividends amounting to rupees 1.5 lakhs and it distributed 80% of the realized earnings. The market value of the portfolio on 30th April 2018 was rupees 147.85 lakhs. An investor subscribed to 1000 units on April 1 and disposed it off at closing NAV on 30th April. Determine the annual rate of earnings. Very good problem involving calculation of NAV and return. And it's an exam problem. I have modified the data numbers so that you can practice a different problem. Very important problem to see before the exam also. Let us see how we do it. The investor is investing at 10 rupees on 1/4. 30th 4 is disposing. So we don't know the NAV. So we have to calculate this NAV first. So the NAV calculated on 30th 4 and 1/4 NAV, that is 10. will give us monthly rate of earning, and we have to annualize, we will get annual rate of earning. So two concepts are involved: NAV calculation and rate of return calculation, but annualize. So NAV formula is market value of securities plus assets minus liabilities plus income minus expenses divided by outstanding number of units. Now I want to calculate NAV on 30th of April. So I want market value of securities on 30th of April, and that is given to us 147.85 lakhs. Now income and expenses that are incurred or done on 30th of April should be written. So they have not given anything which is done on 30th of April. So we just don't write these two. There is some 50,000 fund management expenses unpaid as arrears. So this will be your liability. And rest all we will club in assets in the form of closing cash. So they have given money collected. So we start from there, and how it is used, we just draw it till 30th of April. We come to closing cash, and that we substitute here. So market value of securities we substitute here, closing cash we substitute here, and liability we substitute here, and number of unit is given, so we substitute here. So we get the NAV. Once we substitute NAV here, we get return for this period, and we annualize for that investor and get the answer. So let us begin with the money collected and then fill up everything that is getting adjusted from that money and arrive at the closing money on hand, that is closing cash, or what we can fill it up for assets. So money collected is 150 lakhs. This was on 1st of April. Fund invested 140 lakhs and initial expenses 8 lakhs. So less initial expenses less securities bought. Funds sold, instruments costing 44.75 lakh for 47 lakh. So 44.75 is not relevant. We received 47 lakhs. So add money received on sale. And securities were bought for 41.6 less securities bought. Now fund management expenses were 6 lakhs, of which 50,000 arrears. So only 5.5 lakhs you spent, less fund management expenses. Fund earned dividend of 1.5, add dividend received. it distributed 80% of realized earnings. SEBI says that a fund can distribute dividend only out of realized earning. Now there are two realized earning. In the beginning it is given securities were sold for 47 lakh, but they were costing only 44.75 lakhs. So let us calculate realized earnings. Securities. So 47.00 minus 44.75, 25, 2.25 lakhs. And it also received dividend of 1.5 lakhs. So 3.75 is realized earnings. So total realized earning is 3.75. And it is given that it distributed 80% of realized earnings. So 80% of realized earnings is 3.75 into 80%, that is 3. So we can say less dividend paid. So this is your closing cash or our asset. And liability is 0.5, we know that. So therefore NAV market value of security is 147.85 plus 0.4 minus 0.5 divided by 15 lakhs. So 147.85 plus 0.4 minus 0.5, 147.75 divided by 15. 147.75 divided by 15 lakhs is equal to rupees 9.85. So we have calculated this as 9.85. Now investor bought 1000 units at 10. Investor sold 1000 units at 9.85. Now he received some dividend. Let us calculate that. Total, now he invested 1000. On 1000 unit, how much dividend he received? So we have to find dividend per unit. Now total dividend is rupees 3 lakhs. Units, total units is 15 lakhs. Therefore dividend per unit is 3 lakhs divided by 15 lakhs. That is 0.2. So therefore annualized rate of earning is equal to NAV end minus NAV beginning, that is 9.85 minus 10 plus dividend upon NAV beginning into 12 upon 1. Why 1? Only 1 month, April. We had annualized, therefore 12 upon 1. Since we want the answer in percentage, into 100 is equal to 9.85 minus 10 plus 0.2 upon 10. 12 upon 1 into 100. %6. So we get the answer as 6%. So this was a very simple problem. Only thing is we have to write down all the given information carefully, one below the other. This problem is a very good problem, likely to be repeated, and two concepts are asked in a single problem: NAV calculation as well as rate of return. Hope you understood this. Let us read this problem. Ashok invested in two funds named X and Y. Find A and B from the following data. Now when you see the table, they are given annual return. They are asking investment date in the case of fund X, and they are asking number of days of investment in the case of fund B. So generally when we calculate returns, we need the beginning investment date, we need the redemption date, and we use them to calculate number of days. So here, instead of asking return, they have provided return, and they are asking investment date and number of days. So reverse calculation, very important problem. And if you would have seen November 2020 question paper, every question virtually was a reverse problem only, all reverse calculation. Reverse calculations consume time, and one could easily see how the entire paper was set in the reverse manner. Reverse manner means all the questions, reverse calculations were involved. Let us see how to do this problem. This involves simple calculation of annualized return, and where one of the entry is number of days. So what is the formula? Annualized yield in percentage is equal to NAV end minus NAV beginning plus dividend upon NAV beginning into 365 upon D into 100. Now annualized yield is given for both the funds. NAV end is given for both the funds. NAV beginning is given. Dividend is given in consolidated form, total amount. So we have to find the number of units and then calculate dividend per unit and then substitute. So this is your dividend per unit. Now this is not given. Now what is this actually? It is D is equal to redemption date minus investment date plus 1. Why plus 1? Usually we exclude one of the dates in the calculation. So here we should include both the dates, because when I am investing in mutual fund and when I am getting the NAV, in that day my investment is on. Similarly, when I am redeeming, I am getting the NAV of that date. So that day, on the day of redemption also, I am the unit holder. So we have to take both the dates. Therefore, when you subtract, 1 days get reduced. So we have to, for example, very simple. I can give an example. Let us take 27th April 2019 to 30th April 2019. So it is 27, 28, 29, 30, 4 days. But when I do 30 minus 27, I get 3. When I do 30 minus 27, I get 3. But actually they are 4 days. I should include both 27 and both 30. So therefore we do plus 1. Okay. So that's the reason I do this. Now they are given fund X and fund Y. So let us substitute. Fund X, let us calculate number of units because I want dividend per unit. So number of units is equal to amount invested divided by NAV beginning. So this will be rupees 2 lakhs, rupees 10.30. So this will give 2 lakh divided by 10.3, 19,417.476. You have to remember that units always take three decimals. NAV 4 decimals. Value 2 decimals. In the chapter of mutual funds. So we got number of units, therefore dividend per unit equal to rupees 6,000 divided by 19,417.476. So this will give 6,000 divided by 19,417.0.309. So we take 3 decimals since NAV or number of units you can take. Even if if you take 4 decimal also it is same. So substituting we get, therefore 9.66 is equal to 10.25 minus 10.3 plus 0.309 divided by 10.3 into 365 by D into 100. When you actually calculate, you get D equal to 95 days. So D is this. So 95 equal to redemption date minus investment date plus 1. So 96 is equal to minus this. Our investment date equal to 30/11/19 minus 96. So what you should do is you should actually do backward calculation of 96. So this is 30/11. So November 30 days, October 31 days, September 30 days. So this is the 91 day. Now this is August 31st, August 30th, 2 days, 29th, 28th. So we can see that this is 1, So we want actually 95 days. So this will be 91. This is 1, 2, 3, 4. So we are getting 28 days, 28th of August. So when you actually do by this method, you have to be careful. I would prefer this method. Now this minus 96, you should not get confused. See, entire November including 30, it is 30 days. Entire October including both the days, it is 31 days. So this comes to 91. Then I need 4 more days. So this is a better way to calculate. So therefore investment date. Now this need not be shown. This need not be shown in the exam. This also need not be shown. But I would request you to show this. This is important. So you can actually calculate and ensure. Therefore investment date is 28th of August 2019. So 28, 29, 30, 31, 4 days. And then remaining 91 days. So 95 days. So invested on 28th of August 2019. Now let us do for fund Y, where they are asking only number of days. So there is no question of calculating this. Oh, sorry, this is one. Here it is 94. 95 minus 1, 94. So we are getting 30, 11, 19 minus 94 days. So here this 30th November you should include. So you may get confused. So follow this method only. So let us do for fund Y and let us do investment date also, so that we have a practice. Now in case of investment Y, number of units will be amount invested upon NAV beginning. Is equal to rupees 2 lakhs divided by NAV beginning is 10.0089 is equal to 19982.216. So dividend per unit rupees 5000 divided by 19982.216. 5000 divided by 19982.216. 0.250. 2502 can take. So therefore 24.02 is equal to 10.2 minus 10.0089 plus 0.2502 divided by 10.0089 into 365 by D into 100. Therefore D equal to we get 67 days. Let me do once again. $66.9988 something, we get 67 days. So now investment date. So better we calculate. So 30th November. Now this is the required answer, 67 days. But let us calculate investment date for this, 30th November. So entire November 30 days. We want 67. Entire October 31 days. So total 61. So another 6 days I want. So this is 30th of September, 29th of September, 28th, 27th, 26th. You can see you are taken till now 1, 2, 3, 4, 5. Sorry, we want one more day, 25. That is 6. So this is 6 days. So 6 plus 31 plus 30, 67. So investment date is 25/9/19. So this is how we calculate the investment date in days. Is very important. It's a simple problem, or I will use the word simple looking complex problem. If you are in a great hurry, you are most likely to get this wrong. So better you practice and reduce the speed, then the task becomes easy. Hope you understood this. Let us read this problem. An investor invested in a fund a sum of rupees 5 lakhs at an NFO price of rupees 10 per unit on 1/1/2016. On 31/8/2016, the fund distributed a dividend of rupees 2 per unit, and the fund provided an annualized return of 15% as on that date. The fund further distributed rupees 3 per unit on 31/12/2017, and the investor redeemed all his outstanding units of 76,388.889 on 31st December 2019. As on 31st December 2019, the fund had provided an annualized return of around 20% per annum. Calculate the NAV as on 31st of August 2016, 31st of December 2017, and 31st of December 2019. Institute's most favorite problem. It involves concept of dividend reinvestment plan, that is allotting units out of dividend, and finally calculating the return. And the main question is to find out the NAV. Somewhat a backward or reverse calculation. Let us see how we solve this. Let us first write the data. Date, amount, they are given NAV, and units, because we require that units column. Whatever dividend is given per unit and whatever return is given. So we project the given information in this way so as to understand easily. So 1/1/16 You are investing 5 lakhs at NAV of 10. So how many units you would have got? 50,000. Then some days are passing. Then on 31/8/2016, they are asking what is this A. So I will write here units. We have to write the units because here additional units will be given. How you know that additional units will be given out of dividend? How you know that this is the problem of dividend reinvestment plan? Remember, dividend plan and dividend reinvestment plan are two plans involving dividend. If it is a dividend plan, then the dividend declared would be distributed in cash to the shareholder, or in this case unit holder. In dividend reinvestment plan, the dividend distributed would be taken back and units will be issued. The very fact that initial units 50,000 has become 76,388.889. The very fact that units have increased means when dividends were declared, further units were given. Therefore, it is a dividend reinvestment plan. Now, we don't know this, but they are not asking that. But it is part of the calculation. Dividend 2 was declared and 15% return. Then next is 31/12/2017. Again, they are asking what is the dividend, what is the NAV, and this also we are supposed to find. And dividend distributed is 3. And finally, on 31/12/2019, again they are asking what is the NAV for these units. And now here they are given 20%. Remember, 20% per annum. Annualized return means every year 20%, like this. Suppose here I am getting X. So this is 1.2x. So money has increased by 20%. Next year 1.44x. And next year 1.44 into 1.2, 1.68, 1.44 into 1.2, 1.728x. So this is annualized return. 20% first year, then again 20%, and again 20, like that. This is what this 20% means. So annualized return every year. So in the semester answer, they are given approximate way of calculation because scientific calculators cannot be provided in the exam. Logarithm tables cannot be provided in the exam. So therefore, they are accepting this approximate version of calculation, but that is not perfect. Anyway, let us do this in the last. So we have to find the two yellow shaded region and A, B, C. That is the problem. Now this period is only 8 months. And we know how to calculate return for 8 months. Now annualize return. What is the formula? NAV end minus NAV beginning plus dividend upon NAV beginning into annualize 12 upon months. So let us call it as M number of months into 100. So NAV end is they are asking. So A minus 10 plus 2 rupees upon 10 into 12 upon 8. 1st January to 31st August, 8 months into 100. This is 15. So solving, we'll get A is equal to rupees 9. So this is your rupees 9. Now we have to calculate B. Now this 9 rupee is the NAV. So how much units were given? So dividend distributed will be 50,000 units into rupees 2 equal to 1 lakh. So fresh units issued will be rupees 1 lakh divided by rupees 9, because that is the ex-dividend NAV. So this will be 1111.111. So we add this, therefore total units is equal to 50,000. Let me just verify this calculation. One more one will come. Yes, one more one. 1111.111.6111 point. So this will be units 3 decimals. NAV preferably 4 decimal. In real life, in practical world, NAV is 4 decimal. So let us write that units 3 decimals, NAV 4 decimals, value 2 decimals. So we got the units. Now 3 rupees is declared. Now let us see this here now. 3 rupees is declared on this many units. So 61,111.111 into 3 will be the total amount declared. Now divided by B will give you units allotted when second dividend was declared. Now you can see that after 3 rupees there is no further dividend and our final units are given. Now these final units are given. Now between these two only this dividend is there. So we can say the difference in units is nothing but units that have been allotted when rupee 3 dividend was declared. I repeat, on 31/8/2016, this was the number of units. In the end, this was the number of units. So the difference of units, how it is arising? It is arising out of this 3 rupee declaration on 61,111.111 units. So we can write like this. So 76,388.889 minus 61,111.111. That this difference is coming out of rupees 3 into 61,111 divided by B. So the difference in units have arisen out of how much? 3 rupees declared on the previous units divided by the second NAV. So solving B will be equal to 76388.889 we are getting 12 rupees. So we get B is equal to 12 rupees. Now this is a crux main part. Then come to C. Now what is C? C is the NAV on 31/12/2019. And here again they are given return. So we can use a return formula. But what is the period here? This period to this period is entire year of 16, 17, 18 and 19, 4 years. Now it is given annualized. So remember, having worked in the mutual fund industry and reported figures regularly to SEBI, annualized rate means that rate which has been provided every year on the beginning year NAV. Suppose this is 10 rupees. So this has increased by 20%. Again it has increased by 20%. Again it has increased by 20%. And finally increased by 20%. And we have this C. So this is how we calculate. Now here I have used 4 years, exact 4 years, 1, 2, 3 and 4. Now when I am not going to give my students log table or scientific calculator, I am not supposed to use any year other than 4, 8, etc. Wherein they are supposed to use some approximate method. That will actually inculcate the wrong calculation method when they go into the real world. So I have taken exact 4 years. So we will use this formula. Amount is equal to principal into 1 plus R raised to 4. Now exact 4 years, so therefore 4 amount, how much you invested? You invested 5 lakhs is equal to, invested 5 lakhs. One plus 20% raised to 4. And this side 76,388.889 into C. C is the NAV which you will get when you redeem this 76,000 odd units. So when you solve this, now 1.2 raised to 4 can be taken. But if it is 1.2 raised to 3.75, then you need scientific calculator. So we do this. $13.57. So we're getting 13.57. So this means your 10 rupee which you invested has grown to 13.57. Remember the 2 rupees that has been reinvested, 3 rupees that has been reinvested. So when you just roughly add 2 plus 3, 5, and here 3.57, so 8.57. So 10 has become 18.57, 20% approx. It works. So back of the envelope calculation you can do in the mind if at all you want. Otherwise, if you follow proper method, it should never backfire. So if it is 3.75 year and all, I don't subscribe to that calculation which is shown in this answer. So you can actually follow that method because it has been repeated 4 times in the exam, and all the 4 times students have got mark, but never follow in real life. Hope you understood this. Let us read this problem. A mutual fund company introduces a dividend plan scheme. Mr. R invested rupees 5 lakh in dividend plan on 1/4/2014 when the NAV of dividend plan was rupees 46. The plan matured on 31st March 2019. The particulars of dividend declared for the period are as follows. So 3 times dividends were declared. On 31st March 2019, the investor redeemed all the balance units. Consider the following. Ignore short-term, long-term capital gain tax. STT 0.2% applicable on redemption of units. Ignore education cess. What will the average yield per annum within bracket annual rate of return for the investor will be? Work in 2 decimal points. So this very important problem. You will be surprised to know that out of last 4 attempts, if I am correct, they have asked this 3 times. So we can say it's the recent trend problem. Okay, so let us see how we do this. We first find out what is the amount invested. Amount invested is rupees 5 lakhs. At what rate he invested? So NAV was rupees 46. So how many units he would have got? So we have to work in 2 decimals. So 5 lakh divided by 46 will give you 10869.57 units. So this investor would have got, Mr. R would have got 10,869.57 units. Now dividend plan means whenever dividend is declared, there will be change in units. Now here in dividend plan there are 2 types. One where the dividend is given away in cash to the investor. The second where dividend is reinvested at the NAV after payment of dividend. Now in this case, it is given it is not directly evident that it is dividend reinvestment plan, but it is a problem of dividend reinvestment plan because it is given that investor redeemed all the balance units. Now institute could have specified that it is a dividend reinvestment plan. Nevertheless, now this problem has come in May 2019 and November 2019 also. So we will be issuing units after applying dividend on the original units. So let us see how we go about. Now on 31/12, first we write down date. Units. Dividend. Amount of dividend. This is dividend in percentage. Amount of dividend. NAV. Additional units. Total units. I am making some additional columns to just ensure seamless calculation purpose. I'll explain to you. In disaster answer, you will not find so many columns, but this becomes very easy. Now, first dividend is 31/12/2014. So let us write 31/12/2014. Now this is before dividend. So you can write here remarks. Before dividend, the unit was 10869.57. Now the dividend is given 10869.57. 12% dividend is given. So 12% on 10869.57, face value is 10 rupees. 12% means 1.2. So 10869.57 into 1.2. This will be 13 0. This is rupees 043.48. So this one dividend is due to Mr. R. What is the NAV that day? NAV is given as 47. So this is again rupees. So what is the additional units? So 13043.48 divided by 47. So 277.52 units will be given. You add this to the existing unit of 10869.57. This will be 11147.09. Now this becomes the starting for the next one. And the next dividend is 31/3/2016. And 15% means 1 rupee 50 paisa. So 11147.09 into 1 rupee 50 paisa. 16720.64. And the NAV that day is 49.5. $337.79. Just check this once more. Correct. Now this we add to the previous balance one 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 484.88 111 sorry 11 484.88. So this will be for the next one 31 3 2018. One one 484.88 10%. That is 1 rupee. So 11484.88. NAV given is 48. So divided by 48, 239.27. So we add to the previous balance 239.27 plus 11484.88 11724.15. So this is the number of units after the declaration of the third dividend. Now all these units are getting redeemed on 31/3. Therefore, balance units on 31/3/2019, the day of redemption, is equal to 11724.15. What is the NAV on this day? NAV on 31/3/2019 is 49. Therefore, redemption proceeds 11724.15 into rupees 49 will give 574,483.35. Now these are redemption proceeds. You have to pay STT on this less 0.2% STT $1148.97. This will leave 573,334.38. Yeah. Now we don't have capital gains, long term or short term. If short term was there, then possibly the last units, this additional units which are given, and 48 rupees it is given. Okay, so we would be applying, but it is not given. It is told to be ignored. So therefore, total gain from 1414 to 31,319. So you have to subtract the 5 lakh what you invested. You get 73,334.38. Now this is the total gain over 5 years. What is the question? Question is calculate average yield per annum. So therefore 5-year yield. So therefore 5-year yield in percentage will be 73,334.38 upon rupees 5 lakhs into 100. 73,334.38 divided by 5 lakh. 14.67%. Therefore, average yield per annum will be 2.93%. Remember, this is not the compounded yield. It just calculates simple average. I earned 73,000. So per year I earned 14,000, like that. A simple average. If it was compounded, then we will be using compound interest formula. I'll just give you here, but you are not asking this in the exam, because sometime when the period is not a round figure, you require a scientific calculator. Okay, if it was compounded yield per annum, then I would be written amount equal to principal into 1 plus r raised to t. So I would have written amount 573,334.38 equal to principal 5 lakh 1 plus r raised to 5. So I would have solved this. Now to solve this, either we need a PV table or we need a scientific calculator. So therefore, this is not asked in the exam. So therefore our answer is 2.93%. Very simple but quite lengthy calculation. You have to be very careful when you put up the answer. Hope you understood this. Let us see this problem. During a particular year, an investor invested in a mutual fund. The capital gain and dividend for the year was rupees 3 per unit, which were reinvested at the year-end NAV of rupees 23.75. The investor had total units of 26,750 as at the end of the year. The NAV had appreciated by 18.75% during the year, and there was an entry load of 0.05, that is 5 paisa, at the time when the investment was made. The investor lost his records. You are required to calculate the amount of investment made by him. So another reverse calculation problem which involves dividend reinvestment now. So here we use the concept of reinvestment of dividend, and using the information we calculate. Let us see how we do it. Now this is a problem which involves dividend reinvestment plan of mutual fund. Let us understand the basic of this. Assume that 1/1/2020 the situation is there are two plans. A is a dividend plan, B dividend reinvestment plan. One 2020 you are investing 1,000 rupees in both funds. So this is your investment. NAV that day was 10. Therefore, units 100. Some years pass, or 2 years pass. So on, say, let us keep this in line with the modern trend. 1/1/20 dividend is declared. Dividend of 10% declared. So when dividend of 10% declared, 10% of 10 face value, so you have received, so this is the dividend. So dividend received will be ₹1 into 100 equal to ₹100. Now on reinvestment plan, there will be accrual ₹1 into 100 equal to ₹100. Now assume that on this day the NAV is, say, 15. So this is the NAV. Now after declaring dividend of 1, what will be post dividend NAV? It will be 14, and here also it will be 14. So after declaring dividend, NAV will reduce by the amount of dividend paid per unit. So here reinvested units issue, so nothing will be given, but here this 100 rupees will be issued units for 14. So 100 divided by 14, 7.143. So 7.143 units will be issued. So total units will be 100. Here it will be 107.143. So you can see that in dividend plan, dividend is declared and given away. In dividend reinvestment plan, dividend is declared, money is accrued, and units are allotted at post or ex dividend NAV. So the number of units increases. Now let us see this problem. So here it is given that investor had total 26750 units at the end of the year. So today the number of units are not given, but at the end of 1 year it is 26750. Now it is given that capital gain and dividend for the year was 3 per unit, which were reinvested at year-end NAV of 2375. So NAV is 23.75 and dividend and capital gain of 3 per unit were given. So let us assume X as the beginning year units. So we have X units. I'll write below X units. So now on X units you will be given 3 per unit. So you will get 3X. So you had X units in the beginning. You are given 3 rupee per unit. So how much money you got? You got 3X. And the year-end NAV was 23.75. So you got these many additional units. Originally you had X units. On that original unit, you got 3 rupee, 3x. They were reinvested at 23.75. Therefore, 3x upon 23.75. Now, total units is given equal to 26750. So, this is given. So, solving, we get x equal to, so 26.75x. We get 23750. So this we have calculated as 23750. So investor had invested bought 23,750 units at the beginning of the year. Now the question is, what is the amount of investment he made? Okay, he bought this many units. So therefore we can write units bought. At the year beginning equal to 23750. At what price he bought? So what is the NAV? We don't know, but there is some hint given. NAV, let us call it as Y, and this NAV appreciated by 18.75%. So Y became 1.1875Y, and this 1.1875Y is equal to 23.75, because year-end NAV is 23.75 given. So we can find that let Y be year beginning NAV. Therefore, Y into 1 plus 18.75% is equal to 23.75. Therefore, Y equal to 20. So we got Y as 20. So he invested at 20. But entry load is equal to 5 paisa. Therefore, investment made at NAV beginning plus entry load is equal to 20 plus 0.05 equal to 20.05. So how many units he bought? 23,750. At what price he invested? 20.05. Therefore, investment made by investor at the beginning of the year is equal to 23750 into 20.05. 20.05 into 23750. 476 18750. So that is a correct answer for this problem. So simple problem on mutual fund chapter. You must understand the concept of reinvestment. To summarize, I'll tell you, once the dividend is declared, based on the number of units, dividend will accrue, but it will not be taken away by investor. Investor will give back that to mutual fund, and mutual fund will reissue units based on X dividend NAV, and the number of units under reinvestment plan will increase. So this concept is tested in this problem. Better to go through the basic part first and then solve. Hope you understood this. Let us see this problem. This was asked in November 2020. A simple looking, very lengthy problem, and involves reverse calculation. This involves dividend plan and bonus plan of mutual funds. Let us read this. Corpus and AMC on 1/4/2015 has floated two schemes, dividend plan, bonus plan. Mr. X, an investor, invested in both the schemes. Details except the issue price are available. So the issue price was not given. So two plans were there. So the details are all given. Additional details: investment 9,20,000 and 10 lakhs. Average profit 27,74,860. Now this was given in the first column, that was pertaining to dividend, and the second column pertained to bonus. So what I am trying to say is this particular column, so this is your dividend column and this is your bonus column. So they have given investment in dividend plan, they have given average profit of dividend plan, they have given investment in bonus plan and average yield of bonus plan. Now you can see very carefully, they have given average yield percentage for bonus, but they have given average return, average profit in value terms for dividend. You are required to calculate the issue price of both the schemes as on 1/4/2015. So you want to calculate the issue price. At what price Mr. X invested in both. So you have to work backwards. Very lengthy problem, and it is a challenge for any student to complete this successfully in the exam. Let us see how we do this. This was problem asked in November 2020 exam. Question 3B for 10 marks. I am giving you written guarantee. Whoever would have attempted this problem would have consumed a lot of time, unless they would have practiced this reverse calculation problem at least 3 times in the exam, before the exam. So nobody would have expected a reverse calculation problem in dividend and bonus plan. Though institute has already asked this kind of problem 3 times, but they were straightforward calculation. Here you are given entire information and you are asked to find the issue price. Means usually issue price is given and you are supposed to calculate return. In this problem they have given return and you have to work all the way backwards, all the way from back to front, and find the issue price. Let us see how much time consuming is this. Concept wise it is fairly easy, but you must know how to calculate in the reverse manner. And they had deliberately given for dividend plan, they gave absolute amount of rupees, as returns. For bonus plan, they give percentage return. So there also twist. All in all, the entire November 2020 problem was a big twist. A student, you would hardly find a student who would not have fallen in one of the traps, which is suppose. Let us do the problem. Let us first check dividend plan. Let us read the information first. Just a minute. What is the investment given? 9,20,000. Just see how we are working. You can copy, as I'm sure you would have copied all the problems, solutions wherever it was required. This being asked for the first time, you may prefer to copy it and revise it before the exam. Investment was 9,20,000. And what is the investment period? Investment period 1/4/2015 to 31/3/2020. That is 5 years. And what is the average profit given? Average profit is given as 27. See the odd numbers always give round answer. This is what I have learned in my school days. Even now I'm seeing odd numbers means you are going to get some round answer. So your average profit over 5 years is this. So what is the total profit over 5 years? Therefore total profit over 5 years 2774,860 into 5. So that is what 2774,860 into 5 is 0.60, sorry. $27,748.60 it is. 27,748.60 into 5. That comes to 1,38,743. I request you to correct this. So 1,38,743 is a total profit over 5 years. Now, so what is the total investment proceeds? So therefore total investment proceeds will be original investment plus total profit. Is it not? Now remember, we are working backwards. We got the average profit, we calculated the period, multiplied the period with average profit, we got total profit. How much money you invested? 9,20,000. Total profit 138,743. So how much money you got at the end of 5th year? And that's what you're going to get here. 9,20,000 plus 138,743. So you got this much amount at the end of 5th year. Now they have given NAV on 31st of March. So this amount, total investment proceeds. So this you got on 31st March 2020. So NAV on 31st March 2020 is equal to rupees 49. That is given to us. Therefore, how many units you would have been holding that day? NAV was 49, amount is this much. Therefore, units redeemed on 31st March 2020 would be 1058 743 divided by 49. You get the number of units. Two 1607. So you redeemed 21607 on 31st of March 2020. So you can see now we have to work backwards. 31st March, then 31st March 2019, then 2018, then 17, then reach 1/4/2015. So such a long journey actually. So we got this much. Now let us do backward calculation now. Now this was the total units. So you can see previous dividend was on 31st March 2019. So how it would happen? You would have held some units, some dividend would have been given, that would have got converted into units, and total unit would be this. So units prior to dividend on 31/3/2019 plus units allotted on 31/3/19 will be equal to 21607. Okay, so this is what, so we have to work backwards. Now let us see what is the dividend given. It is given 15% on face value. Let us take it as X units. So he was holding X units. So X plus 15% of rupees 10 on X units. So this much dividend he would have got. He was holding X units prior to dividend on 31st March 19. So on this he got 15% dividend. But he didn't take dividend. He reinvested at NAV. Now what is the NAV given? 31st March 19 NAV is 45. So divided by 45 should be 21606. So let us take this. So X, now 15% on 10 is 1.5x. Therefore X equal to 1.5 divided by 45. At 20910. X equal to 20910. So we are getting X equal to 20910. Now like that we have to go previous. What is the previous dividend? 31st March 18. So previous dividend was on 31st March 18. So again we have to apply the same formula. Units prior to dividend on 31st March 18 plus units allotted on 31st March 18 will be equal to 20910. Now let us assume this as y plus, what is the dividend? 10% dividend. So 10% of rupees 10 into y divided by, what is the NAV? 50 will be 20910. So y plus 20910, therefore y equal to 51. So 120,910 into 50 divided by 51, 20,500. So we get 20,500, that is units held prior to dividend on 31st March 18. Now we have to go one more step to 2017. So previous dividend was on 31st March 17. Again we use the same formula. Units prior to dividend on 31st March 17 plus units allotted on 31st March 17 will be 20,500. Let this be said plus units allotted, how much? 12% dividend. So 12% of rupees 10 into Z, and it has been allotted at 48 equal to 20500. Therefore Z plus this will be 1 minute, 10%, this is 1, sorry, this is 1. You have to make a change here. It's not 0.1y, it is y. I recalculated here, we are getting 1.2 Z upon 48 equal to 20,500. So when you do this, we get, therefore Z equal to is 49.2, 48 into 20,500 divided by 49.2, 20,000 round. Therefore units held on 31st March 17 prior to dividend is equal to 20,000. Now before this there was no dividend given at all, so therefore this was the original units bought. Since no dividends were given prior to 31st March 17, the original units subscribed is also 20,000. Now what is the investment you have made? Investment is 9,20,000. Original investment equal to 9,20,000. Units bought 20,000. Therefore, issue price 9,20,000 divided by 20,000 is half, that is 46. So this was your first answer. So dividend plan issue price is rupees 46. Bonus is slightly easy, or I can say short, because we are dealing with whole numbers. So let us do now bonus plan. Again, we have to follow the same method, but here they are given average return, not average profit. So let us again write the first one, investment. Investment 10 lakhs. Period. Again it is same, 5 years. Average yield 6.4%. Now this is average yield, means over 5 years. So what is total yield? Total yield is equal to 6.4% into 5, 32%. So what is the total investment proceeds on 31st March 20? So to add 32% to 10 lakhs. 10 lakh plus 32%. Correct? No, 13,20,000, sorry. So this was the total investment proceeds, 13,20,000. What was the NAV of bonus plan on 31st March? 44. NAV on 31st March 20, 44. Therefore, units redeemed. So come to 30,000. So units redeemed were 30,000. Now we should look for all bonuses. So there are two bonuses given. So previous bonus date of 31/12/18, and what is the bonus ratio? 1:5. Bonus ratio 1:5. How we read this? 1 for every 5. 1 for every 5. So we can say this: units prior to bonus on 31st December 18 plus bonus will give you 30,000. So let it be X plus. There will be 1 for every 5. So 1 upon 5 X will be 30,000. Therefore, X will be 25,000. That is 1 plus 1/5 is 6/5. So 5/6 of 30,000 is 25,000. So 25,000 units he was holding prior to bonus. Now, what is the bonus date before this? 31st December 16. So previous bonus date 31st December 16. Bonus ratio is given 1:4. 1 for every 4. Therefore, we can write x plus 1 for every 4x should be 25,000. Therefore, x equal to, so 25 for the 1, 20,000. So we're getting 20,000. Now, there is no bonus before this date. Since no bonus prior to this, original units is also 20,000. Now investment is 10 lakhs. Therefore, issue price is equal to 10 lakhs divided by 20,000, that is rupees 50. So this is our issue price for bonus plan. So 46 is the issue price for dividend plan and 50 is the issue price for bonus plan. Another drawback of this problem is you have to write a lot and you can't skip any step because there should be logical continuity. The person reading should understand what you have done. Okay, all in all, a very lengthy problem. Reverse calculation problems are always lengthy. Why? Because we generally solve straightforward problem. We never work backwards. It's like, you try to walk backwards. Okay, it's difficult and it consumes time. Same logic holds here. I feel, according to me, this problem won't be coming so frequently. But whenever institute wants to make the paper lengthy, then they will always select reverse calculation problems. Hope you have understood the concept. Let us read this problem. The following are the data on 5 created portfolios W, X, Y, Z, P, and information on T-bill is also given. Which fund is the best in terms of Sharpe ratio, Trainer ratio, and Jensen's alpha? Very simple problem on evaluating performance of mutual funds. Let us see how we do this problem. The first is Sharpe ratio. Sharpe ratio is given by portfolio return minus risk-free return upon standard deviation of portfolio. Trainer ratio is given portfolio return minus risk-free return, beta of the portfolio, and Jensen's alpha is given by portfolio return minus expected return of portfolio as per CAPM. This is nothing but portfolio return minus RF plus beta portfolio into RM minus RF. And we are asked to judge which fund is the best in terms of all the 3 measures. We must know that higher the ratio, better is the performance. For Sharp, Trainer and Jensen's Alpha means higher the Sharp ratio, better is the fund. Higher the Trainer ratio, better is the fund. Higher the Jensen's Alpha, better is the fund. So we have to find out which fund is ranked highest under each of the three categories or under each of the measures. So therefore we have to find for fund W, X, Y, Z and P which fund ranks highest or the best under Sharp measure, then Trainer measure and then Jensen's Alpha, and then we can make a decision. Now before we proceed, portfolio return is given. So I have portfolio return. Wherever I have portfolio return, I can actually have it. You can see here. So portfolio return is given. Risk-free return, not T-bill, is a proxy for risk-free return. T-bill return is given. So T-bill return is also known. So wherever we have RF, that is known. Standard deviation. So standard deviation is also known. Beta is also known. Now only one entry is not given. Market return is not given. Now we can't write, we don't know market return. We can't write that. So here the question is testing your knowledge about market beta. What is beta of market? Beta of market is 1. Which of the funds in the table W, X, Y, Z and P has beta of 1? Fund P has beta of 1. So how much return it is giving? It is giving a return of 10%. Therefore indirectly it is given in the question that market return is 10%. So we have to write that. So the first two statements of the solution should be T-bills are proxy for risk-free rate. Therefore RF equal to 5%. Then second you should write market's beta is 1.0. We are not provided with market return, but we have a fund P whose beta is equal to 1. Therefore we can assume market return RM to be same as equal to return of fund P is equal to 10%. Therefore RM is equal to 10%. Now these two statements are very essential before you actually calculate. So after writing these two statements and 1, 2 and 3 formulae, we can show the calculations. So we write funds or fund return Then we write RF. Then we write sigma P. This is return of portfolio. Then we write Sharpe ratio. Then we write rank. Then we write beta P. Then we write trainer ratio. Then we write rank. Then we write expected return as per CAPM, because that is required for alpha. Then we write Jensen's alpha. And we write rank. Now in the exam, it is a challenge to show so many columns in that narrow sheet. So what you can do is, you can actually put this in the first part, and in the second part, just below this, you can write down for explanation purpose. And having that advantage of wide screen, I am able to actually show you in one thing. But in the exam, you should do in case they are asking all the three, never cramp your work in that narrow sheet. Show one below the other. So let us write down the names of the fund: W, X, Y, Z, and P. P is also a portfolio constructed, created. See, 5 created portfolios. Return 15, 12, 16, 7, and 10. RF we have seen already, written 5. Standard deviation percentage given 7, 10, 5, 6, and 20. Sharpe ratio RP minus RF upon sigma P. So 15 minus 5, 10 upon 7, 1.429. 12 minus 5, 7 upon 10, 0.7. 16 minus 5, 11 upon 5, 2.2. 7 minus 5, 2 upon 6, 0.33. 10 minus 5, 5 upon 4, 1/4, 0.25. So we can see the rank now. The highest rank, highest value of Sharpe ratio will be given rank 1. And the next one is this, then 3, then 4, then 5. So as per Sharpe ratio, fund Y as a highest rank. Now you have to be very careful. I hope you know rank 1 means best. I remember one student doing exactly opposite in the exam. So you have to be very careful. So highest Sharpe ratio should be given rank 1. Now beta of the portfolio 1.25, 0.875, 1.375, 0.5, and 1. Now trainer ratio is RP minus RF, 15 minus 5, 10, 10 upon 1.25, 8. Then 12 minus 5, 7, 7 upon 0.875, 8. 16 minus 5, 11, 11 upon 1.375, 8. Then 7 minus 5, 2, 2 upon 0.5, that's 20 upon 5, 4. Then last 10 minus 5, 5, 5 upon 1, that is 5. So you can see we are having multiple highest value. So we have to give all of them rank 1. So 3 ranks is already gone, and then we give 4th rank and 5th rank. So there will be no 2nd and 3rd rank. So based on trainer ratio, W, X and Y, all 3 are good. But based on Sharpe, we find that only Y is good, the best, sorry, Y is the best. So as of now, we would vote for Y. Now let us see what does alpha indicates Jensen's alpha. Let us calculate expected return of the portfolio. Now expected return is risk-free rate plus beta into RM minus RF. So expected return is equal to, so this you can put a star here and write, though you have written the formula, it is better to write this again, plus beta of the portfolio into RM minus RF. Now this will be always 5 plus beta of portfolio 10 minus 5. Please understand why I am writing this, you will know, it will help you in calculation. So 5 plus 2 into beta P. So when you do the calculation, so you have to just do 5 plus 2 into beta. Now 1.25 into 2. Okay, that is 2.5. So this is 7.5. Next, 0.875 into 2. So 0.875 into 2 plus 5. So this is 6.75. Next, 1.375 into 2 plus 5, 7.75. Next, 0.5 into 2, that is 1 plus 5, 6. Next, 5 plus 2 is 7. Now what is alpha? Alpha is portfolio return minus expected return of portfolio. Let me just verify this once again. Beta of the portfolio into RM minus RF. So 10 minus 5 is 5. So 5 into beta. So we'll just change that. So 5 into 1.25 into 5 plus 5, 11.25. Next, 5 into 0.875, 9.375. Then 1.375 into 5 plus 5, 11.875. Next, 0.5 into 5, that is 2.5, that is 7.5. And finally, 1 into 5, 5 plus 5, 10. Now just see B. This is one concept actually. The expected return of portfolio of a fund which is having beta 1 will be same. Why? Because if beta is 1, it will give same return as market. So this is a check actually. This is a check. This also helped me to tell, okay, I have not written correctly. So I went back and corrected to as 5. Now this concept, so these concepts are cross-referencer for you. So when the beta of the fund is 1, it will give same return as market. So in that case, alpha will be 0, because what is alpha? Expected return of portfolio minus expected return. So we actually, suppose I call this column as A and call this column as B. I have to do A minus B here. And this also you can do in the exam, to have focus. Lot of columns are there. What you do? Write A, B in pencil, and just so you will be tracking only those 2 columns to do calculation, and then remove those A and B. So here I have put A and B. So I have to simply track these 2 columns. 15 minus 11.25, 3.75. 12 minus 9.375, 2.625. 16 minus 11.875, that will be 4.125. 7 minus 7.5 minus 0.5 and 0. Now which fund is having highest alpha? That is fund Y, rank number 1, and this is rank 2, this is 3, this is 4, this is 5. So we are finding that Y has got first rank in all the 3 funds. So Y is a best fund. Therefore Y, which ranks first under Sharpe ratio, Trainer ratio, and Jensen's alpha is the best fund. So this completes the solution. So you have to remember 2 important concepts in this. Number 1, whenever market return is not specifically given, you must take that fund's return whose beta is 1. Whenever risk-free rate is not directly given, you must use T-bill return as a proxy for risk-free return. And one more concept, a fund whose beta is 1 will always have alpha equal to 0. So you can find that this particular fund whose beta is 1, we found that alpha is 0. In fact, this concept has been asked in many overseas examination. A fund whose beta is 1 will have alpha equal to 0. So therefore we use that 0 as a benchmark. So any fund giving alpha greater than 0 is a good fund for investment. So these 3 concepts you must remember. Hope you have understood this. Let us see this problem. 5 funds are evaluated for investment. An investor wants to invest in that fund which ranks among top 2 in all categories of lower and systematic risk, lower systematic risk, higher Sharpe ratio, and higher Trainer ratio. So we are provided with 5 funds A, B, C, D, E, return, standard deviation, and beta. Given that market variance is 25 and risk-free rate is 6%, which is the best fund for investment? Involves some usually problems from aspects of portfolio management calculations also. And mutual funds are merged in a single problem. Usually you will find mutual fund and portfolio management. So we have mutual fund is in section 3 single index model of your syllabus, and portfolio management is in section 2. But there will be a question where both will be asked because they are interlinked in concepts. Similarly, portfolio management and derivatives. Now this is a classic case of a problem where you have part of portfolio management and part of mutual funds asked in a single problem. Derivatives, portfolio management, mutual funds, the three are interlinked. So many concepts are overlapping. So a question may test knowledge from these three in a single question. Now you want risk to be low, as low as possible. But which risk? Systematic risk and systematic risk. Now these two can be calculated using Sharpe single index model. And it should rank high in which? Sharpe ratio, trader ratio. Now this comes in the chapter of mutual fund. So let us write the 4 formulae and then see how we go about calculating. Now I write Sharpe ratio. Given by the formula Rp minus Rf divided by sigma p. So higher the Sharpe ratio, better is the performance. Then trainer ratio. Rp minus Rf divided by beta p. Again here, higher the trainer ratio, better is the performance. So the best fund will rank number 1 like that. Then systematic risk given by beta square sigma square m. This Sharpe single index model formula. And unsystematic risk sigma square p minus systematic risk. So total risk minus systematic risk. So we have to see for all these 4 what is the value and what is the rank. So we will calculate Sharpe ratio, we will put a rank. So rank, value, Sharpe ratio value, rank, systematic risk, rank, unsystematic risk, rank. So we have to calculate. So we want these two low and these two should be high. So when we do ranking, you have to be very careful. The best Sharpe ratio, highest value of Sharpe will be ranked 1. The highest Sharpe ratio, rank 1. Similarly, highest trainer ratio, rank 1. Then lowest Sharpe ratio, rank 1, because the objective is to select the lowest SR. Similarly, lowest unsystematic risk, I said Sharpe ratio, lowest systematic risk, rank 1, and lowest unsystematic risk, rank 1. So we have to remember this. I written the bottom, we need not write in the exam. Let us see for the funds. What is the calculation? A. Now let us use some space here. We need Rp, we need Rf, sigma p. So let us write this. So Rp, then sigma p, beta p. And we can write Rf also, which is common, same. So this is 6. So let us write the funds. A, B, C, D, E. Returns are given 15, 18, 14, 12, 16. Standard deviation 7, 10, 8. These are percentages. 6, 9. Beta 1.3, 1.7, 1.4, 1.0, 1.5. RF is 6. So first one is 15 minus, now we are doing sharp ratio first. 15 minus 6, 9. 9 divided by 1.7. 9 divided by 7, sorry. 9 divided by 7. 1.29. Next one, 1.20. Next 1. Next 12 minus 6, 6 upon 6, 1. Next 10 upon 9, 1.11. So we can write the rank here. The highest fund will rank 1. So we got 1, 2, 3, 4, 4. So you have to be careful. Identical values should be given same rank, and the next rank should be skipped. So there will be no fifth rank. 2 are getting fourth rank, like that. Next, trader ratio. RP minus RF. 15 minus 6, 9. 9 divided by 1.3. You get 6.92. Next 7.06. Next 5.71. 6. 6.67. Let us rank now. Highest will be first rank. So first rank, second rank, third rank, fourth rank, and fifth rank. Next we calculate systematic risk. Beta square, sigma square m. Sigma square m is given is 25. So given sigma square m is equal to 25. So beta square 1.3 square 1.69 into 25. 42.25. Next 72.25. 49. 25. 56.25. Now the lowest risk will be ranked 1. Now the lowest risk, because it is given that it should carry lower systematic risk. So rank 1. Then rank 2. Rank 3. Rank 4. Rank 5. Now next we do unsystematic risk. That is sigma square p minus systematic risk. Sigma square p first is 49. 49 minus 42.25. 49 minus 42.25, 6.75. Next 27.75. Next 15. Next 11. Next 24.75. Now lowest unsystematic risk should be rank 1. So this is rank 1, 2, 3, 4, 5. So we have calculated all the 4 and ranked also. Now what the 5 funds are evaluated, investor wants to invest in that fund which ranks among top 2 in all categories. So it should be either 1 or 2. Now let us see. Now 1 or 2 means this, 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 this and this. Now which fund qualifies in all the 4? You can see this here also, here also. So fund A is the best fund because it is in top 2 in all the categories. It is number 1 in Sharpe ratio and unsystematic risk. It is number 2 in trainer and systematic risk. So it is in top 2. So this is how we actually evaluate and shortlist the fund for final investment. Hope you understood this. You have to be very careful with the while assigning ranks, because many silly mistakes have been done by students, and though the entire calculations were right, answers were exactly opposite. Let us see this problem. The following are the details of 3 mutual funds. We are provided the G fund, B fund, R fund, and also market. Average return is given, variance is given, and coefficient of determination is given. Now, coefficient of correlation we know. Coefficient of determination is nothing but R square. That is square of coefficient of correlation. So when you do rho square, it is called coefficient of determination. So this problem came in November 2020. Okay, whoever was knowing the basics of statistics, they would have done this. The yield on 182 days treasury bill is 9% per annum, which is the best fund in terms of Sharpe, trainer, and with respect to market. So once you find out the best fund in terms of Sharpe and trainer, we have to ascertain whether it is best or it is a better fund than the market. Let us see how we do this. This problem was asked in the November 2020 exam. Question number, if I am right, it was 4B, 5B for 8 marks. Now this was a fairly simple problem on performance of mutual funds, but those who are not good in statistics, possibly forgotten what they have learned, the words coefficient of determination would have confused them. Now what is coefficient of determination? Coefficient of determination is generally referred as R square. It is rho square. R square means rho square. So instead of giving rho, what is rho? Coefficient of correlation. So instead of giving rho, they give rho square in the exam. But still there was an absence of information according to me. Rho you can calculate between any 2 securities. So I should assume here, we assume that R square info is with respect to market. Okay, then only it will be easy for me to calculate beta, which is not given in the problem. Now there are 3 funds. They have given return, they have given variance, they have given coefficient of determination, they have also provided for market, and they have given 182-day T-bill 9%, that is RF. So they are telling us to calculate Sharpe trainer, and they are also telling us to compare with respect to market. So let us draw. So growth fund, balance fund, regular fund. Since they are telling us to compare with market, we have to draw a column for market also. Now, what is the formula? Sharp ratio formula is RP minus RF upon sigma P. Trainer ratio RP minus RF upon beta P. Now let us see what are all provided to us. RP is given because return is given. RF is given. 180 bill rate is given. Standard deviation they are given in terms of variance. So here, so we are given variance. So this is square root of variance. So that is also given to us. Beta. Now beta, we can write it as rho PM sigma P upon sigma M. Now sigma P, that is square root of variance. So this is given as square root of variance. Market also square root of variance. And this is square root of R square. So we can calculate beta. Okay, so this we can write as working notes, Sharpe ratio. Okay, so these are all the information we can extract. So this you should be writing in working notes. So let us now fill the information one by one. First, they are given average return. Average return percentage 7659. 7659. Now then we need for Sharpe ratio standard deviation. So let us write variance. We are given variance 92.16, 54.76, 40.96, 57.76. So therefore sigma standard deviation will be square root of this. So if we take square root 9.6, 7.4, 40.96 square root, 6.4, 57.76 square root, 7.6. So we can now calculate Sharpe ratio RP minus RF. RF is 9%. So RF percentage 9 and Sharpe ratio RP minus RF. So we are getting negative 0.21, 36%. That is also negative. So 6 minus 9 minus 3 upon 0.41. That is also negative. 5 minus 9 minus 4 upon sigma 6.4. and for market it is 9. 9 minus 9 is 0. So when you want to rank, the best fund will be the lowest negative number. So rank 1, 2, 3, and all the three have performed worse than the market, because market Sharpe ratio comes to 0 and they are all negative. So this we are writing in the end. Now let us write about R square that will be used to calculate our beta. So R square is 0.3025, 0.6561, 0.9604. Therefore rho 0.55, 0.81, 0.98. Now rho with respect to market is will be 1 only. So there is, because we are assuming rho given, because beta you can't calculate with any other rho. You need rho with respect to market. So that information is not given in the question paper. So we have to assume that the coefficient of correlation or determination is with respect to market. Now when you do, we have already calculated sigma p, sigma m, we have got everything. You can see here sigma m is given here, and this is sigma p. So for 3 funds they are given. So using sigma p, sigma m and correlation, we can calculate beta. Therefore when you do 0.55 into 9.6 divided by 7.6, 0.69, 0.81 into 7.4 divided by 7.6, 0.79, finally 0.98 into 6.4 by 7.6, 0.83. So now we can calculate trainer ratio. Again this will be negative because RP minus RP is negative. So 7 minus 9 upon beta. 6 minus 9 minus 3 upon 0.79. 5 minus 9 minus 4 upon 0.83. And here also it is coming to 0. So what is the rank? Lowest negative number will rank 1. So we have ranked the funds based on trainer ratio. This completes part A. So this was A and this was B. And they're asking what is the performance with respect to market. This is C, or market Sharpe ratio and trainer ratio is equal to 0, better than the 3 funds. Therefore funds performed worse than the market. So this was asked in November 2020. Not a very difficult problem, but in case you don't know the formula of that R square, this R square was a main issue here, and beta formula also. Some of you may not be remembering this beta formula. Okay, hope you have understood this. Okay, let us now start foreign exchange. This has been divided into three parts: basics, parity theorem, and others, which includes hedging and other concepts which involve foreign currency. If you talk of the questions that come, most of the questions come from the third part, that is hedging. But the basics part and parity, they also get questions. We can say once in 3 attempts for 8 marks. What are the types of questions we can see in foreign exchange? Now we cannot, there are so many things in forex that we cannot say that this will come most times, but we can divide, as I told you, into 3 parts: basics, parity, hedging, and others. So therefore I take these 3 separately. So we can say that this can come 70% of the times, this can come around 15% of the times, and another 15% here. But without knowing this and this, you can't learn this. So therefore, knowing all the 3 is extremely important. Now, where is foreign exchange? Foreign exchange is placed in section 4. Now, section 4, which other chapters you have? You have real options in capital budgeting, you have interest rate risk management. What is the weightage? Anywhere between 28 to 32 marks out of 120 marks. Suppose you leave entire forex or section 4, entire thing I am leaving, then I can attempt 88 marks. Now this is what I tell students, that if you find it extremely difficult, you are not digesting at all, don't waste time, master every other thing except section 4. But there are so many things in section 4, that is forex and interest rate risk management, they are fairly easy. So therefore you must not make up a general opinion that entire section 4 is difficult. In that case, I suggest students, whichever is easy, whatever you find totally confident, whichever part is easy, you do it. So that at least takes care of something. So if it comes in choice, in a favorable choice, you can say, you can attempt and score marks. Yes, there is a rule that if you study anything, you do everything properly in section so that you don't miss marks. But in case of forex, it's a very vast chapter. Now section 4, if you divide total paper, suppose you are going to take 100 hours to study, section 4 itself will take 35 hours. So when you remove section 4, then you are studying for 65 hours for 85 marks. Absolutely great deal. So you must understand the pros and cons of forex. Now, extremely difficult to execute in the exam, requires a lot of concentration. A little bit of carelessness can cost you entire marks. So let us start. We are going to start with basics. If you go to a banker and ask for a quote of dollars, he will give you like this: $1 equal to rupees 74, rupees 75. I am an Indian, remember, and this is foreign currency. And foreign currency is quoted in 1 standard unit. Now what is standard unit? Standard unit is 1 for most currencies, 100 for some, 1000 for some others. So 1 is a standard unit. So the foreign currency is quoted in standard unit. Foreign currency quoted in standard unit. Therefore, for me, dollar, the foreign currency, is quoted in standard unit. For me means Indian standard unit. Therefore, this quote is a direct quote. The direct quote is that quote where the foreign currency is stated in standard unit. So for a Japanese, any other currency other than yen, if it is quoted in standard unit, it is a direct quote for Japanese. So for an Indian, any currency other than rupee, if it is quoted in standard unit, it is a direct quote. Now, if the foreign currency is not stated in standard unit, like this, here the foreign currency is not stated in standard unit. I said standard unit means 1, 100, 1000, 10,000 standard. Okay, if foreign currency is not stated in standard unit, then it is called an indirect quote. See, direct quote and indirect quote is often, it may come in question paper only to confuse you. So don't bother. You must understand that for an Indian, the foreign currency should be standard unit. Then that quote is a direct quote for Indian. So 1 pound equal to rupee, $1 equal to rupee, 1 Swiss franc equal to rupee. They are all direct quotes because the foreign currency is stated in standard unit. Now, who is giving this quote? Now, this quote is given by banker. Banker is a businessman. Now, in this quote, you can see that banker is giving the quote is from banker's point of view. Banker's point of view. So, remember, banker is a businessman. Banker will always buy low and sell high. Then only he will make profit. So, banker is telling, I will buy at this rate. I will sell at this rate. Who is telling? Banker is telling. Banker is telling, I will buy what? The currency which is stated in standard unit. So banker is telling, I will buy $1 at 74. I will sell $1 at 75. So banker is buying and selling that currency that is expressed in standard unit. The banker is telling, I will buy $1 at 74. I will sell $1 at 75. Suppose he does both. Then he is buying at 74 and selling at 75. He is making 1 rupee gain. Banker being a businessman, the motive of making gain is fulfilled. So remember, the buy rate will always be lower than the sell rate. In foreign exchange market, we call this as bid rate. We call this as ask rate. So the buy rate is a bid rate, sell rate is ask rate. So all the quotes are given from banker's point of view. Why? Whenever you want to buy or sell foreign currency, you can't go to a neighboring kirana shop. You have to go to somebody who is authorized to buy and sell foreign currency. And therefore, you will go to banker because they are the authorized dealers of foreign exchange. So the banker is giving a quote. He is a businessman. So he will give 2 rates. Now I am using the word rates. This entire thing is called quote. This is called rate, bid rate. This is called ask rate. So we can say that a banker has quoted dollar quote. Why dollar quote? Because whenever we speak, we talk about that currency expressed in standard units. So banker has quoted dollar quote. Banker has quoted 2 rates, bid rate, ask rate. Bid means buy. So bid rate will always be lower than the ask rate. Otherwise, this quote is a nonsense. Nonsense means it doesn't make any sense. Because banker being a businessman, he will buy at a low rate, sell at a high rate. So banker will always quote 74, 75, 32, 33, 31, 32 like that. The first will be buy rate, second will be sell rate, first will be bid rate, second will be ask rate. Then this quote, I'll erase so many things which are surrounding it. Now this quote is, you can see, we write in A upon B format. Now this is called notation. If we write A upon B format, the standard unit will be in denominator. So standard unit in denominator. Standard unit in denominator. Other unit in numerator. So standard unit is this, and this will be numerator. So this is a rupee upon dollar quote. Now while we write quote in a equation form, very easy to understand if you write in an equation form. But when we solve problems, we need to write in A upon B format, that is notation form. And when we do that, whichever currency is expressed in standard unit will come in denominator. So it is a rupee upon dollar quote. Suppose I want to find rupee upon dollar bid. Rupee upon dollar bid. In the above example, it is 74. Suppose I want to find rupee upon dollar ask. In the above example, it is 75. You can see so many things are there. These are the main pillar or foundation to understand Forex. So this is all about quote, rate, bid, ask, banker, etc. Now the difference between these two, the difference is called spread. Now spread means spread actually denotes the gain what the banker is intending when he is giving a quote. Suppose you ask a banker for a dollar quote. Suppose I am an Indian, give me a dollar quote. Suppose he gives this quote. Then indirectly banker is telling he is trying to make 1 rupee. 1 rupee per dollar. You can see spread. So spread can be written as, spread can be calculated by two methods. First is percentage. That will be ask minus bid upon bid into 100. 75 minus 74 upon 74 into 100. So this can be done. Secondly, spread equal to ask minus bid. Now here you tell in swap points. Now swap points is percentage in percentage. So in the market sometimes dealers use the word percentage in percentage. Means what? 1% upon 100. What is 1% upon 100? 0.01 upon 100 equal to 0.0001. Okay. So 0.0001. What is this? Let us see. Now 100 basis points is equal to 1%. 1 basis point is equal to 1% upon 100. I have taken here down. Therefore, now if you take it here, which is actually this. So 0.0001 is called 1 basis point. So when you do here at 75 minus 74 equal to 1.0. Now 1 basis point is this much. So whenever you want to convert anything into basis point, you have to multiply by 10,000. So the difference I will multiply by 10,000. So I will get 10,000 basis point. So what we have learned is spread is also expressed in basis points. 1 basis points equal to or you can write 100 basis points equal to 1%. Therefore 1 basis points equal to 1% upon 100 equal to 0.01 upon 100 equal to 0.0001. Whenever we want to convert spread in decimals to basis points, multiply by 10,000. So suppose I have this 1 pound equal to dollars 1.2836, dollars 1.2839. So the difference is 0.0003. So in basis points, what we do? 0.0003 into 10,000 equal to 3 basis points. So multiply by 10,000. Very, very important. Remember this. Because they will give the spread is 20 basis points. So you must know how it is. So 20 basis point means, so you can convert reverse. It will be 0.0020 like that. So this entire calculation is very important. Now after having learned this, you must know what is an inverse quote. Now if I write $1 equal to rupees 74.75, therefore 1 rupee will be equal to dollar 1 upon 75 slash dollar 1 upon 74. Remember, I have taken this 75. What was 75? 75 is rupee upon dollar ask. Correct? Rupee upon, because this is rupee standard currency in denominator, other currency numerator. So it is a rupee upon dollar quote. And second is ask rate. So I can write rupee upon dollar ask. Now what is this quote? What is this quote? This is a dollar upon rupee quote. Or I'll write this side. So this is a dollar upon rupee quote. Now what is this? This is a bid rate. Now what I have written here? What is this actually? This is this. So why I read 1 upon 75 and 1 upon 74? Why not 1 upon 74 and 75? 1 upon 75 is a smaller number. 1 upon 74 is a bigger number. We have a rule, the bid rate should be lower. So 1 upon 75 will come and 1 upon 74. So what we can, if you from this we can write, so you can see this is, what is this? This is dollar upon rupee bid. So because this is a dollar upon rupee quote, this quote is a dollar upon rupee quote, and this is a bid rate. So dollar upon rupee bid is equal to 1 upon, what I did, I took the reciprocal of the inverse quote. Now you can see here, this is dollar. Numerator is dollar. What is this? Numerator is rupee. Here denominator is rupee. Here denominator is dollar. It is, so these are inverse quotes. So similarly you can see here, this one I am writing now. This is dollar upon rupee ask is equal to 1 upon, what is 74? 74 is this. This is what, rupee upon dollar bid. Rupee upon dollar bid. So again you can see here, dollar is numerator, dollar is denominator, rupee is denominator, rupee is numerator. This is ask, this is bid. Exactly inverse. So in general we can write, in general, whenever I want A upon B ask, I can write 1 upon B upon A bid. And whenever I want A upon B bid, I can write 1 upon B upon A ask. You can see B upon A is inverse of A upon B. So A upon B bid is 1 upon B upon A ask. A upon B ask is equal to bid, A upon B ask equal to 1 upon B upon A bid. It is just inverse. Very, very important. When this will be useful? You are doing a problem, you want rupee upon dollar ask to be used, but they are not given rupee upon dollar ask. They are given dollar upon rupee quote. Okay, use 1 upon dollar upon rupee bid. So that's where it is useful, inverse quotes. Okay. Next concept. Now you must understand that whenever we want to look for currency, what we should do? We should follow 3 rules. Now, how to get required quote? Now, what do you mean by this? Suppose want to buy $10,000 versus rupee. Means I want to buy $10,000. Why? I'm going to US. So first you have to identify 2 currencies. Currencies involved, dollar, rupee. Then you should identify quantum currency. What is the quantum currency? See, they are given quantity of which currency? Dollar. So therefore, we need rupee upon dollar quote. So whichever is a quantum currency means whose quantity is given, that quote we want. That quote means that quantum currency should be denominator of the notation. Suppose they are given quantum currency pound 5,000 and Singaporean is doing, Singaporean is transacting pound 5,000. Quantity of which currency is given? Quantity of pound is given. Which is the other currency? Singapore dollar, because Singaporean currency is Singapore dollar. So quantum currency should be denominator and Singapore dollar. So our Indian importer is there. He has to pay Hong Kong dollar 5,000. So if he has to pay Hong Kong dollar 5,000, now quantum of which currency is given? Hong Kong dollar. Who has to pay? Indian has to pay. So this currency is required. This code is required, sorry. So that's how we decide the code. See the quantity currency. That quantity currency should be denominator, other currency should be numerator. Okay. After that, third, now we want to buy. So if you see this quote, initially we saw $1 equal to rupees 74, rupees 75. Assume the banker is given a quote. So banker is buying, banker is selling. Who is doing? Bank. What about customer? If banker is selling, if banker is buying, customer will sell, is it not? If banker is selling, customer will buy. If banker is buying, customer is selling. A transaction buy and sell. One is buying, other is selling. So you can see the second quote is a sell quote. 75 is a sell rate of a banker, which is the buy rate of a customer. First rate is a buy rate of a banker, sell rate of a customer. So whenever the customer buys, we use ask rate. Whenever the customer sells, we use bid rate. So here, what you want to do? You want to buy. So which rate is applicable? Therefore, ask rate is applicable. Ask rate for buy. Therefore, we need rupee upon dollar ask. So this is how we get the quote. Let us see one more example. US importer has to pay yen 10,000. Now first, two currencies involved. Which are the two currencies involved? Two currencies are US importer dollar, other currency yen. Second, which is quantity currency? Whose quantity is given? Yen. Therefore, what code we want? Quantity currency should be denominator. So we want this code. This code required. Third. Now, what is the transaction you want to do with the quantity currency? Transaction of quantity currency. Transaction of quantity currency. Now, what do you want to do with the quantity? US importer has to pay yen. So, what will you buy yen to pay, or will you sell yen to pay? He has to pay somebody. So he will buy. No, he has to buy yen and pay him. So he will buy. So transaction of quantum currency is buy. Now whenever you are buying, you can see here, whenever you are buying, what is the rate applicable? Ask rate. So we need ask rate. Therefore, ask rate. Therefore, we need dollar upon yen ask. Okay, that's how we decide the. Next, you must understand that whenever we go to bank, now banker is there, customer. Suppose I am buying dollars 1,000. You can see banker is selling dollars and you are buying dollars. The banker is a seller, you are a buyer in this contract of $1,000 purchase. You are buying $1,000. So for customer, customer is buying, therefore banker is selling. Now remember, in the books of bank, with this trade, in the dollar folio, this is bank book. In banker's book, in the dollar folio, it will be minus 1,000 created. Remember, in banker's book, you will have a negative position. Why? Because he is selling. Banker is selling $1,000. So banker cannot keep a foreign exchange position in its books. Why? Because foreign currency keeps on moving. Suppose I have 100 rupee note in the pocket, value doesn't change, but $100 value keeps on changing. So minus 1,000 created by selling dollars to customer has to be taken care of. So what the banker will do? Banker will go to market. He will buy $1,000. So what will happen is this will create a buy position for him. So now this is okay. Because any rise or fall in dollars will be offset because he has one buy position and sell position of same quantum. So whenever a banker does a foreign exchange transaction with the customer, he will do the opposite transaction with the market. When I say market, any other bank, he will do a transaction in same quantum, same currency, same due date, so that he has nothing to lose or gain. This is very, very important. Next concept. By default, all transactions are settled in 48 hours or 2 days, 2 business days by default, and they are called spot transactions. So spot means by default, means suppose you pick up the phone, ask the banker, can you tell me dollar rate? He will give 74.75. Means by default it is understood that it is going to be settled in 2 days. Suppose you do a trade on Monday, on Wednesday your trade will be closed, means it will be completed. Means suppose I buy dollar on Monday, I place an order to buy dollar on Monday. On Wednesday, I will give rupee, he will give dollars. That's called settlement. So settlement will happen in 2 business days when we call of spot. Spot is by default. Suppose you want to do early by 1 day, that is called tomorrow. But we don't use in the market. Means you don't have in the exam now. And more than 2 days, this is spot is 2 business days. Greater than 2 days is called forward. So forward quote is that quote where you settle in beyond 2 business days. Next, appreciation, depreciation. Suppose I have 2 periods, period 1, period 2. Now what is period 1? Period 1 could be anything. It could be related to past, last year, this year, next year, any day, any date, any date. Past, present or future. Same goes here also. Any date. Suppose I write here $1 equal to 74, $1 equal to 75 rupees. Now, if period 2 rate is greater than period 1 rate, if period 2 rate greater than period 1 rate, then the currency that is expressed in standard unit, that is dollars, is said to be appreciating. Now, if it is a past, we use the word appreciated. If it is a present, we use the word appreciating. If it is future, we write will appreciate. That's all. Period 2, period 1, compare. Now, period 2 could be, obviously, period 2 should be greater than period 1 rate. When I write period 2, it means a date later than period 1. Now, don't think that it can be. Having taken one particular day, say 1st March 2018, then period 2 should be greater than this date, 7th March 2019. It should be later than period 1. So suppose on this day it is like this, then we can say, now this today is we are in 2020 now, so this is 18 and 19. So we can say during the period 1st March 2018 to 7th March 2019, dollar appreciated from 74 to 75. Why dollar? Because dollar is expressed in standard unit. So whichever currency is expressed in standard unit, we say that currency is appreciated or depreciated. So how to calculate percentage appreciation, depreciation? Percentage appreciation. What about rupee? Rupee has depreciated. So when one currency appreciates, other currency depreciates. Now I am having standard quote. Remember, I am having standard quote of dollars. Standard quote of dollars. Remember, dollar is expressed in standard. So I can calculate percentage appreciation or depreciation of dollars only. I cannot calculate percentage appre of rupee. Why? Because we are having dollar standard quote. So dollar standard quote will give you dollar appre. Rupee standard quote will give you rupee appre. Now I can calculate this. How I do this? Period 2 rate minus period 1 rate upon period 1 rate into 100. So whatever is the second period rate minus whatever is the first period rate divided by first period. So 75 minus 74 upon 74 into 100. So that will give you percentage appreciation of that currency that is expressed in standard units. So suppose I have 1st January 2020. Suppose I have 1st December 2020. I have 1 rupee equal to dollar 0.0135, 1 rupee equal to dollar 0.014. Now obviously the greater date is period 2. This is period 1. So we can say that in period 2, rupee was equal to $0.0140. So since period 2 rate is greater than period 1 rate, the currency that is expressed in standard unit, that is rupee, has appreciated. And percentage appreciation will be period 2 rate minus period 1 rate upon period 1 rate into 100. So rupee code will give you rupee appreciation rate. Dollar code will give you dollar appreciation rate. In the exam, what they will do? They will give you dollar code and ask calculate rupee appreciation. So you should not use that code. You must read what they are asking. They are asking rupee appreciation. Do we have rupee code? No. So first calculate. Now we calculate here. Now this is the rupee code. Now they are asking dollar appreciation. Now you have to take inverse. So how we take inverse? $1 equal to rupee 1 upon 0.0135. Here I will write $1 equal to rupee 1 upon 0.0140. So I will take inverse. And then I will get some value. And then since once I get this will be how much? Suppose you want to write 0.0135. This comes to 7407. And 1 divided by 0.014. This comes to 7143. So we can see that period 2 rate of dollar is lower than period 1 rate. Therefore, dollar has depreciated. So percentage depreciation will be second rate minus first rate upon first rate into 100. And the answer will be negative. Negative means that currency which is expressed in standard unit, that is dollars, has depreciated. Positive answer means appreciated. Negative answer means depreciated. Next concept. Premium discount. If I write spot rate, one spot, $1, rupees 74, rupees 75. This is spot. Suppose I write 3-month forward, $1 equal to rupees 75, rupees 76. Now we can see that forward is greater than spot. The values are more. So then the currency that is expressed in, therefore dollar is quoting at premium. Which currency quotes at premium? The currency that is expressed in standard unit. So F is greater than S. Therefore dollar is quoting at premium. Had it been 73, had it been 74, now then we'll write F is less than S. Therefore dollar is quoting at discount. Now one thing you have to understand, that you have to see the standard unit currency. In forex, that is very, very important. And here also we can see that F is greater than S. Therefore which currency is at premium? The currency that is expressed in standard units. Now suppose how we calculate, very, very important concept. Now we are going to learn formula for percentage premium or discount is equal to forward rate minus spot rate upon spot rate. So forward rate minus spot. Now which rate will you take, bid or ask? You can take either bid. If you take bid in forward, you should take bid in spot also, or ask, or mid. Now mid is equal to ask plus bid upon 2. Now in the exam, how to do? If they are not stated anything, you can take anything. You can take bid or ask, but you must write, I am using bid rate to calculate. So F minus S upon S into 12 upon N. So we have to annualize. Remember, this is 3 months. So this 3 will come here. So when I do 12 upon 3, I am annualizing into percentage, therefore 100. So percentage premium discount. Remember, it is percentage. So therefore into 100. So premium or discount is always quoted in annualized form. Always in annualized form. So they will write 3%. Dollar is quoting at 3%. Means remember, it is annualized. You should not think they will give spot rate so and so, 3-month rate so and so, premium 3%. No, 3% premium is not over 3 months. It is annualized. Okay, so F minus S upon S into 12 upon N into 100. Suppose they give days, you can say that 365 by 91, whatever it is. So like that you can use. Remember, dollar quote will give you dollar premium discount. Rupee quote will give you rupee premium discount. Suppose many time it happens, they give you dollar quote, they'll ask you rupee premium. Obviously, you have to take inverse. Okay, you have to take inverse and bring the standard quote to rupee. Means rupee should be expressed in standard unit. Then only you can calculate rupee premium or discount. Okay, so you have to be alert. In the exam, generally it happens. They will give you pound quote. They will ask you dollar premium. So you have to be alert. Now, there is another way of calculating forward rate. Example I will give you. 1 pound equal to dollars 1.2835 $1.2842. Now this is the spot. Now they will give 3-month swap point. Now swap points are cost incurred or received by the banker to facilitate a 3-month forward to customer. Means what? The banker will quote like this: 2035. They will quote swap point as 2035. So 2035 means what? We have to first fix decimals as it is appearing in spot. In spot we have 1, 2, 3, 4 decimals are there. So I will fix 4 decimals. 1, 2, 3, 4. So I will fix 4 decimals in line with the spot. So here also I will fix 4 decimals. Now you can see that 2035 is an ascending order. 2035 is ascending order. Therefore I will add. So it will be 1.2855, 1.2877, right? So this is 1 pound equal to dollars 3-month forward rate. So we can calculate forward rate by using swap points. Now it can be in descending order also. It will be say 15, 10. Now if they are in descending order, you deduct. So you can see 15, 10 is descending, deduct. So but fix decimals. So we write 1.2820, 1.2832. So we deducted, subtracted. So whenever they give swap points in decimals, whenever they give the swap points, you have to first find whether they are ascending or descending, so that you know whether they have to be added or deducted. And before doing that operation, you must fix the decimals in line with the spot code. Suppose spot has 75.25, only 2 decimals. So 75.25, 75.35, got 10, 20. So fix 2 decimals, that's all. Now ascending, therefore add. So 75.35, 75.55. Okay, so this about premium discount swap. Then we come to cross rates. Now what are cross rates? Now I want to go to Singapore. I'm an Indian. So I want 1 Singapore dollar equal to rupees dash. But this is not available. But the banker is quoting something like this. 1 Singapore dollar equal to dollar dash and $1 equal to rupee dash. So we can see that Singapore dollar has to be converted to rupee and dollar and then dollar to rupee. So there is one unwanted currency, dollar. So what we do is, assume I want rupee upon Singapore dollar quote. Now instead of getting 1 quote, I am having 2 quotes. So I write into 2 fractions. 2 quotes given 2 fractions. 4 quotes, 4 fractions. So I want rupee in numerator. I want this in denominator. So first you write what you want. Then you write unwanted currency so that they cancel out. Suppose I want bid. So you take bid of both. Suppose I want ask. You take ask of both. Very simple. Now sometimes they will not give you, both these currencies. For example, let us take this. Suppose I have 1 pound equal to dollar. Suppose I have 1 pound equal to euro. Suppose I have 1 rupee equal to euro. Now you can see in this there are 3 quotes. If you see the 3 quotes, which are the currencies that are appearing in pair? Pair means 2. You can see pound here, you can see pound here. You can see euro here, you can see euro here. Just knock it off. Which are the ones that is left? Rupee, dollar. So they are the required currencies. So whenever, what they will do is they will give like this, an Indian, they will give like this, an Indian has to pay foreign currency 5,000. Now they will not give which foreign currency. An Indian has to pay foreign currency 5,000. Which foreign currency? How to know? But they will give these 3 quotes. When they give these 3 quotes, eliminate the pairs pound, pound, euro, euro. What is left? Dollar. Therefore, we know Indian has to pay $5,000. Now, once you know the quantum currency, so you know that quantum currency should be denominator. So we need rupee upon dollar, and he has to pay. Therefore, he has to buy. Therefore, we need ask rate. So from like this, we will get what quote we require. Now, once you get rupee upon dollar ask, you put equal to. So do you have? You can see here. You don't have rupee upon dollar ask. What is this? This is dollar upon pound. What is this? This is euro upon pound. What is this? This is euro upon rupee. So we don't have this. We don't have rupee upon dollar. But we know that rupee and dollar can be found out because the pair currency will cancel out. Just see how they cancel out. How many quotes are there? 1, 2, 3. So we write 3 fractions. 1, 2, 3. I want rupee here, so write rupee. I want dollar here, so write dollar. Now see the given quote. Rupee is connected with which currency? The rupee is connected with euro. So write here euro, euro. Because euro will cancel out. Now euro is connected with which currency? You can see here pound. So write here pound, pound. So if we want ask, so we want ask of this, you want ask of this, you want ask of this. Since rupee upon dollar ask is required, we want everything asked. Equal to. Now rupee upon euro ask. Do you have rupee upon euro? You can see we don't have rupee upon euro. We have euro upon rupee. So we'll write 1 upon euro upon rupee. But instead of ask, it will become bid into. Our second is euro upon pound. Do you have? Yes, we have. So euro upon pound ask. Third is pound upon dollar. No, we don't have. So 1 upon dollar upon pound bid. And then when you substitute the rate and divide, we get the answer. So first identify 2 currencies, identify quantum currency, find out what quote you want, identify the transaction of quantum currency, find out what rate you want, then look for the quote and rate. It is not given, but many other quotes are given. How many quotes are given? Make so many fractions. And then proceed the way we discuss. Okay, you can go through this, get to know and solve problems involving all these. So many revisions will be done. After seeing cross quotes, we have got 2 more things in this chapter. Nostro account reconciliation. And in fact, it is discussed along with the problem. So here we maintain 2 accounts, cash account and exchange account. What is a Nostro account? State Bank of India is an Indian bank. If State Bank of India want to maintain a dollar account, why? Because many customers come to State Bank and they say, give me dollars, take these dollars. So they keep on transacting dollars. So it wants to actually have a dollar account where it can deposit, withdraw, so many things. So what State Bank of India will do, it will maintain, it will open a dollar account with Citibank, US. Because Citibank's home currency is dollars. So State Bank of India will open a foreign currency account with Citibank. So foreign currency account of any bank is called Nostro. So it is a foreign currency account. So State Bank can open State Bank can open dollar FC account, dollar foreign currency account with Citi. That is called dollar Nostro. It can open pound Nostro with Barclays. It can open Australian dollar Nostro with Standard Chartered Bank, like that. So a particular bank can have many Nostro account of different currencies. Now this Nostro account, will have so many thousands of transactions in a day. Now it has to be reconciled. Because when you assume that you are opening a savings account, suppose you are a businessman, you are opening a current account with State Bank. Per day, 200, 300, 4,000, 5,000 checks come. You deposit, you issue, withdraw. What you do? So you have a cash book, you have a bank book, you reconcile. Similarly, here also you have to reconcile. Now reconciling is done by whom? So generally you maintain one account, Citibank will maintain a mirror account, and reconciliation will happen at a particular period. So when you maintain, there is a method of maintaining. You maintain one cash account, you maintain one exchange account. All transaction which is going to impact the account immediately. Today only you have to debit, today only you have to credit. It will appear here. All transactions which is going to be, credited or debited today or in future, it will come here. So exchange account will have everything. Are you going to debit today? Put in exchange. Are you going to debit tomorrow? Put in exchange. Okay. Cash account. Are you going to debit tomorrow? Don't put in cash account. Are you going to debit today? Put in cash account. So all transactions hitting the account on the same day, put in cash. All transactions hitting the account on same day or in future, put in exchange account. Very simple rule. But there will be no double entry. For example, suppose one DD has been issued by State Bank. One DD issue. Is the DD going to be encashed today only? No. Suppose you issued $1,000 DD to one customer and he is going to US. So you gave that $1,000 went. Has he encashed $1,000? No. So he has gone to, for foreign tour. So after 25 days, now when you issue $1,000, you will put here $1,000. In exchange account you will put, because it is going to be done sometime in forward. Now after 25 days, if he is realizing it or if he is getting debited, okay, so then what will happen is, then only it is going to hit. So then only you will put here. So what I am trying to say is, you may not put this. You may not put this in exchange account. Depending upon what statement they give. Dollar issued will come in exchange account. Dollar, withdrawn, like that. So then dollar withdrawn already you have put in exchange account. Again you will not put in exchange account. Now you will put only in cash account. Similarly, bills collected. You collected, one person went to Europe, gave a bill, and did some business, and he is going to receive $10,000 or euro 10,000. So he comes to State Bank, take my bill. Okay, euro 10,000. When you are going to receive sometime future, so put in exchange account, euro 10,000 exchange account. After 2 months, he is actually receiving 10,000. So it will come realize. So then it will impact only cash account, not exchange account. So this is the only one or two things. It will not confuse you. You see the problem, you will understand. Finally, we have one important thing I want to tell you about transaction costs. Now, transaction cost, whenever you are buying currency, you have to pay transaction cost. Whenever you are selling, again you have to pay transaction cost. Why? Because you are a customer, you have to pay. But what will happen to the rate the banker quotes? When you buy foreign currency, banker will use ask rate. So what you will do? Ask rate plus commission. And whenever you are selling, he will give you bid rate. Bid rate minus commission. Bid rate means he is going to give you bid rate. Before giving, he will deduct this commission. And whereas when you buy foreign currency, he will give ask rate and he will add. So your purchase rate will increase because he will add commission. Your sale rate will decrease because he will deduct commission. This you have to understand. Okay. And when we talk of cross rates, you have to understand very important thing is, if they give, suppose let us talk about this cross rate. rupee upon dollar into dollar upon pound. Now if they give, now this is a rupee upon pound quote, you can see unwanted currency dollar getting cancelled. Assume that Indian customer is doing some transaction in pound. Now sometimes they will give like this. The Indian customer will pay 5 paisa transaction cost. 5 paisa, or they will write only 5 paisa. Now this 5 paisa will be applied only here, remember. Here it will not be applied because it is a dollar upon pound. So 5 paisa is in denominated in rupees. So it will be applied only in this leg. It will not be applied in this leg. So when sometime in the exam they will give specifically, there will be a cross rate calculation and they will give specifically transaction cost is 5 paise. Now that 5 paise will be applied only in this leg. It will not be applied. Suppose they give 2% transaction cost for the entire trade, then you apply everywhere 2%. Okay, it will not trouble you much in the exam, it will be clear. Okay, so this all about we have a triangular arbitrage. The concept is explained in the problem section when you see. Okay, so this entire chapter is a foundation or pillar. I feel you should go through this entire video once again in case you are not understood, since this rapid revision is meant for students who have already studied once, so you should have understood everything by now. Okay, after this go through the formula where most of the things will be repeated again, that will be re-revision, then you can do problems. Let us now go to see the important formulae in the chapter of international finance. This is broken into 3 parts: foreign exchange basics, then interest rate parity theorem and purchasing power parity theorem, and finally those related to hedging. Unlike portfolio management, this chapter does not have many formulae, but there are several concepts which has to be understood. In fact, we have more rules, and the way we write, the way we calculate, so those kind of rules are there. Formula is less. Therefore, foreign exchange is best understood by solving problems. The discipline is required. If you are indisciplined in presenting the answer, then you should not count this chapter for success. So that discipline, that methodical writing, systematic writing, logical continuity of every step is the highlight of this particular chapter. As I told, I have very less formulae, so let us go through the formulae and some important concepts whichever is required. The first is a standard unit currency. Now what we mean by standard unit currency? Suppose I have $1 equal to rupees 75. Now one is called standard unit, 100,000. 99% of world currencies, standard unit is 1. The currency that is attached to 1 is dollar. So therefore dollar is a standard unit currency. So this quote I can call it as a dollar quote. So when they give dollar quote, means it is $1 equal to. Need not bother about that 100,000. 99% of world currencies have 1 as standard unit. So when you say dollar quote, $1 equal to. Another name is dollar direct quote. Same, $1 equal to. Suppose they will give direct quote of pound, means 1 pound equal to. So standard unit currency is the currency that is attached to that one unit, and the rupee is another currency, or the counter currency. Now every quote has two rates. Remember, quote is given by the banker. So I will have rupees 75.50. Now this entire thing is called quote. This is called bid rate. This is called ask rate. This is bid rate. This is ask rate. This is called dollar quote. So you can see these are different terminologies which you should be familiar with. Entire thing is called quote. And a quote has two rates: bid rate or buy rate, the rate at which bank wants to buy. Remember, it is given by the banker. So bank wants to buy. The rate at which bank wants to buy is called bid rate. The rate at which bank wants to sell is the ask rate or sell rate. For the customer, it is exactly opposite. So when we solve problem, remember, we are not banker. However, in the all problems, only one rule. Whenever I want to sell, use the bid rate. Remember, when I sell, the bank is buying. So when I sell, use the bid rate. When I buy, use the ask rate. Very simple. So whenever we are buying currency, use ask rate. Whenever we are selling currency, use bid rate. So quote, bid, ask. The difference between bid and ask is called spread. Spread can be easily calculated as, now I am telling you difference between bid and ask. So remember, ask rate will always be greater than the bid rate. Ask always greater than bid. Very, very important to remember. You will never have a situation where ask is less than bid rate. Remember, the first rate bank wants to buy. A bank wants to buy at 75. Bank wants to sell at 75.50. A bank is buying at 75. Bank is selling at 75.50. The bank is making a profit. That makes sense because the banker is a businessman. And by buying at a lower rate and selling at a higher rate, bank is making a profit. And that is a norm, and that is what it should be. Therefore, ask rate is always greater than the bid rate. Therefore, ask minus bid upon bid into 100 will give you percentage spread. So this is percentage spread. So percentage spread tells how much a banker is trying to earn when he is quoting a transaction to the customer. Now, how quotes are generally written? So suppose we are taking this quote. Now, how we generally write this quote? So we know that dollar is a standard unit currency. So this is your standard unit currency. This is standard unit currency. So that will come in denominator, sorry. So standard unit currency will come in denominator. The other currency will be in numerator. So this is the way we write the quote, called as a notation. So the notation of this quote is rupee upon dollar quote. And if I want to specify this, I write bid. If I want to specify this, then I write ask. Remember standard unit currency denominator, so that is the notation. Now what is the inverse quote? Inverse is dollar upon rupee. Now this is the quote, rupee upon dollar. What is the inverse? Dollar upon rupee. Currencies will exchange places. So dollar upon rupee is the inverse quote. Suppose I want to use rupee upon dollar bid in the calculation. But rupee upon dollar, that is dollar quote is not given. And rupee quote is given. Then I should use 1 upon dollar upon rupee ask. So this is the inverse of this quote. So dollar upon rupee is the inverse of rupee upon dollar. Suppose I don't have this, then I should do 1 upon, that is reciprocal, of dollar upon rupee ask. See, bid has been changed. So most of the institute problems involve use of inverse rates. They will give you rupee upon dollar. Deliberately, they will make students use inverse rates in the calculation. So we should see, suppose I want a quote 1 pound equal to dollar something. I want this, but I don't have this. And they have given in the formula, sorry, exam or in the question like this. Remember, this is standard unit currency is pound. So this is dollar upon pound quote. And this one is exactly opposite. Pound upon dollar quote. This is the inverse quote. And assume that I want dollar upon pound ask. But it is not given. They are given this. Therefore, I will use 1 upon pound upon dollar bid. So you can see you are doing two changes when you are using inverse rates. One, dollar upon pound will become pound upon dollar. Number two, instead of ask, you are using bid. So you should remember, 18 problems are solved. Most of them, involve use of inverse rates, and we have done so many problems also in the class. Next, we come to cross rates. Now, cross rates involve use of multiple quotes. For example, suppose I want to buy Singapore dollar. I want to buy Singapore dollar. I go to bank and I give rupee. I tell, give me 1000 Singapore dollar. Since the quantity of Singapore dollar is mentioned, suppose I go to bank and tell, give me 1000 Singapore dollars. Now, the quantity of which currency I told the bank? I told I want 1000 Singapore dollar. I did not tell like this, take my 1 lakh rupees, give me Singapore dollar. I did not tell that. I said I want 1000 Singapore dollar. So I have mentioned the quantity of which currency? I have mentioned the quantity of Singapore dollar. What is the other currency? Rupee. Since I have mentioned the quantity of Singapore dollar, it should be in the denominator. Had I mentioned, give me Singapore dollar for 1 lakh rupee, then that rupee would have been in the denominator. So quantity currency should be in the denominator, other currency in the numerator. What I want to do, I want to buy Singapore dollar. So if I buy, which rate we use? We use ask rate. then if I go to bank and tell bank is selling, sorry, I can't give you Singapore dollar directly with rupees. First, I will take rupees from you, then I will buy dollar, US dollar, then I will sell US dollar and then get Singapore dollar. So now the bank is telling that I will use one more currency other than rupee and Singapore dollar. So whenever you are using a third currency or more than that, then we are talking of cross rates. Now the right hand side formula will be like this. I want rupee. Now there are two quotes. One is rupee dollar quote. Other is dollar upon Singapore dollar quote. So there are two quotes. So there will be two fractions. Here it will be rupee. Here it will be Singapore dollars. And there is one currency which I don't want to use, but bank cannot do the transaction without it. What is that currency? Dollars. So if I want rupee upon Singapore dollar ask, I need rupee upon dollar ask and dollar upon Singapore dollar ask. So bank will use rupee upon dollar ask and dollar upon Singapore dollar ask. So you can see that dollar is getting cancelled here. So that makes LHS equal to RHS. So you should build the equation first and ensure that all the currencies, unwanted currencies that is not required to form part of this quote should cancel out on the right hand side. We have problems solved, many of them. You can go through it and you can test yourself also. Then nostro accounts. Nostro accounts are foreign currency accounts held with the opposite bank. Suppose State Bank is having dollar account with Citi. For State Bank, which is an Indian bank, dollar is the foreign currency. So dollar account is foreign currency account. So State Bank will call it as dollar nostro account. Remember, it should be a foreign currency account. And that word foreign currency will change. It depends upon who is looking at the quote. Who is looking at the currency. Suppose we have US bank and that US bank is maintaining rupee account with State Bank. So for US bank, rupee is a foreign currency. So rupee account with State Bank is a rupee nostro account. For whom? US bank. Because rupee is a foreign currency. So you must always see who is looking at the currency. So we have one problem solved in nostro account. And in nostro account, whenever a bank opens a nostro account, that bank is provided with some position. Mean the Indian bank, assume that we are talking of State Bank, having opened dollar nostro account. In that case, the dollar nostro account, dollar position will be given by Citibank. Citibank will say you can hold so much of dollar position, because bank, it is like a savings account. We have a savings account with State Bank. Now it is easy for us. We don't do such a big transaction, but bank has got thousands of branches all over India. So many transactions will come and hit the account. It's very difficult. So State Bank, Citibank will give. You can maintain so much of position. You can either keep it in debit or credit up to this limit. So some exchange limit will be given. An actual account will be there. So what are the things we have to do? Everything is explained in that problem. So you can try that problem first using whatever you have learnt. Else you can go through the concept explained in that problem. Next we see what is appreciation and depreciation. Now appreciation and depreciation refers to what is the rate in period 2 with respect to period 1. Remember, you are comparing rate in period 2 with respect to period 1. Period 2 is always greater than period 1, that you have to remember. So rate 2 I have written here minus rate 1 divided by rate 1. I can use either bid rate or mid rate or ask rate. In the exam, if they don't specify, you can use either of these, but you must mention there that I have used bid rate. Remember, there will be two rate. Say $1 equal to rupees 75. This is say Jan 20. This is July 20. $1 equal to rupees 75.50. So this is rate 1 and this is rate 2. Now here only one rate is given. There is no bid ask. Then you need not mention anything at all. But if they give like this 75.2 slash 75.7. Now here I can use bid rates. I can use bid rates. Or I can use ask rates. Or I can use mid rate. Mid means average of these two. Average of this 75.1. Average of this 75.6. I can use this rate also. Mid rate. Mid means average. So whichever rate you use, you must write. So this is appreciation depreciation where I am comparing rate in period 2 with respect to period 1. Then we come to premium and discount. Very, very important terms. Now, what is premium and discount? If we compare spot rate with forward rates, and forward rate is greater than spot rate, then we say that the standard unit currency is at premium. Suppose I write here spot $1.75, 3-month forward $1.76. Now forward rate is greater than spot rate, so then the currency is at premium. Which currency? The standard unit currency is at premium. Now suppose this is 74, then forward is less than spot, then the standard unit currency dollar is a discount. So premium or discount, compare spot rate and forward rate, and the formula is this. You have to remember one thing: premium or discount is always expressed in annualized percentage terms. Always expressed in annualized percentage terms. Then next we come to swap points. Now swap points means the points that will be given in the examination to calculate forward rate. Now they will give spot rate. £1 equal to dollar 1.2850, dollar 1.2860, and they may give swap points, means additional cost to do a forward transaction. So they may give, it could be a cost or benefit. Now if they give like this 12, 13. Now 12/13, 12, 13, it is in ascending order. The swap points are ascending order. This will be swap points. Swap points are in ascending order, 12, 13, rising. In that case, we have to add A for ascending, A for add. So, but before we add, we have to fix the decimal point. As per the spot rate. In the spot rate, how many decimals are there? 4 decimals are there. So fix 4 decimals. 1, 2, 3, 4. 1, 2, 3, 4. And then add because it is ascending. So we get 1.2862, 1.2873. So this will be your forward rate. So swap points are used to calculate forward rates. If they were in descending order, we should deduct. So descending, deduct. D for descending, D for deduct. Suppose this was 18, 15. See, 18, 15 is descending order. First, write the swap points aligned to the right, fix the decimal point as per spot rate, and then it is descending, therefore deduct. So when I deduct, I get 1.2832, 1.2845. So all these things have been mentioned here. So this completes the theory and concepts and the formulae linked to foreign exchange basics. Now let us go to the next one, that is foreign exchange parity theorem. Let us see this problem. The company expected $5 lakh from an overseas client. Therefore, it placed an order with the bank on 6 June 2020. The exporter, however, was informed by the banker that the deal could not go through on 6th of June and did the customers trade on 10th of June. The interbank market rates were as follows. So we are provided with rupee dollar quote, rupee euro quote, and euro pound quote. How much does the customer stand to gain or lose due to the delay? Calculate rate in multiples of 0.0001. Very famous problem of cross rates. And now when you keep on practicing a particular problem, say 5 or 6 times, you get total control. So suppose you get the same problem in exam, so you get that that rhythm or momentum to solve the problem. Let us see how we do this. So we write by referring the given quotes, we identify that pound and dollars are the two required currencies. Now, quantum of dollar is given, $5 lakhs. Therefore, we need, since quantum of dollar is given, we need pound upon dollar quote. So the quantum currency will identify what quote you want. If quantum is dollar, dollar should be denominator, pound numerator. Quantum is pound, it will be opposite. So we need pound upon dollar quote. Now remember, you are an exporter, you're going to receive dollars. What are you going to do? You're going to sell. So since dollars received, what transaction you are going to do with the quantum currency? Quantum currency is dollar, and when we receive dollar, we are going to sell it. So when you sell it, which rate is applicable? Bid rate is applicable. So since dollar received will be sold, we need bid rate. Therefore, required quote and rate is pound upon dollar bid. So this is the required quote. This is how we have to arrive at what quote we need. Now you told the banker, that is the company told the banker, you send on 6th of June. But the banker sent on 10th of June. So by doing this trade late, has the company gained or lost? Let us find out. So what we have to do is, we have to find pound upon dollar bid for this date and pound upon dollar bid for this date. So I want to find, and then I will compare and finally write. But remember, in the end, we have to multiply by 5 lakhs, and that will give us the required answer. Now let us see, do we have pound upon dollar direct quote? We don't have. So therefore, I have to find cross rate of pound upon dollar. Now there are three quotes are given. So I will have 3 brackets. Now I want pound. How we can say this? And I want dollars. So here I will write dollars. Now see the code. Pound is linked to euro. So you write euro and euro. You can see they cancel out. You can see euro is linked to rupee. Euro is linked to rupee. And rupee is linked to dollars. So even they cancel out. So we will have to calculate like this. Since this is bid. This is bid. So I need bid everywhere. So I need bid this one. I need bid here. Here also I need that bid. Same way, I will be having pound upon euro bid into euro upon rupee bid into rupee upon dollar bid. Now one time I had to calculate using 6 June rates, other time I had to calculate using 10 June rate. So that will give me one rate of pound upon dollar. Now what is given to us? Let us see. If the given quotes are available, we use it directly. Else we use the inverse. So given, first one is $1 equal to rupees 75.2650 slash rupees 75.2700. Now this is your rupee upon dollar quote. So I'll write in a different ink. Second quote is 1 euro equal to rupees 84.1588, rupees 84.1599. This is standard unit currency is euro, it will come down. So this is rupee upon euro quote. Finally, 1 pound equal to euro 1.1225, euro 1.1250. This one is euro upon pound quote. Same way we'll be writing here. Now you need not write the notation form, you can simply write the quotes given. $1 equal to rupees 75.2550, rupees 75.2600, 1 euro equal to rupees 83.6906, rupees 83.7059, 1 pound equal to euro 1.1250 slash euro 1.1275. So when you actually copy down the data from the question paper, you have to be very careful, extremely alert, and speed should be low. Now we have done this, now we have to substitute here. Now we have to put a small tick if it is available and a cross if the required rates are not available. See, I need pound upon euro, but I have euro upon pound, so this is not available. So you put a cross, means we have to use inverse. Next, I need euro upon rupee, but we have rupee upon euro. Again, this is not available. I need rupee upon dollar, and rupee upon dollar is available, so put a tick. So only the last quote is available. The remaining two we have to take inverse, and when we take inverse of bid, we have to use the ask rate. So pound upon rupee, so I will be using the ask rate. So what you can do in the exam, you cannot highlight, so you can just put a small tick. Euro upon rupee I want, but I have rupee upon euro, so instead of bid I'll use ask. So I'll be using this. So you put a tick. And rupee upon dollar we have, so we'll use that. So bid I'll use, so I'll put a tick. Same thing will happen here. You need not do this exercise again because they are same quotes. So I can put a tick here. Now we'll write pound upon dollar bid is equal to, first one I don't have, so I put a cross. See, cross will tell me that I should take inverse. So 1 upon, so euro upon pound, 1.1250 into, next also I don't have, 1 upon rupee upon euro 84.1599. Next one I have, so rupee upon dollar 75.2650. In the exam you can do this calculation one below the other. I am having an objective to show you the difference I'm teaching, therefore I have put in the same screen left and right. You can do one below the other. Okay. Now on the same lines here also, pound upon dollar bid for 10th of June. 1 upon euro upon pound 1.1275 into 1 upon rupee upon euro 83.7059 into rupee upon dollar 75.2550. Now after you write down, you can do one small cancelling. You can see euro cancelling, rupee cancelling, and pound will go to the numerator. So pound upon dollar is what you get on right hand side, which matches with the left hand side. And see euro cancelling, rupee and rupee cancelling. So this will tell that you have written the quotes while taking inverse properly. Now therefore on 6th of June, pound upon dollar bid will be, now we are trying only the rate, let us calculate 75.2650 divided by 1.1250 divided by 84.1599 0.7949. Supposed to take only 4 decimals. Similarly 10th June, $75.2550 divided by 1.1275 divided by 83.7059 0.7974. Now you told the banker you sell on 6th June. The banker would have given you 7949, but banker did not sell and he sold at 7974. Means your company is having a benefit. So we can say that since sale rate on 10th June is greater than sale rate on 6th June, company benefits. The benefit will be equal to dollar given as 5 lakhs into pound upon dollar 0.7974 minus 0.7949. This will be equal to, now dollar will cancel and you will get the answer in pounds. Pound 0.7974 minus 0.7949 into 5 lakhs 1250 pound 1250. So this is the required answer. In this problem, what we have learned? In this problem, the dilemma in the beginning would be what quote we need, because only one of the two currencies, that is $5 lakh is given. So what is the other currency? So how we went about? We actually saw there were 3 quotes, and in the 3 quotes we cancelled the pair currencies, mean those appearing 2 times, and we were left with dollar and pound. So therefore we identify dollar and pound are the required currencies. From this statement of the first statement of the problem, we came to know that dollar is being received by the company. Means a client is sending dollars, but who is receiving? Therefore the UK company is receiving, and that's how we identified the 2 currencies, and that is the most critical part. The second one was to carefully write down the values given in the question, and this method is foolproof. We must first build the quote. After building the quote, this way of writing, if I have, I'll put a tick, I'll use same, then I will underline. You can see I have, so underline, or you can do this in the exam lightly. I don't have, so you can actually, you have to take inverse, you put a cross here. So some method you have to develop, otherwise there is a danger of using the other rate. So this you have to train your mind when you practice. Hope you understood this problem. Let us read this problem. You as a dealer of a bank has the following US dollar position. Opening balance credit with City New York 10,000. Opening oversold position 25,000. Then we are given 1, 2, 3, 4, 6 trades are given, or 6 transactions are provided. What steps would be taken for maintaining a credit balance of US dollar 30,000 in the nostro account and keeping the exchange currency position square? Very popular problem of nostro account reconciliation, which is very much in the syllabus. You can expect in the exam. Better that you practice a couple of problems. We already done some in the class, so this will also help you to revise the fundamentals. Let us see how we do this. Whenever a bank is opening a foreign currency account with counterparty bank, 2 accounts are maintained. One is the cash account, also called nostro account. Other is the exchange position account. What is the difference between these 2? Cash account will show all entries which are going to credit or debit instantaneously. Suppose bank is buying dollar in spot, it will affect cash account. Suppose bank is buying dollar in forward, it will not affect cash account. Suppose bank is issuing DD. Now DD will be given to somebody who will present it sometime later. It will not affect cash account. So all debit and credit that is going to instantaneously affect the account will be reported in cash account. Then the another account is exchange position account. Now exchange position will reveal to what extent bank has taken position in that currency. This will include all cash transactions also. Repeat, this will include all cash transactions also. Because when bank is dealing in cash, that is in spot market, there is an exposure to that currency. So exchange account will show all cash transactions also, apart from all forward transactions. There is one exception that we'll see when we do the problem. The format of presenting is like this. We write cash account and we write exchange position account. So we write in which currency? So figures in dollars. So figures in dollars. Particulars, debit, credit. That is the format of cash account. Particulars, purchases, sales, and net. We start with opening. So cash account opening, it is given as 10,000. So 10,000 credit. Opening oversold 25,000. Oversold. So I show in sales 25,000, but I put minus. Because here we are showing net, you have to put sign. So negative sign will tell it is a sold position. Plus will say it is a purchase position, like that. Overbought position or oversold position. Currently we are beginning with oversold position, minus 25,000. Let us pass the first entry. Sold a telegraphic transfer. Now selling a transfer, telegraphic transfer will instantaneously affect the account. So sold TT 1,50,000. Sold TT 1,50,000. 1,75,000. Issued a draft. You are issuing a draft. So it will not affect the cash account. It will affect only this account. Issued DD 20,000. TT remittance inward. So now TT inward. Inward means money is coming in. 1,25,000. So TT inward 1,25,000. Purchased an export bill. Now you are purchasing. It's like, one customer has exported goods to USA, and that person, that is the client of our customer, has accepted the bill that I will pay US dollar. And this particular bill, which has been accepted by the overseas client of our customer, is brought to our bank by our customer. Customer is coming and tell, please take this bill and realize dollar for me. So what do? You purchase the bill in your favor and keep it. So on the due date, you will realize it. So currently you will show in exchange position. So purchase bill. So this will be 75,000. Next, forward sales. So you have done some forward, as the name suggests, forward sales 75,000. Again minus 70,000. Export bill realize. So similarly, we purchased the bill sometime back. At that time we entered in the forward, that is exchange position account. And today I have realized the bill. So I will get instant cash. But I need not show this particular entry in exchange position because I have already, customer would have given the bill to me for one export bill. I would have accepted it. So I would have shown in exchange position. Days have passed. The bill is actually realized. Now it will come in cash account, but not in exchange account. So this is an exception where you are posting an entry in cash account, but it will not affect the exchange account. I repeat, let us see, 1/7/19. Bill due date is 1/12/19. Now, one customer has sold goods and is coming to me and giving me an export bill. Means our customer has sent goods to USA and our customer's client has accepted those goods and signed a bill, and that bill is brought by the customer to our bank. And what we have done, we have collected or purchased this bill. Say it is for $10,000. So I will show plus 10,000 in exchange account only. Why? Because the bill is due 1/12/19. So I have not received dollars, but I am going to receive dollars. So forward, I will show it in the forward, that is exchange position account under purchases. Now this has gone. Now 1/12 comes. On 1/12, my customer's client has paid dollars into my account. Why? Because I have purchased the bill, so credit will come to me. So there is an inflow in my account. So therefore my cash account will be credited, but not exchange account. Exchange account, nothing will happen. So this is a case where export bill realize where only cash account will be affected, but not the exchange account. So export bill realize, it is 25,000. So we do the total 150,000. This is 160,000. Therefore closing net credit 10,000. And this closing oversold 70,000. Or you can put minus, no problem. What steps would be taken to maintain credit balance of 30,000? Now I want this to be 30,000. How I can make it? I can buy spot. So when I buy spot 20,000, this account will be instantaneously affected. So buy spot 20,000. So when you do this, you get closing 30,000. But when you buy spot, even exchange account will be affected. So buy spot. This will become minus 50,000. Now it is given that maintain a credit balance of 30,000 in Nostok. So this is achieved. And keeping the exchange position square. Square means zero balance. So I want 0 here. So what I will do? I will purchase, forward purchase. So this will be forward purchase. So therefore this is square. So what you did? You bought spot 20,000. You bought forward 50,000. Remember, this has to be done first. Do cash account adjustment first. You should not do exchange position account. Do this first. Make it to the required level. When you do it here, you'll have to show it there. And then you do the net transaction in exchange. Because whatever happens in cash will happen in exchange. So first affect the entry in cash and then in exchange. So the correct answer is buy spot 20,000, buy forward 50,000. So both A and B. Hope you understood this. Let us see this problem. US dollar 10,000 is lying idle in your bank account. You are able to get the following quotes from the details. Dealer A, B and C. A is quoting euro by dollar. B is quoting euro upon GBP. C is quoting GBP upon dollar. Explore arbitrage gain from these quotes. Now since May 2003, if I am right, and then 2008 onwards, now triangular arbitrage was part of the syllabus but never asked. I always used to tell it is just, any time, any year is ripe for asking this problem, and they have asked this problem in November 2020. So the problem what you are seeing is from November 2020 question paper. You have to be very careful. I always tell that you must know which currency is more valuable. You can see the first quote, dealer A quote. It is given euro upon dollar. Now, and the next one is given euro upon GBP. So we know GBP is more valuable. Now I can't write dealer B quote as 1 GBP equal to euro 0.9094. That is wrong. So we should be understanding whether the notation given is reverse notation or normal notation. So here they asked the problem in a simple way, but the currency, the notations were reverse. So I told that November 2020 was entirely reverse problem. All problems are asked in a reverse way. So here they reversed the notation itself. So only general knowledge would have protected the students. Let us see how we do this triangular arbitrage problem. This problem was asked in November 2020. Again, for the first time, a problem on triangular arbitrage has come. Now, these were the problems which I used to do in the class and tell students that since they have not been asked any time, this can be the right time to ask. And all the problems, APV, interest rate swap, this triangular arbitrage, all these problems have come in same attempt, November 2020. So this was asked in November 2020, just for 4 marks. Now, as there was a twist in every question, even this question they had a twist in the form of a notation. So what is the quote? Let us write down first. Now they may print in any form, they may write inverse notation, but you should be writing the way it is. The first quote of dealer A is 1.1539. We know that euro is more valuable, so we write 1 euro equal to, always writing in equation form helps us to understand the quote. And once we write in equation form, we can actually write in notation form. Similarly, B, we know GBP is more valuable, so they are given 1 euro, pound 0.9094. So this will be pound upon euro quote. Then third, we know that GBP is more valuable than dollars. So $1, 1 pound equal to dollars 1.2752. So this is dollar upon pound quote. Remember when, so we can see that the notations, these are correct notations. All these are reversed in the question paper. So this was the trap. If you are not knowing which currency is more valuable, then you would not have understood the quote. Now they are asking, is there an opportunity to gain? Means they are asking to explore triangular arbitrage. Now when you do triangular arbitrage, you start with dollars because they are given $10,000 is lying idle. So currency on hand equal to $10,000. Remember, you have to start with dollar and end with dollars. Therefore, either dollar into, see, there are three quotes given, so we are going to write three quotes, and it has to end in dollar only. So let us write the first. We are having first quote euro dollar. So don't look at the given quote, just write in such a way that this particular thing cancels. Okay? This should cancel out. So you should be writing in such a manner. Similarly, next is pound. So we will be writing pound upon euro. You can see this is cancelling. Now we are having pound. So finally we will be writing dollar upon pound. So you can see that again this cancelling. So what is left? Dollar is left. So either this is beneficial, or now instead of euro upon dollar, I will start with pound upon dollar. You can see dollar is cancelling here, leaving pound. Now we have to convert to euro. So into euro upon pound. Now you can see this is cancelling, and finally we convert back to dollars. Dollar upon euro. This will result in dollar because now in the third leg euro is cancelling. So you can just see what is the difference. You can see here I have used, just see, the first quote is euro upon dollar. Here third quote is dollar upon euro. Here second quote is pound upon euro. Here second quote is euro upon pound. Just reverse, inverse. Here third quote is dollar upon pound, and here first quote is pound upon dollar. So we have to do, so either this is beneficial or this is beneficial. So one of the route is beneficial. Let us see which of these, and then we apply for $10,000. Okay, so we can call this as A route, and B route. So let us write, as per A, we have dollar. You can directly do with 10,000 also. So we can do that, and then we can say we have $10,000 into. Now we need euro upon dollar. But do we have euro upon dollar? No, we don't have. So 1 upon dollar upon euro. That is 1.1539. So if we have, we write it as it is. If we don't have, we write inverse. Now second, now what I'm doing, just see what I saw first. First I saw this. I wanted What I wanted euro upon dollar. What I'm having here, I'm having opposite. If you have, multiply. If you don't have, divide. So I divided. Now I'm going to look at number 2. What I want pound upon euro. Do I have pound upon euro? Yes, I have. So multiply into pound upon euro 0.9094 into, now third I want dollar upon pound. Do I have dollar upon pound? Yes, I have dollar upon pound. So straight away multiply into dollar upon pound 1.2752. So you can actually see this dollar is getting cancelled, euro is getting cancelled, pound is getting cancelled. So this will give us dollars. So I started with $10,000. Let us see where I am ending. So 10,000 divided by 1.1539 into 0.9094 into 1.275. So 10,049.98. Therefore, gains equal to $10,049.98 minus $10,000 equal to $49.98. Now in triangular arbitrage, if one route is beneficial, other will not be beneficial. So at this point you can say, therefore the answer is have dollars, convert to euro. That's what we did in step 1. Then convert to pounds, then reconvert to dollars. So here the answer ends. Now we want to see whether the opposite route gives us a loss. So that is for clarifying the concept, but it is not part of answer. So as per B, note, as per B, we have $10,000 into, in B what we have. Now the first one is pound upon, first one is pound upon dollar. Do we have that pound upon dollar? No, we don't have pound upon dollar. Next one is euro upon pound. Do you have euro upon pound? No, we don't have this. Next one is dollar upon euro. Do we have? Yes, we have. So when you have, multiply. When you don't have, divide. So let us do that. First one is pound upon dollar. We don't have that. So 1 upon dollar upon pound 1.2752 into, next also we don't have. So 1 upon pound upon euro, that is 0.9094, and last one we have dollar upon euro, that is 1.1539. Now again you can see that dollar cancel, pound is cancelling, euro is cancelling. This will give you dollars. So 10,000 divided by 1.2752 divided by 0.9094 into 1.1539. You are getting only $9950.27. Less than $10,000. Therefore, do not go for this route. This may not be part of answer because they are asking whether you can get any gains. Yes, I can get gains by this method. Okay, so it's a very simple problem, but just 4 marks. Okay, hope you understood this. Let us see the next part of Forex, that is Forex parity theorems. We have totally 4 formulae here. One is interest rate parity theorem. F upon S is equal to 1 plus RH 1 plus RF. S stands for home currency and F for foreign currency. Where we get this? We get this, both these, from spot rate. For example, 1 pound equal to rupees 89. Now suppose you have like this, then this is standard unit currency, so this becomes F, this becomes H. Suppose you have got like this, 1 pound equal to Singapore dollar 3. So again standard unit currency is pound, that will be F and it will be H. So standard unit will always be H. Just see, I am just changing the currencies. Standard unit will always be F. You see, I am writing now $1 equal to Australian dollar 1.3. Standard unit will be F. Okay, so look at the spot code, identify the standard unit, that will be F, remaining will be H. Now this is interest rate. Interest rate in H means interest rate in Australia. Interest rate in F means interest rate in US. So F and S will tell you where. So F upon S is equal to 1 plus RH upon 1 plus RF. This is interest rate parity theorem. Now, couple of things you must know from here. What I am going to do, just see, I am subtracting 1 from both sides. I can take LCM and write F minus S upon S is equal to 1 plus RH minus 1 plus RF upon 1 plus RF. F minus S upon S is equal to 1 will cancel, RH minus RF upon 1 plus RF. Now, RF will be say 4%, 2%, whatever it is, unless it is a very big percentage. So 1 plus RF will be generally very low, the low number. So I can write F minus S, it will be low number means it is 1.0203 like that. It will be approximately equal to RH minus RF, low number close to 1. So RH minus RF upon 1 will be approximately RH minus RF. Suppose you write 78 upon 1.02. Now what is 78 divided by 1.02? It is 76.47. It is close to like that. So what I'm trying to say is it will not be this much also. It will be 1 RH minus RF. So 10% minus 8% upon 1.02. So 2 upon 1.02. So when you do 2 upon 1.02, it is coming to 1.96. You can see it's very close to 2. Therefore, we write like this. So this particular formula is very useful to understand some concept. What is left hand side? Left hand side is formula for premium discount of currency. What is this? This is interest rate differential. So interest rate parity theorem states that forward premium or discount is approximately equal to differential of interest rates between the two countries. Suppose US interest rate is 2%, Indian interest rate is 6%, 6 minus 2 is 4%, then the premium of dollar with respect to rupee will be close to 4%. Why dollar will be premium? It depends on whose interest rate will be lower. See, that we can get from this analysis, what I'm going to show now. Take this. Suppose I write 75 upon 73 is equal to 1 plus RH upon 1 plus RF. Sorry, I wrote, yeah, correct. Now, this is 75, numerator is bigger number. Therefore, RH is greater than RF. Then only this equal to will be validated. So, when F, now this is F, S. When F is greater than S, when F is greater than S, RH has to be greater than RF, is it not? F greater than S means what? Dollar is at premium. Let us take $1 equal to 75 spot. Forward $1 equal to rupees 73. So we write 75 by 73 now. And we are having dollar quote. So dollar is at premium. Means what? RH is what? H is rupee. What is F? F is dollar. Now RH is greater than RF. Means what? Rupee interest rate is greater than dollar rate. So when dollar is quoting at premium, RF, that is dollar rate, will be lower. So whichever country's interest rate is at premium, then that country's interest rate will be lower. So you can see here that forward premium discount should be approximately equal to RH minus RF. Number 2, when the country's interest rate is lower, then that country's currency will be at premium, or vice versa. When the country's currency is at premium, then that country's rates are lower. These are the important thing. And then covered interest arbitrage, 2 problems are solved where everything is explained. You can go through that. Then we have purchasing power parity theorem. Purchasing power parity theorem, which states that expected spot rate upon spot rate. Expected means what? It is not forward rate. Expected, predicted, forecasted spot rate upon spot rate will be equal to 1 plus IH upon 1 plus IF. So again, H is home currency, F is foreign currency, which we get from spot rate. Standard unit currency will be your F. That is this one. Standard unit currency will be your F. Other currency will be H. So this is purchasing power parity theorem. One problem is solved, you can go through that. Then one gentleman Fisher gave 2 more formulae, which is explained in the formula section. It to be asked in last 20 years. I think you can rest assured they may not ask, but still you can see the formula section to learn. So we have just 4 formulae here. but covered interest arbitrage and relationship between forward premium and interest rate, they are important, and all problems are solved including PPP. You can go through that. Let us see the most important part of this chapter, that is covered interest arbitrage. I am deliberately taking after we have written the important formula in this chapter so that we can dedicate clear discussion on this covered interest arbitrage. Now this relates to disparity between interest rates and forward and spot. So we have got from interest rate parity, we have got from interest rate parity we have F upon S is equal to 1 plus interest rate in home country upon interest rate in foreign country. HF from where we get from spot rate. Remember, HF we already said from spot rate or given spot rate. Now the standard unit currency will be F. F will be standard unit currency. H will be other currency. Now ideally this should match. If they don't match, then arbitrage is possible. Okay, so if LHS equal to RHS, parity exists, else arbitrage opportunity exists. So when you get problems from this chapter, mainly from this section. In fact, I solved 2 problems. You can go through it. And what are the steps to be followed? Just follow the steps. Step number 1, verify IRP. So that is this formula. Are they equal or not? See, remember when they are giving an arbitrage problem for 8 marks, do you think first step it will be verified? Because if it is verified, no more answer is possible. Arbitrage not possible. So for that purpose, they will not give 8 marks. That is common sense. Rest apart, you should verify. Now sometimes you have to be very careful. Now remember when you are writing this, if it is a 3 month, suppose for 3 months how you write? See, for 3 months we write like this: 1 plus RH into 3 upon 12 you should write. Remember, 1 plus RF into 3 upon 12. Many students make simple mistake. They are seeing clearly it is printed 3-month forward rate, so they will give 3-month forward rate, they will give spot rate, they will give interest rate. Interest rate will be per annum, but since it is a 3-month forward rate, we must write into 3 upon 12. So this mistake you should not be doing. Suppose you don't use 3 upon 12, if it matches, you know arbitrage. How it is possible? So verify IRP. So then you should write it is not possible. Then find LHS. Now this equation, just I am just removing these things. Now this equation, now this will go here. If it goes here, then what we have? LHS equal to F upon S 1 plus RF, RHS equal to 1 plus RH, that is this. So I am going to split the equation in this manner and I am going to find the value. And I am going to find the value. Suppose X, Y. If X less than Y, means left hand side is lower. Now lower is which part is lower? You can see F is lower. So borrow F, deposit H. But if the other one is if X greater than Y, always borrow at lower rate. So you will write borrow H, deposit F. This is a crucial step of the problem. So carefully calculate. Again, if it is a 3 month, then you will do into 3 by 12. 1 plus RF into 3 by 12. Remember, 1 plus RH into 3 by 12, like that. So you see problem solved, you can understand. So here in this step, you identify which currency to borrow, which currency to deposit. Then you write the arbitrary step. Write steps. So borrow H. See, let us assume that we are borrowing F. Assume that we are doing. So example, borrow F for 3 months. Then convert to H in spot. Then deposit H for 3 months. Then reconvert to F. Repay foreign currency borrowing. Balance gains. So you have to write the steps. So when you see the example, you'll understand how to write the step with the values, because I don't have a specific problem here. I am writing a skeleton format, that's all. So you write this step. Now in May 16 examination, many of the students did the problem correctly. Everything perfect, answer correct, not a single decimal mistake, got 0 mark. Why? They did not write this step. So this step is very important, compulsory to write. Then D, show calculation and prove gains. Okay. Step number 1, verify parity. Step number 2, identify currency to borrow. Step number 3, write the steps. Step number 4, show calculations. I repeat, step number 1, verify parity. Parity will generally not be there. Step number 2, B, identify which currency you should borrow. Step number 3, write the steps. You borrow pound, convert to dollars, deposit dollars, reconvert to pounds, repay pound borrowing, balance gains, like that. Remember, whichever currency you borrow, gains will be in that currency. Suppose I am borrowing F. Answer, gains will be in F. These are small things you must remember. Suppose I am borrowing dollars. Gain will be in dollars. Suppose I am borrowing pounds. Gain will be in pound, like that. So you have to show calculation and prove gains. And this is about your covered interest arbitrage concept. So when you go through problems, in fact 2 of them I solved, you will understand how to present the solution. Very commonly asked. And the concept method is there for identifying currency, that is this part. I strongly advise not to use that, because sometimes they will give inverse rate and all those things. The method B, which is presented here, is absolutely the best method. In case transaction costs are there, remember transaction costs. Now suppose it can be that there are dollar and pound, two currencies are there in this problem. Assume that, just make note of this. Suppose I have to borrow dollars and gain will be in dollars. So this will suit US trader, because for borrowing dollar means it is US is currency, and you get gain in dollar is currency, no problem. But what will happen if the other currency is pound and that UK trader wants to do? Now still he will do this, and when he goes to reconvert, he will reconvert only that many part to repay this F. Okay, this I don't think they will ask, but still you can look at that. According to me, it has never been asked. Second thing is transaction cost. If US based trader is doing, then transaction cost will be paid in dollars. Remember, he is a US based investor. You can't tell him to pay foreign currency brokerage. So he will pay transaction cost in his own currency. For that purpose, you have to calculate in home currency only. Let us take an example. Assume that it is like this: borrow $10,000 for 3 months at the rate of 10%. So he has to pay 10,250 after 3 months. The 10% is 1,000 rupees, $1,000. 1/4, 3 months means 1/4, $250. So he will convert to say pounds. Suppose he is going to convert to pounds. Assume that this comes to, assume that we have $1 equal to pound 0.75. So this will be pound 7,500. And then he will deposit for 3 months, say at the rate of 8%. So it will be 7,500 into 1.02, 7650. So this will be pound 7650. Now this will be reconverted. Assume that on this day $1 is equal to pounds 'll take that rate so that we have some gains. Therefore, I'm just calculating. It is 7. Assume that it is 0.72. Then what will happen is this will be converted 7650 divided by 0.72. This will come to dollars. Now remember, this is pound and this is pound upon dollar. So you will get dollars 7650 divided by 0.72. This will be $10,625. So you have a gains of $325. right now. Dollar 375. So we have dollars 375 as gains. Now assume that this transaction done by US based trader. So then in this market, the US based trader will pay brokerage on $10,000, and in this market he will pay brokerage on $10,625. If the UK based trader is doing the deal, he will pay in this leg on $7,500, and here you have to repay 10,250. So he will not convert entire thing. He will convert only $10,250 upon, or sorry, into pound upon dollar 0.72. So 10,250 into 0.72, 7380. So this will be pound 7380. So he will convert only pound 7380 and repay the dollar borrowing. Remaining balance will be taken as profit. Balance as gains, that is 7650 minus 7380. 270, pound 270 will be taken as gains. I repeat, remember, if you do the arbitrage, you are borrowing dollars, gains in dollars. But if UK trader wants to do, then he is not happy with dollar gains. He wants pound gains. So what he will do, he will still do these activities: borrow, to repay, then convert, get pound, deposit. He will receive this also. But here he will convert only 7380 pounds and make it 10,250 and repay this. And the balance which will be there, that will be 7650 minus this equal to 270, that he will pocket. Then transaction cost will be calculated on $7,500, sorry, pound 7,500 and pound 7,380, because he is converting only pound 7380. So this is all about covered interest arbitrage. 2 problems are dedicated solved. Please go through that. You will get total clarity. Let us now see formulae, exactly 4 of them, in the chapter of parity theorem. The first one is interest rate parity theorem, where you are finding forward rate, which is theoretical forward rate. The rate quoted by the banker is the actual forward rate. This is the theoretical forward rate. Now, how you calculate theoretical forward rate? You are actually substituting interest rates of the 2 countries. Now, suppose I write $1 equal to rupees 75. The standard unit currency is your F. I repeat, the standard unit currency is your F. The other currency is your H. F for foreign, H for home. But do not link with that. Just understand, standard unit currency is F. Because foreign and home will change depending upon who is looking at the quote. So let us not get confused. Standard unit currency is F. Other currency is H. So I will get RF. Now in this case, it will be our interest rate in US. In this case, it will be RH is interest rate in India. So we can see that we identify RH and RF from the spot quote given. From spot. So in the spot rate, given spot rate, Identify standard unit currency, that will be F. Identify the other currency, that will be H. And then substitute RH and RF, substitute the spot rate, you will get theoretical forward rate. And this can be different from actual forward rate. And when they are different, we do arbitrage. So we have solved problems in the class, and you have in the revision video problem of covered interest arbitrage. Now this verifies parity. When I say verifies parity, parity means equality. You are able to see equal to sign. Left hand side is F upon S. Right hand side is 1 plus RH upon 1 plus RF. So before you proceed to do arbitrage, you must verify whether parity is existing. If there is no parity, then only arbitrage is possible. And if there is parity, then arbitrage is not possible. Similar to interest rate parity formula, we have purchasing power parity formula. Here, please see, we are not having forward rate. We are having expected spot rate. What is the likely spot rate? And that is what is answered by purchasing power parity theorem. What is the likely spot rate 3 months from now, 1 year from now? Usually they will give 1 year from now because inflation. So instead of interest rate, we have inflation. Same here also, H and F is identified from the spot rate. So HF, we have to look at the spot rate. Identify, substitute the inflation values, and using spot rate, S0 means today's rate. ST means rate in future and time T. So interest rate parity theorem will give you forward rate. Purchasing power parity theorem will give you expected spot rate. You have to understand this. You should not be writing oppositely. It will ruin the concept. Then Fisher, some books also refer as FISHER, has given two formulae to the world. One formula links interest rate, that is right hand side of your interest rate parity theorem and right hand side of your purchasing power parity theorem. He says they are equal. And another formula he has provided where left hand side of purchasing power parity theorem and right hand side of interest rate parity theorem, even they are equal. Now these two formulas have never been asked in the exam, but it's better to glance, and these two problems have come very frequently. So these are the only 4 formulae in this chapter. Let us go to the next chapter. Let us read this problem. It is given that spot rates are $1 equal to rupees 74.532 slash 75.4143, and the 6-month forward rates $1 equal to rupees 75.1278 slash 76.1684. Making appropriate assumptions and using ask rates for calculations, comment on the US and Indian interest rates. This pure concept from interest rate parity theorem, the linkage between interest rates and forward premium, and they have indirectly hinted that you should use ask rates. So let us see how to solve this problem. Now what does interest rate parity theorem states? It states that when a country's interest rate is lower, when a country's interest rate is lower, then that country's currency quotes at premium in the market, in the forward market. Suppose we compare India and US. If US has lower interest rates than India, then US currency dollar will quote at premium against rupees in the forward market. So in this problem, they have given us forward rates and spot rates, and we will use the formula percentage premium slash discount is equal to F minus S upon S into 12 upon N into 100. Now which quote we are having? We are having dollar quote. So spot $1. We are having dollar quote means the currency that is expressed in standard unit in the quote is dollars. What is standard unit? 100,000. So 1 is associated with dollars in the quote. So therefore dollar is the standard unit currency. So therefore it is a dollar quote. So spot $1 equal to rupees 74.5320, 75.4143, 6 month, $1 equal to rupees 75.1278, 76.1684, and we have been told clearly to use ask rates. So this is our F and this is our S. So we substitute in the formula. So let us calculate 76.1684 minus 75.4143, 25.2%. So we are getting the answer plus 2%. So which is quoting at 2% premium? Therefore dollar whose quote is given to us is quoting at 2% premium in the forward market. So dollar is quoting at 2% premium. Therefore interest rate in US, is lower by 2%. This is based on assumptions of this based on concept. Can write down this based on the concept of interest rate parity theorem. and this we have stated in the beginning. So interest rate is lower because currency dollar is at premium. When currency dollar is at premium, then the country to which the currency belongs will have the same quantum, that is 2% lower interest rate. So dollar premium, therefore dollar interest rates are lower. So the correct answer is the dollar interest rate is lower as compared to Indian interest rate. Hope you understood this. Let us read this problem. Suppose that the current spot exchange rate is euro 1.12 per pound and the 180-day forward exchange rate is euro 1.15 per pound. The 1-year interest rate is 4% in euros and 3.5% in pounds. You can borrow at most euro 1 million or the equivalent pound amount, that is pound 892,857 at the current spot exchange rate. Examine covered interest arbitrage for euro based investor. So this is a classic problem involving IRP and arbitrage arising from disparity. Whenever there is parity, we cannot do arbitrage, but whenever there is disparity or whenever the parity doesn't hold, we can do arbitrage. Let us see how we do this. Using interest rate parity theorem formula, forward upon spot is equal to 1 plus RH 1 plus RF. Now theoretical forward rate should be equal to S 1 plus RH upon 1 plus RF. Theoretically forward rate should be this. Whenever theoretical rate is not matching this, then we have an arbitrage opportunity, and while doing arbitrage we protect or cover our trade by booking a forward contract. Therefore it is called covered interest arbitrage. Now how we propose to do this problem? The first step is you have to identify the home currency and foreign currency from the given spot rate. Now let us see what is this spot rate given. Now spot is 1 pound equal to euro 1.12. The standard unit currency is our F. Standard unit means 100, 1000, etc. For 99% of the codes we have 1, so that 1 is F. So this F is our pound because 1 pound. So wherever we have that 1, that is our F. Then the remaining H is euro. So this RH will be euro rate. RH will be R of euro, and that is given as 4%. And F is pound. So R of F is same as R of pounds. That is given as 3.5%. And we are also given 180-day forward, 1 pound equal to euro 1.15. Now these are the facts given. Now we have to first verify whether this holds good. If it holds good, then LHS equal to RHS means parity exists, because interest rate parity theorem states that F upon S, which is our LHS, should be equal to 1 plus RH upon 1 plus RF, which is our RHS. So if they match, then there is parity, no arbitrage is possible. So we have to first verify that. Step 1, verify parity. So F upon S, is it equal to 1 plus RH upon 1 plus RF, 1.15 upon 1.12, is it equal to 1 plus 0. Now you can see RH is 4%, 0.04 into 180 upon 360. So we assume 1 year equal to 360 days. Why 360? Because we have got 180. Days are in multiples of 30. Whenever days are in multiples of 30 and nothing is stated in the question, we can safely allow or assume 1 year equal to 360 days for mathematical convenience. And this will be divided by 1 plus 0.035 into 180 upon 360. LHS is 1.027. RHS is 1.0025. So they are not equal. Therefore, parity does not exist. Therefore, arbitrage is possible. Now, it is clear that we can do some arbitrage. But which currency to borrow? Because we have to borrow one of the two currencies, euro or pound. That is our step 2. Now in step 2 we will write, or we will find out which currency to borrow. For that there are two methods. The best method is this one. So method 1, recommended method. We have to simply find LHS equal to F upon S 1 plus RF. See how we have got this? F upon S is equal to 1 plus RH upon 1 plus RF. So I take this here. So then it becomes F upon S 1 plus RF and equal to 1 plus RH. So I calculate this and I calculate this. By calculating this, we can easily identify which currency to borrow. Very easy, very mechanical, very quick. Let us see what we get. 1.15 upon 1.12, 1 plus 0.035 into 180 upon 360. This will give 1.045. RHS is 1 plus RH equal to 1 plus 0.04 into 180 by 360 is equal to 1.02. So we can find that RHS is lower. Now, once you know RHS is lower, you have to link to the interest rate. Now, RHS term, the interest rate term is this. In LHS term, the interest rate term is this. But which is lower? RHS is lower. Therefore, this is lower. What is this? H, we have identified here. H is euro. So RS side is lower and H is euro. Therefore, borrow H, that is euro, at RH rate. So we have quickly found out which currency you have to borrow, and that is, the main crux of the problem, or we can say it is the main crux part of the entire solution. Now this is method number 1. Method number 2 is not reliable because sometimes quotes are given inverse, sometimes currency may quote a discount, and it becomes a challenge, and it consumes a lot of time to find out which currency to borrow. Anyway, I am doing in this method 2 the conceptual route. Now we have pound quote. How we know? Because it is given 1 pound spot, 1 pound equal to euro 1.12, 180-day forward, 1 pound equal to euro 1.15. So the standard unit currency is pound. Therefore, we have pound quote. And see, and forward greater than spot. And see, 1.15 is greater than 1.12. Therefore, pound is a premium. Percentage pound premium. So we have to find out the premium of the currency. So whatever quote is given, we have to find out the premium. Remember, if we are having a discount, if the forward is less than spot, then you have to take the inverse and then calculate premium. So therefore, this method I don't suggest. Anyway, so pound premium in this case, 1.15 minus 1.12 upon 1.12 into 360 upon 180 into 100 equal to plus 5.36%. Now this you have to compare with RH minus RF, which is 4% minus 3.5% equal to plus 0.5%. Therefore, pound premium is greater than interest rate differential. Now, whenever something is at premium, what we do? Now, suppose I am a businessman. This product is worth 10 rupees, but it trading in the market is 16 rupees. What I will do? I will sell. Same way, here the currency pound is at premium in the forward market. In the 180-day forward market, this pound is at premium. So in forward market, I must sell pound. So our activity should be that we must be selling pound in forward market. If I have to sell pound in the forward market, I must be having pound that day. So if I want to have pound that day, today, that is 180 days before that date, today I have to deposit pound. Now if I have to deposit pound, I must borrow euro and convert to pound, because it is given that euro based investor. So the euro based investor, what he will do, he will borrow euro and then convert to pound in spot, deposit pound, and then get the deposit proceeds of pound, and he will sell pound forward, and he will earn this 5.36%. So he will earn 5.36%, which is greater than 0.5% interest rate differential. Therefore, there will be arbitrage profit. So since pound, therefore pound premium greater than interest rate differential, therefore sell pounds forward. Therefore borrow opposite currency. Therefore borrow euro today. So you can see this is the roundabout way of knowing. The biggest challenge will be if they give currency quote in discount, means forward rate is lower, then you have to convert everything into inverse, then you have to take RH, RF again, and it becomes a big mess. It becomes a challenge. So our method one is highly reliable, followed by many universities in the world. I'm not talking about India. Many courses. Simple method, just do that. So we have identified in both the cases that we have to borrow euro. Step number 3. So what we do is we borrow euro, and they have given the amount 1 million today. Remember, we are having 180-day forward rate. So we have to borrow euro today for 180 days. This step number 3 is compulsory. In May 2016 exam, many did not write this step, though they got the final answer correct. They got 0 marks. So this you have to explain what you are going to do. You are going to borrow for 180 days. Then what you are going to do? You are going to convert pound at spot rate. Then what are you going to do? You are going to deposit pound, because I want to sell pound in forward market. So deposit pounds today at 3.5% for 180 days. So borrow for 180 days, deposit for 180 days. So you can write here borrow today at 4%. Then next what you do? After deposit you will get the proceeds. Sell pound proceeds in 180-day forward market. Repay, and you can write down get euro. Repay euro borrowing and realize the balance as arbitrage profit. So this activity need to be written. So borrow euro 1 million at 4% for 180 days, convert to pound at spot, deposit pound today at 3.5% for 180 days, sell pound proceeds in 180-day forward market, get euros, and finally repay euro borrowing. And whatever is left is your profit. Step 4, we have to show the working. I always prefer this method one of the most reliable method where you don't miss a single step. So what we do is we borrow euro 1 million for 180 days at 4%. So you have to repay how much? Into 1 plus 4% into 180 upon 360. This will be euro. So you have to repay this much euro after 180 days. After you borrow euro, immediately you'll go to spot market. Sell euros at spot. That is 1.12. 1.12 pound upon euro. So you can see euro you can see this, the currencies, they should cancel, then only you will get the answer in pound. Get pound. We are given, sorry, this should be, it is not, it is euro upon pound. So now you can see it is getting cancelled and we get pound. At this point we can do one small check. I am having euros. What is a quote? What is the standard unit currency? Pound. I am having euro. Standard unit currency is pound. It is not same. Divide. I am having euro. Standard unit currency is euro. Multiply. Now this helped me to find out that okay, I should have divided. So immediately I corrected it. So this cross verification always helps. So here I have pound. Pound is a standard unit. So it is a pound quote. But I am having euro funds. Euro fund, pound quote. Divide. So when I divide, euro gets cancelled and I'm getting pound. Get pound. $892,857. So what we do is we deposit for 180 days at the rate of 3.5%. So what we get? Pound 892,857 1 plus 0.035 into 180 upon 360. So you will be getting 908482. So 908482 pounds you will be getting at the end of 6 months. So what we are going to do, we are going to sell these pounds in the foreign market, get euro, so that I can repay euro borrowing. So sell pound 908482. So how many euros you will get? Now we are having pound in hand at the end of 6 months and I am having pound quote. So having pound in hand, having pound quote, multiply. So euro upon pound 1.15. So this will give euro 908482 into 1.15 1044754. Now how much I have to repay? I have to repay this much. How much I will be getting at the end of 6 months? I will be getting this much. So since I am having more than what I had to pay, there will be arbitrage profit. Working note 1. So this you can show here. Euro to be paid at the end of 180 days. Euros received from arbitrage operation therefore arbitrage profit you can just call it as A and B minus A, that will be euro 24754. So the euro based investor will be getting a profit of euros 24754. So this is a problem of covered interest arbitrage. Step number 1, verify interest rate parity theorem. Step number 2, identify which currency to borrow if parity does not exist. Step number 3, write down all the steps. Step number 4, show the calculations. In step number 2, that is identify currency to borrow, we have two methods. Method 1, simple mechanical formula method, highly reliable. Let it be inverse code, discount code, don't bother, straight away use that, you will get the answer. But method 2 is a conceptual method where it will be a challenge whenever currency codes are given in the discount way or discount form, or inverse codes are given. It becomes a big challenge. So I would never suggest to use method 2, though I have solved it for knowledge purpose. Hope you understood this. Let us see this problem. The following information is given. Spot $1 equal to rupees 64.0123. 180-day forward rate $1 equal to rupees 64.9120. Annualized interest rate for 6 months rupee 12%, and annualized interest rate for 6 months $8%. On 1000 units of relevant currency, calculate the optimum covered interest arbitrage gains or losses. So generally when we solve arbitrage problem, we will perform arbitrage only if it is giving us gains. So though they will say gains or losses, you must always project or show that particular operation which will result in gains. Let us see how we solve this. So let us write down the information that is given. The information that is given will be $1, this is spot, 64.0123. Now you can see that standard unit currency is dollars. Therefore, this is your F, and other currency is rupee. This is your H. Now they have given 6-month forward, or what we call as 180-day forward. $1 equal to rupee 64.9120. Now RF, that is dollars, 8% per annum. RH, that is rupee rate, 12% per annum. Now using this information, we have to demonstrate arbitrage, if at all it exists. Now what does interest rate parity theorem says? Interest rate parity theorem says that F upon S should be equal to 1 plus RH upon 1 plus RF. If this LHS equal to RHS, that is F upon S equal to 1 plus RH upon 1 plus RF, then no arbitrage is possible because parity or equality exists. So this is going to be our step 1 for us. Step 1, verify parity. So I substitute for F. So this is our F. This is our S. So 64.9120 divided by 64.0123, is it equal to, now remember it is 180 days, you have to be very careful. So it is half year given. So now 1 plus RH. So 1 plus 12% into 180 upon 360. 1 plus 8% into 180 upon 360. So here we write, assume 1 year equal to 360 days. So we have to write this. Suppose they give 182 days or like that, we can write 365. But when they give in multiple of 30 days, you have every right to assume 1 year equal to 360 days, unless otherwise they have given something in the question. Now this will be, so let us calculate. The LHS will be equal to 64.912 divided by 64.0123, 1.014. So this is 1.014, and the right hand side is 1.06 divided by 1.04, 1.019. They are not equal, therefore parity does not exist. Therefore arbitrage possible. Step 2. Now how will you do arbitrage? Which currency you will borrow? Now we can actually use our master formula, which involves calculating LHS equal to F upon S 1 plus RF. and calculating RHS equal to 1 plus RH. You can just see, if I rearrange this, I can write F upon S 1 plus RF equal to 1 plus RH. So this is our left hand side here, and this is our right hand side here. We know they are not equal, but this will tell which currency to borrow. Let us see how. So this will be equal to 64.9120 divided by 64.0123 into 1 plus 8% into 180 by 360. So this will be equal to, so let us calculate. $1.055, and this will be 1.06. Because this you can write 1 plus 12% into 180 by 360. So we are getting 1.05 and 1.06. So which side is lower? Left hand side is lower. Now in left hand side, which interest rate is there? In left hand side, we have interest rate this one. Which is a currency? Currency is F. What is F? That is dollars. Since left hand side is lower, it is associated with RF, that is dollars. Therefore, borrowing dollar is better. Why? It is lower. So whenever the rate is lower, you borrow. Since LHS is lower, borrowing at RF, that is borrowing dollars, is beneficial. So step number 1 was verify parity. Step number 2 is identify which currency to borrow. So we have decided that we should borrow dollars. Now let us proceed. Step number 3, write the process. So what you are going to do? Remember, arbitrager does not use his own money. So he is going to borrow dollars. Step number 1, borrow dollars, and in the question it is given use 1000 units. So borrow $1000. For what period? Now remember, we are given 180-day forward rate. So for 180 days. At what rate? At 8% per annum. So he will borrow this, and therefore he will take upon himself an obligation to repay borrowed dollars at the end of 180 days. So this is step number 1. After borrowing, what he will do? He will convert to other currency. Which is the other currency in the problem? Rupee. So he will convert to rupee at spot. After converting, he will have rupees in hand. What he will do? He will deposit. Remember, borrow. Opposite is deposit. So he will deposit rupee available from sale. Available from sale of dollars. For how many days? For 180 days. At what rate? At 12% per annum. So you'll borrow dollars. After borrowing, sell, get rupee, deposit for 180 days at 12%. After 180 days, what happens? After 180 days, rupee proceeds will be sold. After 180 days, rupee deposit proceeds. So you will get deposit proceeds of rupee will be sold in which market? In 180-day forward market. In 180-day forward market. After selling, what you will get? You will get dollars. The dollars obtained will be used to repay dollar borrowing, and the balance will be used arbitrage profit. You can write balance will be arbitrage profit. Now writing this is compulsory. If you don't write this, you'll get 0 marks. Suppose you don't write it, directly show the table or draw the diagram, etc. You will not get any mark. So you have to explain what you have done. So in step 1, we verified parity. Step 2, we found out which currency to borrow. Step 3, we write the process. Borrow dollars, therefore obligation to repay after 180 days. Sell borrowed dollars, get rupee. Deposit rupee for 180 days. Then get deposit proceeds of rupee. Sell in forward market. Get dollars. Use dollars to repay original borrowing. Balance will be arbitrage profit. Step 4. Let us draw the diagram. This diagram is the best way to project the entire solution. And it is not without reason that many of the world textbooks use this diagrammatic method to explain covered interest arbitrage. There is very less chance you will make an error. You can write one below the other. You will get full marks also if it is correct. But there is a possibility that you can make error. Mostly you forget to charge interest on borrowing. So therefore we follow this method. Borrow dollars 1,000 for 180 day at 8%. So when you borrow that, you will have to pay 8% is 80 for 1 year. You have to 180 days, so you have to repay $1040. After you borrow dollars, sell $1,000 in spot. How much you will get? $1,000 into rupee upon dollar. What is the spot rate given? 64.0123. Dollar cancels. So you get rupees 64012.30. So when you sell, you get this much rupees. What do you do? You deposit this for 180 days at 12%. So then you will get rupees. So when you deposit this, you will get 67 853.04. You can verify this once again. 64012.3 into 1.06, 67853.038. So you can write 04. So you get this many rupees. So what do? Sell forward. Sell in forward market. So what do you get? So we get rupees 67853.04 into, so this is rupee. So 1 upon rupee upon dollar 64.912. So we get dollars. How much? We calculate this divided by 64.912. 1045.31. So we can see that I have to repay $1040, but I'm having 1045.31 at the end of 180 days. Therefore, arbitrage profit is equal to $1045.31 minus $1040, and right at the end of 180 days. $5.31. So you will end up with a arbitrage profit of $5.31. So which are the 4 steps you have to do in this problem? Number 1, verify parity. Number 2, once parity is not established, arbitrage is possible. In step number 2, you identify which currency to borrow. Step number 3, write the process. Step number 4, show this particular calculation. Hope you understood this. Let us read this problem. The current spot rate of Indian rupee is $0.013245. India is reporting 3% inflation per annum and the US is reporting 1% inflation per annum. Assuming purchasing power parity theorem holds good, calculate the expected spot rate of dollars at the end of year 3. Very popular problem of institute. They have asked this many times, not more than 4 marks though, but still important. Let us see how we do this. Now, what is purchasing power parity theorem and what does it state and what does it, how does it help? So purchasing power parity theorem will give you this formula. Suppose I write expected spot rate at time t, E for expected, T for time, divided by spot rate is given by 1 plus inflation in home country upon 1 plus inflation in foreign country. Now What is H and F? H home country, F foreign country. From where we get? We get from spot rate. And what is the spot rate that is given to us? It is given that 1 rupee equal to dollars 0.013245. The standard unit currency is rupees. So this rupee is F. The other currency is dollar, and dollar is your H. So IF, that is inflation in India, is 3%. Inflation in US is 1%. So from the spot rate we get H and F. So we have got this too. And we know this. Now this is inflation per annum. So using today's rate, we can calculate next year's spot rate. And using next year's spot rate, we can find spot rate 2 years from now. And using that spot rate 2 years from now, we can calculate spot rate 3 years from now. And number 2, if we are using rupee rate, we can get spot rate of rupee only. So what we are going to do, we are going to use today's rate and first calculate spot rate 1 year from now. Why only 1 year? Because inflation is for 1 year. So 1 year inflation will give you expected spot rate at the end of 1 year. So we write S expected 1 year from now upon S is equal to 1 plus IH upon 1 plus IF. Expected spot rate 1 will be equal to 1.01 upon 1.03 into 0.013245. Remember, they have given 6 decimals for spot rate, so therefore you can work in 6 decimals. So this will be equal to 0.013245 into 1.01 divided by 1.03. This will be 0.012,988. So I have taken 6 decimals. Now similarly I can calculate S2E using S1E. 1 plus IH, 1 plus IF. Therefore S2E will be equal to 1.01 upon 1.03, 0.012988. We have to erase the value appearing in the calculator and use the correct 6 decimals. 0.0112988 into 1.01 divided by 1.03 will give you 0.012736. Similarly, you can calculate S3E using S2E is equal to 1 plus IH upon 1 plus IF. This will be SE3 will be equal to 1.01 upon 1.03 into 0.012736. Again, remove the number appearing in calculator and type 0.012736 into 1.01 divided by 1.03. that will give you 0.01 to 489, 0.012 489. Now this is the expected spot rate of rupee. So therefore expected spot rate of rupee will be this. But they are not asking of rupee. They are asking expected spot rate of dollars. Therefore, taking inverse, you get SE3, $1 equal to rupee 1 upon 0.01 to 489. So we take inverse of that. 1 divided by 0.012,489, 80.07, 80.0705. So 80.0705. In case, now this is how you will present in the exam. You can't use infinite decimal. Of the given answers, this answer has given you 80.0705 because you used 6 decimals exact. In case you do by second method, the answer that is printed will be matching. Let us see what is that method. So this is the correct way you must present in the exam. You should not be taking infinite decimal appearing in the calculator. But the answer can also be arrived at like this. SE3 upon SE2 is equal to 1 plus IH upon 1 plus IF. Now what is SE2? Now SE2 is, we have written here, just I'll write down all the three, just see here. What I'm going to do is, I am going to substitute this here, then I am going to substitute this here. So what will happen is, you will be getting like this, SE3 will be equal to S into 1 plus IH upon 1 plus IF the whole cube. This will be equal to 0.012345, 13245 into 1.01 cube upon 1.03 cube. So when we do this in calculator, 0.013245 into 1.01 into 1.01 into 1.01 divided by 1.03 divided by 1.03 divided by 1.03, we get 0.012488. Taking inverse, we get $1 equal to rupee 1 upon 0.012488 80.0747 equal to 80.0747. So when we do not round off at every step, you will get. The very purpose of showing you this is you need not worry about those final decimal differences which you get in answer, especially when you have carefully rounded off at each step and shown correct formula, correct substitution, and most importantly correct calculation. Marginal differences would come depend on how the person has stored the values. In case you had truncated the decimal from 6 to 4, then you would have got some other answer. So, but according to me, the best answer would be this. But you have seen one thing, you will not be getting any other answer than 80.07. So, I would request you to follow this method where I have rounded off to 6 decimal. Why 6? Because they have given 6 decimal. So I have adopted 6 decimal throughout. And finally, when I wanted to calculate dollar rate, I had truncated to 4 decimals and written the final answer. So the correct answer is 80.07 or 80.0747. So hope you understood this. Okay, let us see the last part of Forex that consists of hedging majorly, and it consists of some other topics. Now, first of all, hedging has the same meaning as what we have learned under derivative section. Hedging is to protect the value of whatever you are holding. Now, in the case of Forex, there are two broad categories: foreign exchange, hedging. Now you hedge your receivable or payable. Now receivable, what is the meaning we have in a balance sheet? Now what we are going to receive. So if we draw a balance sheet and we find an entry receivable, accounts receivable in the current assets part, what is the meaning? The meaning is we are going to receive over the next 1 year. So here receivable means we are talking of foreign currency receivable. Similarly, foreign currency payable. So if we have a foreign currency receivable, it is in the nature of outstanding asset, because we are going to receive foreign currency, not today, sometime later. Similarly, foreign currency payable means outstanding liability. Now when you hedge, you create a hedge by making outstanding liability. Now what happens is, when you create outstanding liability and when foreign currency changes, this asset and liability, asset you are already having because you are going to receive foreign currency, liability you have created, that is a hedge. So whenever foreign currency changes, the asset and liability will move in opposite direction and they will cancel off. As a result, your value, whatever you are going to receive, is protected. Same way here also you create outstanding asset. So if you are having a receivable, you create using derivatives outstanding liability. So which are the derivatives we can use? We will use forwards, foreign currency forwards. These are all foreign currency. We can use futures. foreign currency futures, we can use options. So this asset or liability we can create using foreign currency forward, futures or options. Now we can also use DC, that is our own currency, in the case of futures and options. So there are 5 methods of hedging. Number 1, create foreign currency forward, create foreign currency futures, or create domestic currency futures. Suppose Indian company is hedging, then domestic currency future is rupee future. American company is hedging, domestic currency future is dollar future. Okay. Number 4, foreign currency option. Number 5, domestic currency option. So there are 5 methods of hedging as far as foreign exchange is concerned. These 5 methods of hedging, so we are going to write down what we are actually going to do. Had it been a regular class, we could actually elaborate at length and talk for 1.5 hours, everything. But now with this being a rapid vision course, and assuming that students know, even if they don't know, whatever table I am going to make, that table should be remembered. So we are going to see how we are going to hedge receivable, when I say receivable, it is foreign currency, and foreign currency payable. So what we are going to do to hedge? Now we are written here, if we are going to use foreign currency forward, if we are going to use foreign currency forward, we will sell forward, sell FC forward to hedge FC receivable. So whenever they give you a problem of receivable, and if it is a foreign currency receivable and they are telling you to hedge using forward market, so you will write, we will sell FC forward. So whatever is FC, we will sell forward, and here we will buy FC forward. So this is forward. Next we will write foreign currency futures. Remember, forwards and futures are one and the same. Futures are standardized, forwards are not standardized. So absolutely same. Sell FC futures, buy FC futures. You can see they are same. So you remember forward, you remember future. Now what about DC futures? Now why you would be using DC futures? Now when FC futures are not available, when FC future quotes are not attractive, and when DC futures are trading at an attractive price, you may be tempted to use DC futures. So what do? You do the opposite. Buy DC futures. So here I will write opposite so that you can remember. So sell FC future, buy DC future. Similarly, we will write here sell DC futures. So I'll write here opposite. Opposite means do the opposite act of buying. The opposite of buy. So this is how you should remember. Then finally, number 4, if I want to use FC options, remember receivables means I am receiving foreign currency. When I receive foreign currency, what I do? I sell. Which option gives you right to sell? When I receive foreign currency, what I will do? I will sell foreign currency and convert to domestic currency. Now, which option gives you right to sell? put option. So we will write FC put. Now will I write buy or sell? Now here selling options are always highly risky. So everywhere it is a buy. So it is going to be buy. Suppose I write here DC options, then also it is going to be buy. Here also it is going to be buy. Here also it is going to be buy. So there is no selling options, only buy. So if I am writing buy FC put, receivable, I receive foreign currency, I want right to sell. Similarly payable, so I want to buy foreign currency, buy FC call. Now we have to write the opposite here. How to remember? I'll tell you. Opposite of put. What is that? That is call. So buy DC call. Similarly opposite. This is how you remember. Buy DC put. So you can see that this is how we remember. This is a very important table. This table you should remember without fail. What you can do is you can write down at different points of time. So today you write, then you are studying next time, write 2 times in a span of 2 days. Then in the exam, write first day once, second day, so that you know that you are written. You know, if you are sure that you can remember well, then no problem. But you should not be doing reverse. Unnecessarily marks also will get reverse. So you should be remembering this. So this is the main activity you will do. Now I am going to show you formats, how we should present the problem. And that completes most of the chapter, that's all. Now, first let us talk about forward hedging. So whenever forward hedging problem comes, whenever forward hedging problem comes, how you present? First you write down what is the exposure. Exposure means whether it is a receivable or payable. So this I write it as R. This I write it as P, just for our reference here. So first you write whether it is a receivable or payable. Then you write down quantum and currency. Quantum and, so this is a format. So what we are going to do, we are going to write the format of presentation, how we should present the solution. Then you write quantum and currency. Then you write due date. Now these three are very important because receivable will tell you what activity you will do. Receivable or payable. Exposure will tell you what activity you will do. Quantum and currency, obviously you must write sell FC forward $10,000, sell dollar forward 10,000. So quantum and currency is important. And due date in 3-month forward market. So due date will tell you in which market. Number 4, write the strategy. So when I told you strategy, example, we write sell dollar 10,000 forward in 3-month forward market. You can see we are written here sell forward. So this tells about what activity you are doing. Assume that it is a receivable. So you are writing this strategy, sell forward, this one. You are writing $10,000. Now this from quantum and currency we get this. In 3-month market, so from due date we get this. Okay. So this is how you present. And then show the calculation, whatever it is. So when you do this, systematic approach helps you to see things very clearly, and the person who is correcting the paper will never think of cutting any marks. even if you have done an arithmetical error, if you have written perfectly and he finds, oh, he has made a simple error, they may overlook and give you marks. Remember, discipline and neat writing always helps. Okay, now this about forward hedging. Futures hedging, it is not so simple. So futures hedging, now in futures hedging, we first write exposure. So exposure is receivable or payable. Then we write quantum and currency. Quantum and currency. Then you write due date. Then you write number of contracts. Now when you write number of contracts, there is a formula. Formula is size of exposure upon size of contract size of exposure upon size of contract. Remember, numerator, I put a star here, I put a star in numerator, and denominator should be same currency. Then only you can calculate number. Suppose I write here $10,000 upon $100. So we get dollar cancel, we get 100 number, n equal to 100. So they should be in same currency. Then only it will get cancelled and you will get number. Because you are calculating what is called as number here, number of contracts. Now when they will not be same currency or when they will be same currency. Now if FC futures are used, both will be same currency. Both numerator and denominator will be in same currency. Then when they will not be same currency. Now understand what is numerator. Numerator is exposure. Exposure from where you get, here you get. The numerator will be in FC. If we are using DC futures, if we use DC futures, then N will be equal to size of exposure. Exposure will be in FC because obviously only because it is FC you are hedging. Whereas contract will be in DC. Then can we cancel? We cannot cancel. Okay, can I change denominator? Denominator you cannot change because it is a denominator is a contract. It is like, you know, I am having a 100 rupee note. Can I convert to 100 rupee dollar? No, I can't convert. It's a product. 100 rupee currency note. Can I convert to dollar? No, I can't. So future, this cannot be converted. Therefore I have to find equivalent DC value. So you have to find equivalent DC value of FC exposure. So if I do that, then both will be in DC. So FC exposure will have to be converted to DC equivalent value, and for that purpose we need a rate. equivalent DC value. So here I'll put a dollar sign, not dollar sign. I'll put a double star sign for converting FC exposure to DC value. We use futures rate. So whatever futures rate you are going to use, that rate I will use for converting. So this FC exposure will be converted to DC value, then numerator will be DC exposure, denominator will be DC contract. So DC we can cancel, we get number of contracts. Now how will you know that whether they have given us FC contract or DC contract? We'll write that. Note, by looking at contract size, currency, or standard unit of futures rate, we can find whether we are given FC contract or DC contract. Now they will give, suppose the question says, we have a couple of problems you can easily see there. Still I'm explaining here. Suppose exposure is $1 lakh and they have given currency code like this. Futures rate is, so they are given like this, $0.015 per rupee. So they are given like this. Futures rate they are given. What is the standard unit? Standard unit is rupees. So it is a rupee contract. And what is the exposure? $1 lakh. So $1 lakh I am having, and here I am having rupee contract with respect to dollars. So it is a DC future. Or you can see contract size. They will see contract size is 1 lakh rupees. So obviously we have a case of FC futures and DC contract. So that will tell you that you have to convert the numerator and you calculate the number of contract accordingly. So once you calculate number of contract, our next step, this is see, step number 1 is this, step number 2, step number 3, step number 4. After you calculate all this, you have step number 5. Hedging strategy you write. In hedging strategy you write, example I am writing, buy $5 futures contracts, or we had write tenure also because it is a future contract. By, I'm just writing 3-month dollar future contracts at rupees 75 per dollar. So we write like this, by 5, then you have to put a comma, then only it makes a meaning, right? So you have to write the hedging strategy. You buy DC futures or buy FC future, whatever it is. This is an example I have given. Now number 6, after write hedging strategy, we have settlement. Now when you talk of settlement, we have three parts: A, B, C. Now what is the A part? A part is that FC exposure what we are having. For example, it is a receivable. So due date comes, I will get $1 lakh, assume. What I will do? I will sell. So sell receivable. So sell receivable at spot on expiry day. Or if it is a payable, or buy payable on expiry day, whatever is the spot rate. So whatever spot rate they are given on expiry day, use that rate and calculate. So you will get DC value. Whatever, remember, answer will have to be in DC everywhere. DC means of which company is hedging, you will come to know. From the we have solved many problems, you can easily understand from there. So sell receivable at spot or buy payable at spot. So what you have done, you have settled that payment. So that payment or receipt is taken care of. Now second comes derivative. So derivative would have bought futures or sold futures. So whether that will give gain or loss. Okay, so gain or loss, gains or losses from future contracts. A. If it is FC futures, directly you will get DC gain or loss. No problem. But if it is DC futures, then it will be FC gain or loss. Then the answer will be in FC. But we have to write everything in DC, remember. Everything should be DC. So this FC gain loss, you have to convert to DC. If it is a gain, sell FC in market, make it DC. If it is a loss, buy FC from market and pay. And the cost of buying FC will be DC. So DC should come, remember. Indian company is hedging, everything should be rupees. American company is hedging, everything should be dollars. UK company hedging, everything should be pounds. Remember this, very, very important rule. You have at least 4 or 5 problems, so you will easily understand this. Of options, futures, etc. If I am right, at least 3 problems are there, 2 or 3 problems are there in futures. For this taken care of, you will understand. So if it is FC futures, no problem. Straight away the answer will be in DC. But if it is DC, then this conversion will be there. Then only you will get DC. And last, margins. Margins will always be an outflow, but you will take only cost. Only cost of funding. Only cost of funding margins. This also will be in DC. So you will actually, so this or this. So you have 3 entries: A, B, C. So depending upon inflow or outflow, you will net. Now if it is a payable, A will be outflow. If it is a pay attention, if it is a payable, A will be outflow. C is always an outflow, payable or receivable. B, if it is a futures gain, it will be inflow. If it is a futures loss, it will be outflow. So depending upon whether it is inflow or outflow, you write net and that is the answer. Okay, this is about futures hedging format. Now comes to options hedging. In options hedging format, so we have number one, exposure. Number two, quantum and currency. Number three, due date. Number four, number of contracts. Size of exposure upon size of contract. So I'll just name it as A, B. Now B cannot be changed. B cannot be changed. Remember, this you have to remember. Now, if it is FC option, if FC option, A and B will be in same currency. A and B in same currency. Calculate directly. If it is a DC option, if we use DC option, then A will be in FC, B will be in DC. Then you can't cut. You have to convert A in terms of DC. Then we have to convert A in terms of DC using strike rate. This is important. So whatever strike rate you are going to use that rate and calculate equivalent DC value. When you see the problem, solve there, it is explained, it will be easy to understand. So once you convert numerator DC, denominator DC, cancel number of contracts. Now how will you come to know that the given contract is DC or FC? We identify the nature of contract by looking at a currency of contract. So they would have given contract is dollar 10,000. Contract size dollar 10,000 means it is a dollar contract given. Or standard unit of strike rate. So they will give strike rate equal to rupee 74 per dollar. So standard rupee 74 upon dollar, rupee upon dollar 74. So standard unit is dollar. Therefore, it is a dollar contract like that. Or standard unit of premium. So they would have given premium of an option. Premium is rupee 6 per dollar. So rupee upon dollar, standard unit is dollar. Therefore, given contract is dollar. So like that, we will identify the nature of contract. Then you know that then this can be identified. Size of contract in which currency B is. So this particular thing is very important. The contract, size of contract is okay. Which contract you have? Do you have DC contract or FC contract? So these three will tell you. So knowing all this, you will calculate contract size properly. Then you will write hedging strategy. the way we explained above for futures. Then after hedging strategy, you write settlement. In settlement, you have A, B, C. A, actual purchase cost of FC or sale proceeds of FC. So if it is a payable purchase cost of FC, when on expiry day. So whatever is expiry day rate, that rate you will use, and you will calculate actual cost of payable or actual proceeds of receivable. So that you will write in DC. Everything should be in DC, remember. B, premium. Now premium you write number of contracts into. So here also we will write that way. Just see here. Suppose you are writing gain loss from futures, you will write number of contracts into underlying into change in futures. So we have to find out gain loss from future contract. You will write number of contracts into underlying units per contract, underlying per contract into change in futures price. Here you will write number of contract into underlying units per contract into premium. So this will give you total premium. Now here you have two possibilities. FC options. So you will directly get the answer in DC. But if it is a DC option, then you will get in FC. But FC you will not have, therefore you have to buy in spot. Buy in spot on hedging day. The day you are hedging, and that cost you will write in DC. So you have to be very careful. If they give DC option, then problem everywhere. So when you see the solved problem, you will understand the problem. So coming to the second point, if it is FC options, no problem. So whatever premium they are given, directly answer will be DC. Remember last that column, this should be DC. Everywhere DC should be DC only. Because ultimately I am finding the DC hedging cost or DC hedging proceeds. So we cannot add dollar and rupee. You have to add everything should be rupee. Okay, like that. So after you find premium, you will find last one, exercise gains. Exercise gains, if any. Otherwise you put a simple dash. No. If FC options, it will be straight away in DC only, no problem. But if it is DC options, gain will be in FC, so which you have to sell on expiry day, then only you will get DC. Remember this, you are buying in spot on hedging day, the day you are hedging, and here you are sell on expiry day. So for this problem, option problem, you need spot rate on the day you are hedging, you need spot rate on the day of expiry. For these two purposes, if DC options are given. Okay, then ultimately you take the total, so then you take net. So this completes option forwards, options and futures hedging. Entire format, presentation, everything I covered. And when you look at problems, it will be easy. Best way is go through this once again, then do the problem on your own, or see the problem, understand the solution and solve that problem. Solve that problem. You should not be making a mistake. This is going to consume time if you are not learning properly. Okay, next we come to money market hedge. So I'm just writing the process. You can see this solved problem. First, receivables. A. So you have to follow these steps for receivable. Borrow present value of receivable. So if receivable is $10,000, so borrow present value of receivable. So you will write FC receivable divided by 1 plus RF. So you will borrow this much. Suppose they give $10,000. Now the $10,000 divided by RF I have written. So dollar rate into n by 12, depending upon how many months it is. 3-month receivable 3 by 12, 12-month receivable 12 by 12, like that. Now once you do this, B, sell in spot. C, deposit DC proceeds. Remember, when you sell PV of FC receivable, right? So when you sell in spot, we write get DC. So you borrow FC. Just here I am writing borrow FC. Sell in spot, get DC. Deposit DC. Okay, deposit DC. Step 4, receive DC proceeds. Use in business. Use, now you have borrowed FC. Use receivable or use FC receivable. Use FC receivable to repay FC borrowing. This is very important. So whenever money market hedge is given, they will give you interest rate. Because here when you receive, now you see, just see here, I am just taking an example so you will understand. Example, $10,000 receivable by Indian company. Okay, I am writing now A. So $10,000 upon 1 plus R dollar. Suppose it is 3 months. In 3 months, so into 3 by 12. So whatever the dollar rate given, so into 3 by 12. Second step. So this will be borrowed. So borrow. So you have to borrow this. Then convert to DC. Second step. Sell in spot, get DC. So $10,000 upon 1 plus R dollars into this what you have borrowed. So you will sell in spot. So when you sell in spot, you will use bid rate. So now you have got this. So this one DC you are having. Then what will be third step? Deposit. So I will deposit at DC rate, rupee rate. So this I will deposit into 1 plus R dollar into 3 by 12 into rupee upon dollar bid. This amount you are having, is it not? And this you will deposit for 3 months or rupee interest rate into 3 by 12. So this is the amount you are going to get now. So this amount I can call it as A. D. Use A in business. Money market H proceeds is equal to A. So this when they ask, can I calculate money market H proceed, then you have to, this A you have to find out. Okay. Now for payable, money market H payable. Step 1, deposit. Now remember, you borrowed in receivable. Deposit PV of FC payable. So again use the same rate, FC payable. What is the PV? PV in present value, 1 plus RF into N upon 12. So this much you will deposit. Now you want to deposit FC. Remember, deposit FC payable. But you don't have FC. Where is FC? Do you have FC? I don't have FC. Buy from spot. Buy the above quantum FC for the purpose of deposit. For the purpose of deposit from spot. So from the spot market, you buy this. So you will buy this particular quantum. Then to buy that FC, you need DC. See, first of all, you have to deposit FC. You don't have FC. You are an Indian company, assume. So you have to deposit FC. I don't have FC. So buy FC from spot. To buy FC from spot, I need rupee. I don't have rupee. Therefore, borrow rupee required to buy the above FC. Borrow rupee or borrow DC required to buy above FC. D. Borrowing cost of DC is MMH cost. So whatever will be the borrowing cost, that will be your MMH cost. Now what you will do? Now at expiry, this you have borrowed DC. So you have to repay DC. So use business cash flows and repay DC loan. So DC loan is taken care of. Now FC you have deposited, that will mature. Use FC deposit proceeds to repay or settle payable. Use FC deposit proceeds to settle payable. Use business cash flows to pay off DC borrowing. So this is how you do. So this is about DSM, FC payable, money market H. So we have seen all types of hedge. What else you have in this chapter? We have adjusted present value, that is best understood by seeing an example. I have solved one example, so you can see the problem, and where I have written the formula, there are certain things you have to keep in mind. Okay, then you have capital budgeting of foreign projects. Capital budgeting of foreign projects. So here you have to use certain simple rules. Remember, if you are using a foreign project, then either you can use foreign currency approach. Now when I say foreign currency approach, then I calculate NPV like this. NPV is equal to minus foreign currency plus foreign currency cash flow first year plus foreign currency cash flow second year, and so on. So everything will be in FC. So India is setting up a project in the US. It will be minus $10,000 plus dollar upon. Now this should be FC. KFC means expected rate of return of foreign investor, because you are investing in US. So whatever return is expected by US investor, you want that. Now sometimes it will be given directly, sometimes it may not be given. Suppose they give, if K foreign currency is not given, but K domestic currency, risk-free rate domestic country, risk-free rate foreign country are given. See, I need for foreign currency approach, I need K, expected rate of return of foreign investor. NPV, you must have learned in IPCC. This is the formula for NPV, minus outflow plus present value of inflows. Now present value means discounted using cost of capital. Now since it is a foreign project, it is a cost of capital of US investor. Assume India is setting up in US, whichever foreign country investor. Now if it is given directly, no problem. But if FC this is not given, then they will give these three. If they give these three, then we follow this method. We use this formula. Just see this formula and learn. 1 plus KDC is equal to 1 plus RFDC into 1 plus risk premium. So this and this are known, therefore we get risk premium. So using KDC and RFDC, we will calculate risk premium. Then again we use the same formula. But for FC, just see 1 plus KFC is equal to 1 plus RFFC into 1 plus risk premium. Remember, these two risk premium are same because we are talking of same project. So they are same. So we have calculated, we get risk premium. So now this is known, this is known. So therefore KFC can be calculated. Therefore KFC is calculated here. The KFC is found out. So this you learn. So summarizing, NPV means minus outflow plus present value of inflows. So therefore, we have to discount the foreign currency cash flows with foreign expected rate of return. Because every foreign currency approach means everything in foreign currency. Therefore, expected rate of return should be foreign currency. So then we use this method. Then the second approach is DC approach. DC approach means everything will be in DC. Domestic currency approach. Then NPV will be minus DC outflow plus DC inflow first year upon 1 plus K DC, DC inflow second year upon 1 plus K DC square and so on. So now everything is in DC. Now if they give an FC, here what they will do, if FC cash flows are given, then use spot rate. Now FC cash flows are given, I want in DC. Use spot rate to convert. Use spot to convert year 0 FC cash flows. Use spot rate to convert year 0, that is today's FC. I have to convert to DC. I can use spot rate. Use interest rate parity theorem or purchasing power parity theorem to convert year 1 and future cash flows. So we can always find a forward rate for year 1, forward rate for year 2, forward for year 3, or expected rate 1, like that. Using, if they give interest rates, you can use interest rate parity theorem and calculate forward rate for year 1, year 2, year 3, etc. But if they give inflation rates, then you can calculate expected rates of year 1, year 2, year 3, etc. So then what happens is, we can use those rates to convert the remaining cash flows. Okay, now this is how we calculate NPV. Now we have got cash management. Now cash management problems are solved, which is straightforward. But multilateral cash management, I'll give an example. Multilateral means there are, say, 3 offices of a company. There are 2 offices of a company. Suppose I have a company and it has got office in Germany, Japan, apart from US. So I'll write like this: US, Germany, Japan. Now US has to pay Germany $100. US has to pay Japan $50. Germany has to pay US $60. Germany has to pay Japan $30. Japan has to pay US $100. Japan has to pay Germany $20 cash. Now just see if each of them transact for every payment they have to make. Now US has to pay for Germany and Japan. So 1, 2. Germany has to pay US and Japan. 3, 4. Then Japan has to pay US and Germany. 5, 6. So total 6 transactions need to be carried out. And what is the total? Just see if you take total. Take the total. This is $150. This is $90. This is $120. So total $360. So you have to, so total transacted money will be $360. And 6 transactions have to be carried out. But if we net, means US will say, look, I have to pay you and you have to pay me, let us set it off. If you do that kind of thing, that is called netting. Now here we have multiple companies, multilateral netting. So how we go about? So we first add the way we have done here. Then we add this $160, $120, $80. Now what is this? This is total receivable. So now US has to receive. See, I told you US has to pay. I was telling, to pay this. So Germany has to pay this. Japan has to pay this. So I can say total receivable. When I take the vertical total, it will be total receivable for each country. Now minus total payable. So what I'm going to subtract this. So $150, $90, $120. So receivable minus payable. $10, $30 minus $40. So you can see that Japan has to pay. Japan has a net payable. Now net receivable slash payable. If it is in bracket, it is payable. So Japan has to pay. So what Japan will do? Japan will pay Germany $30. Japan will pay US $10. That's all. Only 2 payments and total $40. So just 2 payments. Versus 6. Just $40 versus $360. So instead of doing $360 transaction, remember it will be in millions in real life. Here we have put a small figure. So you are transacting just $40 and only 2 transactions. So what is the saving? Savings. Transactions. 6 minus 2 upon 6 into 100. Because you have to do 6 transactions, you are going to do only 2. So 4 transactions are saved. So 4 upon 6 into 100. Similarly, value of transaction, saving in value of transaction. Value of transactions. So 360 minus 40 upon 360 into 100. You have to transact 360. You are doing only 40 now. So 320 is saved. So 320 upon 360. So with huge savings. So this is the advantage of multilateral netting. So multilateral netting saves cost, saves number of transactions. And remember, otherwise everybody, if I had to pay foreign currency, I hedge. The hedging cost is also removed. So many advantages are there. Okay. So in this chapter, there are specific problems like costs of GDR, where concept of DDM is used. When you go to the problem, you'll understand that. There is currency swap, that is done in the next chapter. That is interest rate risk management. There is hedging. So hedging we have seen in detail. So this has completed the entire chapter of FC hedging. Hope you have understood this. In case you have not, run through it once again. And while solving problem, I already said you can adopt 2 methods. After having understood this, you can give a shot. You can try the problem. After I read the problem, you can pause the video, solve it properly, and then verify the solution. That is method 1. And when you verify, suppose you find errors, circle in red, write down and understand, and try to solve one more time without a mistake, or see the solution first and try to solve. Okay, hope you have got everything. Let us now see the concepts connected with this part of forex, that is hedging exposure. There is no formula, there are only strategies. Here we are going to see how we can hedge exposure. What is an exposure? Exposure is a position which you have taken in foreign currency that is subject to change in value due to movement of foreign exchange. Suppose I have $10,000 receivable. Then if I am an Indian, then rupee value of $10,000 will change. Why? Because foreign exchange rates of rupee and dollar will change. Then I can say that the $10,000 which I am supposed to receive is an exposure. So exposure is something that is exposed to risk. Why risk takes place? Because the foreign currency moves. Suppose the foreign currency doesn't move at all, then I am getting a fixed value in rupee terms. So whenever there is a movement in foreign currency, then it automatically creates an exposure in that currency. So what are the two kinds of exposure? One is receivable, other is payable. I am an exporter. I am going to receive $10,000. This is a receivable. I am an importer. I have to pay pound 10,000. Now this is a payable. Remember, these are not due today. If it is due today, it is not an exposure at all. Why? I can go to bank and remove this. If I can go to bank and book the contract in spot market, and I can settle it immediately. But I am not talking about those which are due today. I am talking about those which are due in future. Now they are only categorized as receivables and payables. If I have something to receive in future, it is a receivable. If I have something to pay in future, it is a payable. Now if I am going to receive something in future, how I show in the balance sheet in accounts? I show it under receivable. So accounts receivable we have. Suppose I sell goods on credit. I am going to receive some funds. So that is accounts receivable. In the same way, it is receivable is something which are denominated in foreign currency that I am expecting to receive in future. So receivables are in the nature of outstanding foreign currency asset. Similarly, payables are in the nature of outstanding foreign currency liability. So receivables, I am supposed to receive foreign currency when sometime in future, therefore it is outstanding foreign currency asset. Whereas payables are outstanding foreign currency liability. Now what is hedging? Hedging is to protect the current exposure, whatever you have now. I am having $10,000 exposure. Suppose I am going to receive $10,000. If the value of dollar rises, so my exposure value rises. If the value of dollar falls, my exposure value falls. Now what is hedging? Hedging should nullify this. Hedging should actually nullify this. So what I do is I create that position which will show opposite movement. So when this increases, that position should decrease. If this decreases, that position should increase. So I am having one outstanding asset receivable and I am creating another asset which should be outstanding liability. So when foreign currency changes, asset and liability will move opposite, and when they move opposite, they nullify the effect. So whenever you have receivable which is in the nature of outstanding FC asset, create a liability. Similarly, whenever you have payable which is in the nature of outstanding FC liability, you create an asset. So that asset and liability will move in opposite direction when foreign currency value changes. So this is a broad strategy we are adopting, but the derivative types are there. So we have forward, futures, options, and we are also going to see money market. Let us take the first derivative, forward. If I have receivable which is in the nature of outstanding FC asset, then you sell foreign currency forward. When you sell foreign currency forward, I am supposed to pay foreign currency in future. So it is a liability. Sorry, this is a liability. So this liability will offset this asset. Same is for futures. Futures are standardized forward contracts. So I use the same strategy, sell FC futures. You can see sell FC forward, sell FC futures. Sometimes FC futures are not available. Then I use DC futures. Instead of selling, I buy DC futures. So when you read the problem, first identify whether you have a receivable or payable. If it is a receivable, then you have to think that it is in the nature of outstanding foreign currency asset. Therefore, you have to create outstanding foreign currency liability. And when you sell foreign currency, you can see here, when you sell foreign currency, you are creating outstanding foreign currency liability. Sometimes the foreign currency futures may not be available. Then you use your own currency, DC. DC means domestic currency. In that case, you create your own domestic currency futures, but you do opposite transaction. So you do buy DC futures. Now we come to options. If receivables are in the nature of outstanding FC asset, so I want to create a liability. Now how I create a liability? Now liabilities are what? Liabilities are those which you are supposed to pay in future or deliver in future. Suppose I promise you that I will give you 5 kg of wheat 3 months from now. Means what? I have taken an obligation on myself to give you 5 kg of wheat. Now in which option you have a condition that you have to deliver? That is nothing but put option. So if I buy foreign currency put option, then I am having a liability to deliver foreign currency in future. So this liability will offset this asset. So that is a hedging strategy. So buy FC put. Now sometimes FC put is not available. Now if FC put is not available, then you will use DC. Remember, unlike futures, you will never sell option. You can see therefore that you have buy, here also buy. You will never find a sell in option because selling options are risky. Remember, this is a chapter of hedging. So you will not create any position which will create further risk. So selling option is ruled out. So we have only buy of option. Suppose I don't have FC option, then I use DC option. If I use FC option, I will do FC put. But if I use opposite currency, I will do DC call. Now, in the class, I have given you lengthy notes about detailing each and everything what I said. Similar strategy we will follow for payable, but slightly they are of opposite nature. So this table is extremely important. Now coming to money market, and money market is best understood with example. Here I have just given borrow whenever we have a receivable, borrow PV of FC. Whenever we have a receivable, your first step should be whatever foreign currency receivable you have, find out the present value using borrowing rate of foreign currency and borrow that in the bank. Then once you get FC, sell FC in spot at debit rate. And when you sell FC, you get DC. So get DC. Then deposit the DC in bank. So deposit DC matching the period. So deposit DC matching the period of the receivable. Now deposit proceeds of DC is the money market hedge proceed. So whatever you will get after depositing DC, that final amount, that is your money market hedge proceeds. As I told you, this can be best understood by solving an example. We have already done in the class. Try, in case you are not getting, there are some problems on money market hedge in this video where I have explained the concept in detail with the problem. Exactly opposite you do with money market hedge payable. Understand, in money market hedge, that is this part, receivable. Why we are doing this? Let me explain that part. Receivables are outstanding FC asset. Hedging strategy should be create outstanding FC liability. But I have to create liability in money market. How I can create a liability in money market? If I borrow. If I borrow, I will create liability in money market. So that is hedging strategy. Therefore, money market hedge receivable, the first step is borrow PV of foreign currency. Now payable. Payables are future payments which I am supposed to make. Therefore, they are liability for me because I have to make payment. What is hedging strategy? Hedging strategy is create asset in the same foreign currency for the same quantum. So how I can create asset in money market? If I deposit, I can create asset because if I deposit today, it will mature 3 times from now, assume. So today if I want to report, I will call it as an asset because I am going to get deposit proceeds. So you have to create an asset. How you create an asset? You deposit PV of FC. So therefore the first step in managing payable using money market hedge, the first step is deposit PV of FC. So the rest all are explained in the problems solved in the in this video. And if you have already understood what we have done in the class, you can attempt the problems and then verify. Hope you have understood this. We now move on to the next chapter.